Please take your seats. 2025 Bitcoin for Corporations is about to begin. Please welcome to the stage your host, Natalie Brunell.
Good morning, everyone. My name is Natalie Brunell. I'm the host of the Coin Stories podcast and author of the upcoming book, Bitcoin is for Everyone. And I'm so honored to be here to welcome you to day 2 of Bitcoin for Corporations. First of all, I just want to say thank you so much to the generous sponsors that make this event possible, and of course to the brilliant team at Strategy. I don't know about you, but I've attended many conferences for Bitcoin, and this is one of the most inspiring because so many people's lives have been changed, not just by Bitcoin here, but actually by strategy. I've met at least a handful of people who say that they've been able to retire early, they've been able to expand their families, and I think that it just shows you the power of not just Bitcoin, but an executive team that has such vision. So I'm excited to kick off this day. We have a very amazing lineup with some of the biggest names in Bitcoin. And I want to remind everyone that it's not just these massive public corporations that can embrace a Bitcoin treasury strategy. If you recall Michael Saylor's slide yesterday, there are hundreds of millions of companies around the world, many of them small businesses that can also benefit from a Bitcoin treasury. I have a small media company and it has a Bitcoin treasury. And I'm proud to say that it holds that Bitcoin at River. And our next speaker is from River. He is the CEO. Alex Leishman will be talking about the case for Bitcoin. He's the founder, chief executive officer, and chief technology officer. And River, in case you don't know it, is an institution dedicated to providing financial products and services to harness the transformative possibilities of Bitcoin. He brings his deep expertise in software engineering, information security, and Bitcoin to River, where he oversees investor relations, corporate strategy, and engineering. He holds a master's in computer science from Stanford University, where he helped teach the first Bitcoin class. Welcome, Alex Leishman.
Oh, here's the clicker. Hi, everybody. It's amazing to be back at Strategy's Bitcoin for Corporations conference. This is the 3rd year in a row for me. It's even more incredible to be on stage in front of a group of business leaders from around the world. And I think the coolest thing is that most of the people in this room believe that Bitcoin is here to stay. That wasn't the case just a few years ago. Business leaders were not embracing Bitcoin, and a lot has changed recently. And today, I'd like to make the case to you, using some insights that we've compiled at River from both public data and proprietary data that we have, that Bitcoin isn't only here to stay, it has a long way to grow. So I like to break down Bitcoin's life into 3 different phases. The first phase was the Wild West. The second phase, which is the phase that I'll argue that we're in today, is the it's here to stay phase. And then Bitcoin's final phase, I believe, will be as a global reserve asset. In the Wild West days, there were very few trustworthy financial institutions focusing on Bitcoin. There weren't many safe places to buy Bitcoin, to custody Bitcoin. It was a very risky industry with a lot of fraud, but a lot of exciting times as well. And I would argue that we transitioned from the Wild West phase into the it's here to stay phase around the same time that Michael Saylor entered the chat. Michael was a bridge between the early ideals of Bitcoin and the builders to the mainstream institutional capital. And I deeply believe that we are now in the here-to-stay phase. And let's look at why. So if we look at Bitcoin ownership globally, we've seen drastic growth in the amount of people and individuals who own Bitcoin. Over 4% of the world owns Bitcoin today. And if we zoom into the United States, over 10% of Americans own Bitcoin. That's an incredibly powerful political bloc and group of economic actors. And if we look at the global map, the Americas are leading the way as it relates to Bitcoin adoption. Looks like the map was a little messy. So what does that 10% mean? Is that a lot? Well, more Americans now own Bitcoin than own gold. Almost 50 million Americans today own Bitcoin. Americans have been stacking gold since 1776. They've only been stacking Bitcoin for 16 years. That's pretty incredible growth. If we look at public company holdings of Bitcoin, the number of public companies holding Bitcoin has doubled in the last year. Public companies are institutions in the United States that have been blessed by the highest powers to offer investment-grade assets to the public. And the fact that we've seen a doubling in just 1 year of companies like this owning Bitcoin is pretty incredible. And the most powerful financial institutions are also doubling down on this asset. The amount of hedge funds and RIAs making massive allocations to Bitcoin, especially since the advent of the Bitcoin ETF from just over a year ago, is accelerating. And more importantly, countries are becoming more supportive of Bitcoin. Politics is just how humans socially coordinate to create rules. And so when governments get more friendly towards something, it's an indication that the will of the people is in support of this thing. There's an implication of permanence here. 47 countries since 2020 have become increasingly friendly towards Bitcoin from a regulatory perspective, with just a small handful of countries moving the other direction, and those are the usual suspects: China, Venezuela. So where do we go from here? What's next for Bitcoin? What does Bitcoin adoption look like going forward? And to understand that, I think it's important to look at the historical narratives and role that Bitcoin has played in society. In the early days, in 2010, Bitcoin was seen as an experiment. The vast majority of people using Bitcoin or working on Bitcoin at that time, they didn't have any deep belief that this would become some global store of value, that this would become a very important asset in the world. There were a few deep believers, but by and large, most people thought this was just an experiment. In fact, there were Bitcoin faucets back then. You could go to a website, fill out a CAPTCHA, and just get free Bitcoin. It was pretty cool. By 2013, a lot had changed. Markets started developing for Bitcoin, pretty liquid markets. But there were a lot of ups and downs. Bitcoin hit $1,000 by the end of 2013. But at the same time, the largest Bitcoin exchange in the world, Mt. Gox, based in Tokyo, collapsed and took a lot of people's money with it. So it became pretty clear. This thing is pretty interesting, but there's a lot of risks that come with this asset. And it started being seen by people as something that I should probably pay attention to, but I don't know where it's going to go. But if it does go somewhere, I want to have some. This is where it started entering its speculative investment phase. By 2017, all of Silicon Valley had crypto fever. The narrative then was actually that Bitcoin wasn't here to stay. Bitcoin was AOL, and all of these new tokens that the Silicon Valley VCs had funded would be the next Bitcoin. During this era, we saw the Binances and the Coinbases of the world really grow. But Silicon Valley was wrong. Bitcoin wasn't AOL. During the crypto proliferation, Bitcoin just got stronger and came out the other side still the king. And it became very clear that the main narrative here is about Bitcoin. So by 2020, most people who knew about Bitcoin knew that Bitcoin was pretty important. This thing was real. It was worth paying attention to. But the powers that be, the politicians, the regulators, they still did not like Bitcoin. And the prevailing narrative was that, yeah, Bitcoin is interesting. It actually, it is pretty neat, but there's no way the government will ever let this thing grow. In fact, even President Trump at the time in 2019 tweeted, he doesn't like Bitcoin. So let's fast forward. 5 years later, everything changed. And in 2025, we have President Trump buying a hamburger with Bitcoin at PubKey in New York. And Bitcoin is one of the primary platforms, one of the primary pillars of his presidential platform. So we've come a long way. So what comes next? Bitcoin's narrative and its role over time went from an experiment to an investment, a speculative investment, which I would argue it's been for most of its life, is this speculative investment that's worth at least just having some just in case. And I'd like to argue that the next phase for Bitcoin's, for the way Bitcoin's role in society and the narrative around Bitcoin is Bitcoin as a default savings asset, Bitcoin as a store of value. Bitcoin is something distinct from risk-on textile investments. So what evidence do we have for this? If we look at some of the largest macroeconomic events in the last 5 years, some of the most disruptive macroeconomic events, we see that throughout the vast majority of these events, owning Bitcoin was superior to owning gold or the S&P 500. Most recently, during Trump's Liberation Day, we saw the exact same thing. And the more this happens, the more it's going to happen. The more Bitcoin behaves like a safe haven store of value, the more it will be seen as a safe haven store of value. And we can look at individual adoption. Using some on-chain analytics, we can see that Bitcoin is increasingly held for longer on the Bitcoin blockchain. Now, on-chain analytics aren't perfect, but they directionally indicate that Bitcoin is trading hands less and less often. It is more commonly being accumulated and held for longer periods of time. In fact, over 42% of clients at River who have ever bought Bitcoin have never sold it. And the most important data point, I think, and what this conference is all about, is the business adoption of Bitcoin as a treasury asset. And to me, the trend here is undeniable, and it is the strongest indicator that Bitcoin is becoming seen as a distinct asset, as a store of value. Businesses are stacking Bitcoin at an unprecedented rate. Here's a chart showing the estimated business Bitcoin treasuries using both known public company data and disclosed private company treasury data. So that means that this chart is an absolute lower bound. It's almost certainly higher than this chart. And we've seen tremendous growth in the last year. Now, it's important to hammer this point home. These companies are thinking about preserving their treasury. They're not running hedge funds. They want to preserve their capital through time to further the interests of the business and their operations. What are these companies not doing? These companies are not opening Charles Schwab accounts and buying Apple shares or Tesla shares. These companies historically have held cash and cash-related assets. And they're skipping stocks. They're not even looking at that for preserving their treasury. They're going straight to Bitcoin. To me, this is the biggest indicator that Bitcoin is becoming an asset totally distinct from being seen as anything like a tech investment. And we have hard evidence at River. We serve over 2,000 businesses today, and that number grew 154% last year alone. And these are real companies, real small and medium-sized businesses from around the United States, construction companies, real estate companies, biotech companies, plumbing companies, farms, restaurants, everything you can imagine. highly diversified. All of these business owners and operators are coming to the same conclusion, that they want Bitcoin. Most of these people had never had anything else in their treasury other than cash and cash-related assets. And the first thing they're doing to diversify their treasury out of that is buying Bitcoin. They're not buying stocks, they're buying Bitcoin. We're also seeing the most conservative financial institutions in the world continuing to grow their Bitcoin allocations. Insurance companies, pension funds, university endowments. The narrative is changing quickly. And lastly, nation states continue to build Bitcoin reserves. You have the leaders, like El Salvador, continually buying Bitcoin. You have state-sponsored mining operations in Bhutan and other countries. I think we'll probably see the announcement of a few other nation states over the coming years buying Bitcoin or running Bitcoin mining operations. And we have the Bitcoin Strategic Reserve in the United States. We'll see what actually comes to fruition there. But the fact that this is even a point of conversation. The United States is not discussing a strategic Tesla share reserve or a strategic Apple share reserve. Strategic reserves are for assets seen by the people of a country and by the government of that country as critical for having a reserve for various scenarios. And the fact that Bitcoin is in that conversation at all, to me, is proof that Bitcoin is becoming seen as something completely distinct from a risk-on tech-type investment to being seen as a true store of value and place to save. So what does this tangibly mean? What are the activities and behaviors we're going to see from people because of this shift? Well, for one, I think that Bitcoin savings will become mainstream for individuals. Said another way, Bitcoin is going to kill the savings account. Today, the people who save in Bitcoin are seen as a little bit wacky. It's maybe becoming a little bit normal over the last year or two. But years from now, saving in Bitcoin will just be seen as the default. People won't even think about it. That will just be what they do. A large percentage of their paycheck every month, every 2 weeks, will be going to Bitcoin. Bitcoin as a treasury asset for businesses will be mainstream. Today, the entrepreneurs who are buying Bitcoin for their treasury are leaders. They're pioneers. They're doing something different. It's just going to be normal in 5 years. It won't even be special. So my worst case analysis is that Bitcoin becomes a reliable tool for saving, which is massive. This means that every business and every human on the planet saves in Bitcoin. But it could be even bigger. Bitcoin could emerge from this, the next phase after this, as a true global reserve asset. Now, I don't have time to go into this today. Perhaps this will be a talk for next year. But I think this is the true end state for Bitcoin, and I think the trajectory is clear. So just to reiterate, over the coming years, I expect businesses and individuals to continually save in Bitcoin. Yet they'll still use dollars for transacting. You'll still get paid in dollars, but you'll save in Bitcoin, and you'll pay your bills in dollars. Businesses will continue to stack Bitcoin for their treasury. This will lead to drastic pressure on the upward price of Bitcoin, and it will become a very mainstream part of our financial lives. Thank you, and I look forward to seeing you all again next year.
Thank you so much, Alex. I'm glad I could help with those statistics with my stacking. All right, next up we have Chris Kuiper. He is the Director of Research for Fidelity Digital Assets, which provides enterprise-grade digital asset solutions for institutional investors. Chris contributes to and oversees the research creation process to provide leading Bitcoin education and resources to clients. Welcome, Chris.
All right, thank you everyone. Thank you for being here. Thank you to Strategy for inviting me. It is a pleasure and honor to be here today. One of the things I do at Fidelity Digital Assets on the research side is I talk to a lot of institutional investors. So money managers, fund managers, advisors, and I try to speak in their language, making the investment case for Bitcoin. So that's what I want to try to do this morning. I want to take that, but tailor it to corporations and specifically talk to corporations. To be clear, I think that you have to have the philosophical understanding and conviction in Bitcoin. You have to have the fundamentals, a lot of the stuff that Alex just talked about. But it helps to add another leg to that investment thesis stool, the investment angle. And so let's jump in right into the numbers here. I'm going to put on my CFA hat, my nerdy analyst glasses here. This is a chart that I show a lot of institutional investors. This is, broadly speaking, their menu of options if they're running a fund or running money. You see they've got stocks, fixed income, real assets, and then you've got your first two columns are your return. Your second two columns are what they consider to be risk. I'm going to talk a little bit about that in a second, though. And then the last two, bring those two together, risk versus return. So not surprising for a lot of people here, Bitcoin 79% annual, compound annual growth rate over the last 10 years. Now you might say 10 years, well that includes a pretty fantastic early period for Bitcoin, you would be right. But if you take the last 5 years, it's still very high, around 65%, so I'm not trying to cherry pick here. I'd rather have the 10-year picture for you here for the other things. So for example, corporations, as Alex said, they're not buying stocks. Real assets are hard. Gold, commodities, real estate, they're hard to buy, they're hard to purchase, they're hard to insure, transport. They're literally boxed in that middle box. Treasuries, maybe they can go out on the duration curve with intermediate treasuries, investment-grade corporate bonds. But you see, over the last 10 years, they've only gotten about 1.3% out of those. And that's nominal. We're going to get to real in just a second, real returns. Now, of course, the reason for this is they like the low risk, the low perceived risk. Low standard deviation, not too much of a drawdown there. But if you put the two together, which is what a good analyst should do, what return are you getting for the risk you're taking on? The Sharpe ratio shows a different story. So Sharpe ratio, as you know, is your excess return, return minus your risk-free rate, divided by that risk measure, standard deviation. The Sortino ratio might be a little more interesting, especially for corporations, because this takes your excess return and divides it only by the downside standard deviation. So in other words, most people don't care if Bitcoin is volatile on the way up, it's ripping higher. They care when it's crashing and going down, and I'll get to that in just a second as well. So here's your return, risk versus return. The other thing they always look at is correlation. So on the left chart there, you see the correlation of Bitcoin to major asset classes. Most people are surprised it's this low, but this is over a longer time period. At some time periods, it is very high, especially to things like stocks. But if you take a longer-term view, low correlation even to things like commodities, gold, real estate, other real assets. The chart on the right is what I think is more interesting. This is very underappreciated, in my opinion, both in the Bitcoin community and certainly the investment community. This is a histogram showing the monthly returns for the S&P 500 in blue, and then Bitcoin in orange, of course. So the S&P 500 looks like a pretty normal distribution. So on any given month, the S&P is going to go up 1% or 2%. Maybe it'll go down 1% or 2%. Bitcoin, of course, is completely inverted. It's flipped inside out. Any given month for Bitcoin, you're not going to go up or down 1% or 2%. You're going to go up a lot, or you're going to go down a lot. And this obviously talks a little bit about the correlation. So this is why it's uncorrelated. And that's, of course, the holy grail in finance. Find an uncorrelated asset to add to your mix. You can improve your risk-adjusted returns. William Sharpe, of the Sharpe ratio that you just saw, he is thought to have said, I can't prove this anywhere, but everyone agrees at one point he said, there's no free lunch in finance except for diversification, or diversification is the only free lunch. So that's one reason why this is interesting. But more importantly, the distribution is skewed to the right, at least historically, meaning there's more times when Bitcoin has gone up than it's gone down. And this makes it very different from every other asset class out there. So if you've heard of good cholesterol versus bad cholesterol, not all cholesterol is the same, LDL, HDL, good versus bad. You want the good cholesterol in your body, you don't want the bad cholesterol. Bitcoin has more good volatility than bad volatility. And this makes it unique because, for one, you can actually harvest that volatility. If you do a quarterly, monthly, annual rebalancing, whatever it is, Bitcoin goes up, you rebalance back to your target rate, you're harvesting that volatility. The other reason this makes this so unique, and this is what I think is quite profound, is that it turns on its head a lot of traditional finance, which says volatility equals risk. The pure definition in finance is things like standard deviation. But that's because most assets have that normal distribution. Or they even have, you can even see in this chart here, there's a little bit of a spike in the blue to the left there. So if you heard the old Wall Street adage, stocks take the escalators up, the elevator down, that's because that volatility comes at times of crashes. And that's why they think of volatility as risk. Risk is not volatility, though. Volatility, the other side of it, is opportunity. True risk, in my opinion, is permanent loss of capital. And of course, I'm not the first to say this. I think even Warren Buffett, who hates Bitcoin, has said this before. So risk is not volatility, it's permanent loss of capital. So for corporations, the permanent loss of capital they should be concerned about is this. You've seen this chart before, the purchasing power of the US dollar. This is used with CPI numbers. Notice on the left, I've done a logarithmic base 2. So every horizontal grid line you see there is the dollar getting cut in half. So you can see the half-life of the dollar is a decade, maybe 2, if it's doing okay. And so this is the problem that everyone faces on an individual level and certainly a corporate level. You say, well, that's fine, but I'm a corporation. I don't put cash in a vault. I don't stick it under a mattress. I invest it. So here's cumulative returns of a 3-month Treasury bill, $100 to what it is to today. So you've done a little better. Nominal returns for bonds, 10-year bonds, you can do even a little bit better still. But of course, that's nominal. If you look at real returns, the 3-month T-bill, you've barely tread water. And with treasuries, you've done a little bit better as interest rates have come down and inflation has come down as well from the 70s and 80s. This next chart here, I saw a version of it, and I didn't actually believe it when I first saw it. A lost century in 10-year treasuries. Meaning if you held a 10-year treasury for 100 years, after your real return, after inflation, and after tax, you have made no progress. So I actually calculated these numbers myself to verify it. Don't trust, verify, right? And it's worse than I thought. So I've used the statutory tax rate historically for corporations here. So maybe tax rates are around 21% right now for corporations. They've been as high as 50% or more. So as you see with the recent bout of inflation, you are, again, underwater after almost 100 years. And the question, of course, is, do you think tax rates for corporations will stay at 21%? Do you think inflation will stay where it is today? Do you think interest rates have a lot more room to go lower and bond prices higher? Maybe, maybe not. A lot of corporations say, okay, I'm convinced. I've got to protect my purchasing power. This is a real threat, especially maybe in today's macro environment. But the thing that scares them the most is this. They look at these massive drawdowns in Bitcoin. And to be clear, we have to recognize this. 70 to 80% drawdowns are nothing to sneeze at. So let's acknowledge that up front. But one thing I want to point to is notice the time period here. Every drawdown lasts maybe 3 years or so. But this is why they go into things like 10-year treasury bonds, or even shorter. They see these nice, shallow, nominal drawdowns. Very short, very shallow, although recently, minus 20%. But again, the bigger threat to a corporation, especially if you plan to be around for a long time, is your real return. This is effectively the drawdown you're experiencing because you have to use your money to purchase things. And so even bonds have experienced a 55% drawdown on an inflation-adjusted basis. And notice it wasn't just 3 or 4 years of a drawdown, it was 40 years of a drawdown that they sat in that underwater. I just saw a statistic this week. The US aggregate bond index, so the Bloomberg US aggregate bond index, is in its 57th year of a drawdown, the longest it has ever been in its history. And it's still going on since the year 2000. So again, this is what Bitcoin is designed to protect against, in my opinion. In our research, we find Bitcoin is driven by 2 major macro factors. Number one, currency debasement, which we're showing here with the global broad money supply change year over year. Notice there are 2 different axes, so Bitcoin has massively outperformed that debasement. And then inflation expectations. Not CPI, which is backwards looking, but if you look at when inflation expectations actually spike, that's when Bitcoin is spiking as well. And so this is what it's designed to do. If you look at this data on this chart, it actually has an R squared of 0.8 to 0.9. That means that 80 to 90% of Bitcoin's move can be explained by the change in the money supply. All right, so even after saying all that to a lot of corporations, I still hear from them, I got to protect my purchasing powers, but I just can't handle that volatility. I've got bills to pay, I've got intermediate bills to pay, I've got intermediate opportunities to pursue, and I certainly can't have a 80% drawdown at a time when it's probably going to be pretty bad for the rest of the environment as well. Again, that elevator, that crash there. So I'll offer two simple ways to mitigate this volatility. Number one is just the power of position sizing. In the green, you see the current option set for someone like a corporate treasury. They can be in T-bills, cash-like instruments. There's no max drawdown there. There's no drawdown at all. But of course, they're not keeping up with inflation, minus 1.2% over the last 10 years. It's actually worse if they go out on the duration curve with 10 years, at least it has been over the last 10 years. And then, of course, you have Bitcoin, but they can't stomach the 75 to 80% drawdown. But Bitcoin, like a lot of things in finance, is not an either or. It doesn't have to be. It doesn't have to be 100% in or 0% out. It's not a switch. It's more like a dial. So you can think about adjusting an analog dial. You can move your exposure up or down depending on your risk tolerance, depending on your situation. And so here in the orange columns, you see just some hypothetical examples. These are not recommendations necessarily. But the cash part is just 3-month treasury bills. It assumes annual rebalancing. It assumes reinvestment of dividends. And you can see by blending in different levels of Bitcoin, you can greatly increase your returns, at least historically you would have. Your risk in terms of standard deviation, that classic measure, does go up. But what you're mostly concerned about is that max drawdown. And you can dial this up to what you think your company could handle. And then to throw another ratio at you here, we talked about the Sharpe ratio, the Sortino ratio. There's also the Calmer ratio. And that is your excess return divided by your maximum drawdown. And this is very important for companies like banks who have certain capital requirements, or any corporation that just says, I need X amount of cash. I can never go below this line. And so you can see the Calmer ratio for different levels there, and you can, again, dial this up or down to what suits you. So that's one way to handle it. The second way to handle it is just have a longer time frame. This is Bitcoin's compound annual growth rate over various periods, rolling periods. So you've got rolling 4-year CAGR, rolling 5-year, rolling 7-year, rolling 10-year. And you can see the worst that has ever happened, at least historically, is that 5-year CAGR. At one point, you barely hit 0, maybe dipped it below it for just a few days or weeks. But if you have a long enough time period, all of these have been positive on a rolling basis. So again, if you don't need cash as a company for the next 4, 5, 7 years, you can ride it out. You can wait out the drawdown. You can wait out the volatility. But this goes back to my first point. That's why you have to have the conviction as well. All right, this is my favorite part. I started my career as an investment analyst. It's what I did mostly before coming to Fidelity. And early on in my career, I listened to hundreds, if not thousands, of corporate earnings calls. And it became clear to me right away that corporations and Wall Street focuses almost exclusively on the income statement, not the balance sheet. So it's all about revenues. What was your revenue growth? Did you hit your target? What were your expenses, your margins? And then that big EPS number. Did you hit it? Did you exceed it? What did you guide to? You guys know this game. But as I tried to be a better analyst and I started reading a lot of books, some of the better analysts out there, they all said the same thing. Start with the balance sheet to understand a company. And then my mind was really blown. My eyes were literally opened when I came across Michael Mauboussin. I don't know if any of you have heard of him, but he's a great thinker. He's a professor of finance. He's worked in the industry many, many years. He's an author of multiple books. And the book that really opened my mind was one called Expectations Investing. And there's a lot in this book that I won't get to, but the big part about it is he introduces return on invested capital. And this is not unique to him, but he's the one that put it in terms that took out a lot of the noise. So if you're not familiar with return on invested capital, it's simply this. You take your income statement, you want to get your cash earnings, so NOPAT is net operating profit after taxes, and then you divide that by your invested capital, and that comes from your balance sheet. So it is explicitly linking the income statement to the balance sheet in one metric. If you're wondering what the invested capital is, just a side note, you can compute it top down or bottom up. If you're going from the bottom up, it's simply your net working capital plus all your property, plant, and equipment, your acquired intangibles, and your goodwill. So basically all the stuff you need to operate your business. So if you take the cash earnings divided by your capital base, you get return on invested capital. Now, this number doesn't mean a whole lot just by itself. You can see trends if it's going up or if it's going down for a company. But where it really comes into play is when you compare a company's cost of or return on invested capital to its cost of capital. So if it's returning more than its cost of capital, you're creating shareholder value. Less, you're destroying shareholder value. Now, where the insight came from with Malbus and others is that you can decompose this, you can see what's driving it, but most of all, it strips out the noise of the income statement. It strips out the noise of all the things you hear on financial television and analysts and what they're saying. Because, for example, a company could be growing its earnings very quickly. But if it's growing its invested capital base to get that earnings growth or that revenue growth, it could be destroying capital. And you wouldn't know it just by looking at the income statement. And the research shows, and the academic research shows, that the market eventually figures this out, and it will punish a company accordingly through its stock price. And the reverse is also true. You could have a company that's shrinking its capital base, its revenues might actually be declining, and you think it's a dying company, but they're actually increasing the returns on invested capital. They might be divesting business lines that don't make sense anymore, are low return, they take up way too much capital, and the market rewards them as well. So you might be wondering, what does a typical company look like? So here's the 5-year average return on invested capital for the S&P 500. Most of them, as you can see, are in that left tail. They're all bunched around 0 to 5, 5 to 10, 10 to 15%. Pretty moderate to mediocre returns. And mind you, this is for the S&P 500, the cream of the crop. And there's, of course, a few way out on the tail, companies that you probably would surely recognize that have outstanding returns. The other interesting thing about this is there's a debate in the investment community of how to handle excess cash. Michael Malbus and others say you should strip it out, don't include it. Why? Because you're trying to get at a measure of how economically efficient a company is. How does it compare to its peers? So if you're trying to do that, I would agree with it. However, I'm in the other side of the camp, where I think you should include it if you're trying to evaluate how good management is allocating capital. Cash is something that management has the discretion to allocate, and one of their #1 jobs is to be a capital allocator. So we should include it, and this is becoming a big deal. As you can see, S&P 500 companies, cash as a percent of revenues, from the early 90s, it's gone from 10 all the way up to 35% today. You can see we came down a little bit from the COVID era where they were hoarding a lot of cash. And this even goes back earlier to the 70s and 80s. The two biggest drivers to this, better inventory management, so think of like just-in-time inventory, a more globalized world. And the other one is just the digital nature that all of these companies live in today. You can now run a multi-trillion-dollar company with very little capital. It's code, it's software, it's servers, it's not heavy equipment, railroads, industry, that sort of thing. So those are the two big trends there. And to give you an idea of how big of a difference this makes in a company's returns, if you take Microsoft, just as an example, at one point, they were earning 49% return on invested capital. That is extremely high, as you saw with that histogram. That tells you how good of a business that is. Incredibly high margins, incredibly capital light, efficient, and lean. If, though, you add in their excess cash, that 49% goes down to 29%. So that tells you how much of a drag this extra capital, this extra cash, is on their returns. That's just sitting there, not earning as much as their cost of capital. So here's my last slide and my question to companies today. Is your company generating shareholder value? Here's a summary of that histogram you saw for the S&P 500. The average S&P 500 company returns about 12% on their capital. The median's a little lower, around 11%, but they still have a positive spread. They are above their cost of capital, around 8%. If you zoom out and you cast a wider net, the Russell 3000, the median Russell 3000 company is only earning mid to high single-digit return on invested capital. The average is much lower. That tells you how much is being driven by these outliers. And of course, they have a negative spread. They're not earning their cost of capital. They are, on average, destroying shareholder value. And then you compare this to Bitcoin. Average annual return last 5 years, 65%. So the question to companies out there is, number one, What's your return on invested capital? Have you calculated it? How does that compare to your cost of capital? Are you generating shareholder value? Do you have extra cash? And if so, what are you doing with that extra cash? And then the ultimate question is, what's your current opportunity set? What are the investment ideas and opportunities that are in front of you? And do you think or do you believe the return on those ideas or opportunities will exceed the opportunity cost of Bitcoin? Thank you.
Thank you so much, Chris. Has anyone seen the viral ad from Coinbase? The shipping container? Pretty cool, right? They're coming out with some really great marketing videos. Well, our next speaker is from Coinbase. I'm pleased to introduce Rick Schoenberg. He is the CEO of Coinbase Custody, bringing over 3 decades of experience in electronic trading and leadership roles at Goldman Sachs, State Street, and LCH. Appointed in late 2023, he is steering Coinbase Custody's institutional strategy amid the growing demand for secure digital asset storage solutions, particularly in anticipation of spot Bitcoin ETF approvals, which were already approved. So, welcome, Rick. Thank you.
Hello, and thank you again. My name is Rick Schoenberg, and I help lead custody at Coinbase. Unlike our ads, my presentation is not going to be all that exciting. We do custody, and custody is meant to be secure and not exciting. So jumping into that, the presentation here about fortifying your security around the assets that you store at your custodian, I want to talk about how we custody things today, how we're going to be custodying assets in the future, and how that's important to the world of digitized finance as this market evolves and changes. So let's just get into the challenge at the very beginning here. To start with, if we go back to the end of the last calendar year, Coinbase Custody, our qualified custodian, held over $200 billion in client assets. And that's just within our QC custodian. Our Inc. business held another very large sum of client assets. Now, when you think about $200 billion in assets, that's a lot. But we hear a lot of talk about banks and others that have assets measured in trillions. But I challenge you there. When you give a bank $1,000, does it secure those assets? Does it hold them in a vault, in a teller? They don't. All their efficiency ratios dictate that they get those assets out of their hands as quickly as possible. They deploy them, they loan them out, they give them to the Fed or the Treasury or to a clearing corp, and they don't really secure them. And I think that's an important point that we will get back to as we go through this presentation. But here at Coinbase, those hundreds of billions of dollars in assets, we secure each and every one of them. And that's what makes us different. So trust is our brand, it's core to our mission, and that brings me to security. And security, therefore, is absolutely existential to what we do. So to this quote here from Brian, which I like, various people at Coinbase, they get up in the morning, they look in the mirror, and maybe some of them might see a top 30 bank looking back at them. Others will see a top 10 broker. At Coinbase Custody, we see one thing and one thing only, and we see it always. We want and we are the world's leading and preeminent digital asset custodian, which brings me to the challenge of security. So security is at the core of what we do, as I said, and at its core, security is about a trade-off between usability and security. So going back in time, we created these funky terms like cold and frozen or hot. And just briefly here for everyone, the idea of a hot security or an asset that's kept in hot, the keys there are encrypted in a server, in memory, in one location. When it comes to security, having them in one location is not optimal. When it comes to usability, it gets good marks. And that's where hot is on that efficient frontier. And at the other end, you had cold or you had frozen. And that usually means those keys are kept offline, usually in a physical medium, requiring humans to access. And from a security perspective, accepting the fact that humans are involved, that's pretty good, and it's better. But from a usability perspective, that clearly suffers. But that's that efficient frontier. And the question is, how do we achieve progress, and what does progress look like? So you'd think that, oh, well, why don't we just add usability? But that's not good enough. We've all read the press. We all know what's going on. it's a pretty dangerous world out there. So just achieving security parity as time goes on is falling behind. So the question is, how do we achieve progress, and how do we do that here at Coinbase? Here, for me at Coinbase. So we have launched a platform called Core KMS, or Core Key Management System. Not a very clever name, but it's our 6th generation key management system, and it aims to achieve, and we would argue it does achieve, this exact trade-off of usability versus security by increasing both usability and security at the same time. So how exactly do we do that? So I'll dig in for a moment and I'll bore some people, and for others, maybe this will be a bit new, but there's a concept which is heavily used in cryptography called multi-party computation. So just reading the slide briefly, this allows multiple parties to jointly calculate a function while keeping their inputs private. I borrowed that from one of my PhDs. He dumbed it down for me. But what that lets us do, sort of just conceptually, is if today you go into a bank, you access your vault that you have there, your safety deposit box, you have one key, the bank has one key, you turn them at the same time, you access your assets. In the land of multi-party computation, what that means is instead of just having 2 keys, you can have 10 keys, and you could define a flexible quorum such that any 8 of 10 keys are necessary to sign a transaction or to access assets. So what you can then do is you could then send those 10 keys to 10 different locations on the planet, secure them differently, and then have any 8 or 10 of them asynchronously access or sign a transaction and effectively give you access to those assets. And what that does is it makes sure that there's no one single point of failure or compromise. So if you think back to that asset of the hot storage being in one place, even protected, this lets you have them in 10 places protected. So this gives you an unrivaled level of security. Now, one thing that's interesting to note about MPC, sounds great, sounds bulletproof, but not all MPCs are created equal. So there are a lot of devils and a lot of details, and I'm not going to belabor it, but it's just a point to keep in mind. So as we go forward, MPC is amazing, but MPC is just one part, just one layer in a multi-layered approach to security. So in addition to having secure keys at the core, we have something that I like to call a multi-party consensus, or these policy engines at the edge of our network, protecting things and protecting transactions before they get initiated. So what we do is we have these policies that we work with clients to help define. So this is one thing that makes Core KMS unique and our processing unique, is that the client gets to determine their own trade-off between usability and security. And just to bring it home and to give a real-world example, it may be that for one client, if they want to do just a small transaction, they may have one pool of people that can initiate that transaction, and say 1 of 5 partners at that firm that have to approve it, any 1 of 5. But for larger transactions, they have a different set of people that can initiate, and maybe they require 3 of 5 to sign that transaction before it even moves off to the part in the process where the keys are involved. And what that lets clients do, it adds an extra layer of security around that transaction before it even gets initiated. So this is protection at point of use. Again, multi-layered security. So bringing this all together, what does this mean and how does this work, and sort of how does Coinbase do custody and achieve security? For starters, we start off with best-in-class multi-party computation. As I said, there's a lot of ways to do it. There are some ways that are better than others, and it's something that we have invested years and years in perfecting, which is an interesting point when I get to a second, as how we've open sourced it. What we have next is we have data centers that also, for the cryptographic keys, and these data centers are distributed globally, they are secure, and they are secret. We don't take clients there, we don't take senior execs there. I've never been there. In fact, I don't even know where they all are. And at those data centers, we have best-in-class military-grade hardware isolating those networks and ensuring their security. We then have AI agents scrubbing our network and scrubbing our systems. And then we also have a group of anonymous Coinbase employees that are globally distributed, adding an extra layer of distributed security. And then we have security personnel. We have over 250 security engineers on our team, and I believe that's the biggest security team in the digital asset business. I know it's bigger than a lot of startups in its entirety, and they're obviously key to our success. And then at the end here, as I mentioned previously, we have the customer's involvement, your involvement for defining how exactly you want to live on that efficient frontier. So now that we have that sort of mental model, putting together all the components, how do we ensure that we have our A game going 24/7? In this time of sort of trust but verify, how do we do this? Starting with audits and pen tests. Coinbase was one of the first digital asset custodians to receive their SOC 1 Type 1 and SOC 2 Type 2 certifications audited by Deloitte. Everyone knows Coinbase is a very strong proponent of regulation. And in the case of Coinbase custody, we've done the same. We've chosen a strong regulator in the New York Department of Financial Services. They are the same regulator that regulates some of the largest TradFi custodians and banks. And they also do their own periodic audits. In true cloak and dagger style, we have a team of hackers internally, our red team, that is constantly reading up on third-party exploits, testing them on our internal systems, making sure that we have eternal vigilance and that our systems are always secure. And we do also use third-party pen testers to test various subcomponents of our system as well. On the insurance front, we have one of the largest and one of the oldest cyber insurance policies out there. And then lastly, as I alluded to, a little while ago, our PhD cryptographers came to me and said, we want to open source this marvelous IP that we've been working on the last 4 years. And I said, no, that's crazy. We want to protect our IP. That's what we build IP for. And they said, yes, that's cute, and that may be optimizing sort of commercially in the moment the protection of our intellectual property. But if your heart is in protecting and optimizing the protection of the underlying client assets, then you should subject our math to public scrutiny. So that's hard to fight that argument. So they won. So we have actually gone ahead and we've open sourced the core mathematical libraries. They're on GitHub. We have bug bounties. And it's literally, we've sort of given away some of the keys to the kingdom, pun there, to help ensure the security of client assets. So putting this all together and sort of thinking ahead to the future of finance, how is this all relevant? And just sort of two last slides to go through things here quickly. One, I would argue, and I'm biased, but I'll still make the argument, that custody is the core of this future of finance. As I alluded to originally, banks don't really secure assets. They're intermediaries, they transmit them, they transform them, but they aren't really in the safekeeping business. So if you think about today, you're all contemplating put Bitcoin on your balance sheet, as you should. Are you going to do that at your bank? You're thinking about maybe paying your employees in Bitcoin or paying them in USDC. That's great, but that's not a banking service. So this is where the custodian fits in, and picking a custodian that is trusted, extensible, reliable, secure is so important. And so again, just as that paradigm shifts, and this is one way in which the future of finance and the digitized world is very, very different to TradFi, is that in some ways, your new partner really isn't your bank, it's your custodian. And a custodian does a lot more than custody, but just to sort of paint that picture. And on one last slide, I'll try and bring that point home. This future of finance is something that we at Coinbase believe in heavily, obviously a firm founded over 10 years ago, being very crypto native. But we've been investing in that efficient frontier of security and usability for all that time, but especially over the last 4 years, investing heavily in this platform we've called Core KMS. So what do we believe the future of finance looks like? Well, if you're a corporation today thinking about putting assets on your balance sheet, or as the prior presenter showed, a lot of asset managers are moving into the space of digitized assets, one thing is clear. The world is going to become far more tokenized, and those tokens will live on chain. So as that happens, you'll need a banking partner. There I go, too many years in TradFi. You'll need a custodian, a digital asset partner, there with you, delivering security, extensibility, compliance, and that framework. We've all seen the run-up in stablecoins and that usage. We see that continuing. I think that's tremendous. But in that world of stablecoin usage, finance goes from being whatever banker hours used to be to 9 to 5, to you're in the FX markets, it's 24 by 5.5, to truly being 24 by 7 in crypto. Again, you need someone on that efficient frontier with usability, security, and speed. And lastly, this topic of embedded finance. I'm not sure how many in the audience were here last year in Las Vegas when Michael spoke to the idea of AI agents sort of working for their carbon-based creators, transacting in Bitcoin and living in a world where Bitcoin is the medium of exchange. But that world is here. All the tools you need, all the infrastructure you need to achieve that, we have live today at Coinbase Custody. We have APIs, we have the speed, we have the extensibility, so all that world is basically here, and it's at your fingertips today, and we're ready to embrace it. So just to bring this home and going back to security and our mission, what we're trying to do is, we're here, obviously, Coinbase, fully committed to the future of a digitized financial system. What we're trying to do, and again, where my mindset is, and what I would probably argue is somewhat mundane to some, but for us is very exciting, is how do we push out that efficient frontier on that first chart? How do we improve both usability and security at the same time? And that's really our mission, to push that curve out. That'll help and underlie the future of finance, and it'll also help bring economic freedom to the world. Thank you all very much.
Our next speaker is Boaz Avital. He is the head of product and a founding member of Anchorage Digital. Anchorage, by the way, happens to be the only federally chartered bank in digital assets. Boaz leads the development of secure, institutional-grade custody and infrastructure solutions. And prior to Anchorage, he was a senior engineer at Twitter, focusing on large-scale, mission-critical systems. Welcome, Boaz.
Hey everyone. You're going to be experts on crypto security by the end of the day, it looks like. My name is Boaz Avital. I am the head of product at Anchorage. Anchorage Digital is one of the oldest and largest digital asset custodians. And what you're going to continue to learn today is that when you talk about digital assets, custody isn't just custody the way you might be used to it in the traditional world. Traditional custody is largely a safekeeping and bookkeeping activity. And when we started Anchorage many years ago, and we talked to traditional managers and companies looking to get into Bitcoin, we talked to them about, hey, what are you thinking about custody for your digital assets? And they were very surprised that we were bringing it up, because in the traditional world, custody has been a problem that has been solved for like 30 years. No one's thinking about it, and we were getting a lot of puzzled faces. But as you already know today, digital asset custody is completely different. It's not just a bookkeeping activity, it is a cybersecurity problem. And with digital asset keys comes a new and broad attack surface, but also comes a bunch more opportunities for more frequent and more verifiable trust-building audits, and enabling programmable money to do what it's supposed to be good at, which is interacting on-chain. So let's break down and start from sort of the beginning, for those of you who are less familiar, about what is different about digital asset custody, and then build up to what you're going to see and what Anchorage provides to make that safe and usable for you. On one side of the screen, you see $1 billion in gold, and on the other side, $1 billion in Bitcoin. Though I, of course, don't recommend you keep your Bitcoin on a USB drive. Already, you're beginning to see that things have to operate differently here. But it's actually even worse than what this looks like, because you can't copy a bar of gold. A counterfeit is never going to be the real thing. But you can copy a USB drive, and then that copy has all the same rights and privileges to that Bitcoin as the original. So you know, and you've already built an understanding, I believe, that where your Bitcoin sits at rest is critically important to the safety of your treasury and your assets. But what most people make the mistake of is thinking that that's where digital asset security stops. In reality, crypto has one other big differentiating feature, which is that unlike physical gold, most of the time, crypto always physically settles, which means you always need to have access to those assets when you want to use them, interact with them, trade them, pay with them, whatever it is that you want to do. And so When you're moving gold, that's a very straightforward but difficult thing to do. You need more trucks, you need more gas, you need more people to load those trucks as you scale up the amount of assets that you move. But when you're moving Bitcoin, moving $1 looks exactly the same as moving $1 billion. Moving your assets across the street to your neighbor look exactly the same as moving them across the world. And so now, for the first time in the history of the financial system, we have an incredibly important focus on how you authorize the movement of funds. And when we started Anchorage, this was one of the most important things that we focused on. How do we authorize the movement of funds so that at every step in the process where risk is introduced, we reduce that risk? And it's not just risk of attack or risk of a malicious actor. It's risk of mistake in human processes. And of course, when you execute on that risk, it's also completely different. Because if somebody is coming in and moving those funds and taking advantage of your risk, they need to physically be there if it's gold. But if it's crypto, they can execute on that risk from somewhere in the comfort of their office chair across the other side of the world, although most often it's going to be North Korea. So, is this just theoretical or has this actually happened? Of course, we know that billions of dollars in Bitcoin and other crypto assets have been compromised in all kinds of ways. But most often, the way that they are compromised is by fooling the company or the crypto system that supports them to move assets in a way that were not originally intended. That's why when you're choosing a custodian, you are choosing someone who is not just a good financial institution for you to partner with, but who you believe is a good digital asset security company, who is great at the technical security that needs to happen, and who is ideally built up with a DNA of security from day one. So what options exist when you talk to these custody companies, both for storing your assets and for moving them? Let's go over them quickly and create a foundation. First, there's this concept of hot wallets and hot storage. And you guys have interacted with these, of course, when you go to an exchange and you log in and you deposit some assets, those are going into hot wallets. These are basically servers on the internet. They're as safe as any other website that you can log into. And I think we're all in agreement that it's not a good place for you to keep $1 billion. What you'll normally be confronted with when you go to a regulated custodian is something called cold storage, or legacy cold storage. This is essentially a way for companies to go into a secret room, create crypto keys, distribute them, break them up, lock them up into a bunch of different vaults, ideally touch them as little as possible, but when they do want to touch them and move them, because that's necessary in this space, they have to go and do a very heavy and manual process of collecting not just your authorization, usually by calling you up and talking to you and scheduling a time to do that withdrawal, but then going and collecting a bunch of people, going and collecting those keys, coming back and reassembling them, executing that transaction, and moving it on chain. A very heavy and very slow process. What's good about cold storage, especially that those keys are offline, is that when those assets are at rest, they're much safer. But it introduces a lot of new risks. Risks in the movement of manual funds from that custodian onto the chain. A human being going and following a checklist is going to make mistakes sometimes, and that is a risk that we have to take. You guys have your own operational teams and you've seen it. And as this industry scales and custodians are making more and more transactions, that risk goes up, that pressure goes up, and new kinds of operations have to happen that add more complexity into the system. These are the kinds of risks that we need to think about when we're building a true system for the modern financial age. Last thing I'll talk about very quickly is MPC, a thing you've certainly, of course, heard of. MPC is made a big rise in the last few years. It is a very complicated topic. Essentially, it's some complex math that allows one transaction to be signed at the same time in multiple different places in order for it to happen. It's like, think about taking that USB and splitting it up into 3 different ones, and they all need to be used at once. MPC is a great tool. Where most people fall short is that they hear that term, multi-party computation, and they say, okay, that box is checked. But MPC is just a tool. There are many kinds of ways to use MPC. You can have hot MPC, you can have cold MPC, you can store the keys 2 ways, 10 ways. You can give some of the keys to you as a customer, and then you have a question about whether you're in real custody or self-custody. So it's a tool that means that when someone says we use MPC, you need to ask them more questions and figure out what's going on next. There's a lot of different options, and you guys don't want to be professionals in security. What do you need from an institutional custodian? You need someone who is built on security and safety from day one, not just in the way they create those keys and the way they store those keys, but the way they execute those transactions so you feel safe. You need a custodian that gives you usability so you can actually use those funds when you need to, and you are not introducing risk in that process. And you, of course, need a qualified, well-regulated, well-audited custodian that has a proven track record in the industry. I'm going to talk to you a little bit about Anchorage and what we do. Anchorage Digital was founded in 2017. We are one of the oldest digital asset custodians, focused solely on institutions. And we were founded by security engineers with 2 main purposes. The first is to provide the best technical security and safety that is available in this market, because we saw that this hot-cold dichotomy was not working. And the second is to be the best regulated digital asset custodian on Earth with the best possible regulatory framework so that your companies can feel comfortable investing in digital assets. By building up that basis, we now serve some of the largest and most demanding institutions in crypto in the digital asset world. And we are proud to have a very high standard that we maintain not just for them, but for all of our customers. So let's talk about that technical side. What is it that Anchorage does that's a little bit different that helps solve these problems that I talked about? At Anchorage, we have 3 main pillars of our security system. The first is end-to-end security that goes from hardware in your hands as a customer to cryptographically authorize a transaction, all the way to hardware in this form of HSMs, hardware security modules, in our secure data centers around the world that know who you are, know your own keys that you hold in your hand, and only use those keys as authorization for a transaction to happen. That means end-to-end, it is impossible to tamper with the transaction that goes through Anchorage. At no point is there human judgment or the risk of a fat finger or anything along those lines when you comes to the operations of digital asset movements in Anchorage custody. The second is a really important one, hardware-enforced policies. We believed, and this is all from day one, that the policies that you follow in order to move your Bitcoin need to be just as secure as the storage of the digital asset crypto keys themselves. And so rather than separating out our policy system somewhere else and then having that policy system under a different security model tell our custody system what it can and can't sign, we have combined our policies and our digital asset custody into one hardware enclosure, one HSM that knows who you are, knows your policies, and evaluates those policies against every single transaction. Integrating policy and digital asset custody allows us to be the safest custodian. And finally, wherever it makes sense, we have humans in the loop. Not just your coworkers who go and authorize transactions with verified biometrics in multiple ways to make sure that we know that you are who you say you are when you are authorizing a transaction on demand, but also humans on the Anchorage side with dedicated and expert risk reviewers who know you and know your company and can do another layer of review to say, hey, is this a transaction that your team actually wants to do, or is something strange going on here, and should we reach out to you? That level of support is critically important when you're working with institutions. This technology might have had some translation errors on the slides. This technology sets us apart in a few ways. One important way that this sets us apart is it lets us have the best security without compromising on access to your funds. You are able to do most transactions with all redundant security in less than 20 minutes on the Anchorage platform. At the same time, we allow you to do all kinds of interactions that are important and always have the safety of 24/7 support. The second part that's important is, of course, regulation. You have a responsibility to your board and to your shareholders to use the best regulated custodian. You don't want to think about, is this a state trust? Is this a money services business? Is this technology? Anchorage, in 2021, to solve this problem, became the first and only nationally chartered bank in digital assets. We hold a federal charter. We're regulated by the OCC at the same level as all of the other national banks that you work with. And that provides a level of comfort not just in our oversight, but also in our bankruptcy protections. We have federally mandated laws around bankruptcy remoteness in national trust banks, and that's a thing that you can take as comfort that your company's Bitcoin is always yours. And of course, this is all part of a larger and full offering. That includes trading, that includes settlement, that includes connecting you with institutions for liquidity and lending, all of the things that your company needs in order to actually operate a Bitcoin treasury, layered on top of comprehensive reporting, on-demand audits, all the things that are important for a public company with 24/7 white glove service. Going into the future with these digital assets is important. We're a $3 trillion asset class with companies like yours investing in Bitcoin treasuries, with new crypto savings and ETFs coming in to advance and further push that Bitcoin, and with new use cases around payments, around tokenization, around securing new networks and innovation. That's why I'm very happy to announce that last week, Anchorage launched staking with Bitcoin, starting with the Babylon network, to help Bitcoin secure innovation in the ecosystem and create new ways to get rewards. And we're going to have a lot more Bitcoin ecosystem opportunities soon. So please reach out to us. Happy to talk to you and help your companies out.
There's only one speaker standing between you and lunch, and I know you're going to be very excited to hear who it is. I am honored to introduce Phong Lee, the CEO and President of Strategy, who has done an exceptional job filling the shoes of Michael Saylor as CEO. It's no easy task, but Phong has taken the reins and brilliantly steered the company through its explosive growth. So please give a warm round of applause for Phong Lee.
Who's excited to talk about KPIs? I actually am. Let me poll the audience and ask a few questions so I can understand how to calibrate this presentation. Who is one of the 150,000 people that listened to our earnings call last Thursday? That's like almost all of you. Thank you. Second, who's actually taken a class in corporate finance in their entire life? All right, that's pretty good. It's like half of you. All right. And third, you guys are like knocking fists. Yeah, we took a corporate finance class. Third, who actually has a background in finance? Like, you worked in the finance industry. All right, not bad. Still got it. The Morgan Stanley guys did. Okay, this is my first time attempting to teach the new world of corporate finance or the old world of corporate finance, so it'll be a little bit fun for me. The only class I think I've ever really taught in my life was Fortran, which is a lot different than this. But let me just start with, we need a new BTC standard. And you guys are like, we have a Bitcoin standard, right? BTC stands for Bitcoin Treasury Company. We need a new standard. And I think you all agree with that. And I'll show you a few things that you're quite aware of. This is a chart of Strategy's EPS, diluted earnings per share, every quarter since we began the Bitcoin standard. And on top of that chart is our market capitalization. right? And when I had the team put the chart together, they're like, they had like that little thing on the negative $94 where it went off the chart. And I said, no, just show the whole thing. And it screws up the scale. But clearly, diluted earnings per share has zero correlation to the valuation of their company. And what happens is people will literally take some sort of a bot. I don't think they're writing this stuff. I can't imagine someone's really writing this stuff. There's like some AI bot that right after we release our earnings at 4 p.m. on a Thursday, an article comes out 5 minutes later that says, MicroStrategy loss widens as revenue falls, crypto holdings struggle. Terrible news. We had an awful Q1. Wall Street Journal, right? Bloomberg did a little bit better. Strategy doubles Bitcoin buying capital plan to $84 billion. And then you look at the actual article, and it says they posted a record first quarter loss that resulted from the adoption of an accounting change, which we advocated for, that requires valuing their firm's massive Bitcoin holdings at market prices. Not inaccurate, because they're using traditional corporate finance. I took my first corporate finance class in 2003 at MIT, and I was taught by Stuart Myers. Anyone know Stuart Myers? He wrote the book on corporate finance in 1988. And so I went back and I looked at the book and I said, okay, what were the contents? And for all of you, I broke it down. There are 3 major areas, something like 18 chapters: valuation and options, capital deployment and structure, and corporate governance. 1988. I think there's on something like the 11th edition, no mention of Bitcoin. These are the summary topics in that book. And as you go through each of these, bonds, secure debt, asset-backed loans, stocks, equities, volatility, the options market, investments, NPV, which I'll talk about a little bit, capital deployment, right? That's actually meant to be DCF, discount rates, debt financing, equity financing, and go on and on. Investor relations, 8Ks, 10Qs, regulatory affairs, securities, commodity, every single topic in here affects or is affected by Bitcoin. Not one topic needs to be ignored. Every single topic in corporate finance today needs to be rewritten. And so for Bitcoin treasury companies to work, we need to educate the world as to what are the KPIs and what are the metrics. And that's the framework that we really put out last Thursday, and one that I'm going to talk about today, right? And I'll put this into sort of 3 broad categories. BTC KPIs. This one, a lot of you are fairly familiar with. Bitcoin yield, BTC yield, BTC gain, BTC dollar gain, right? As potentially a reasonable substitution for something like diluted earnings per share. The second topic is newer, we introduced last Thursday, is BTC valuation. Think about this as any valuation you might do, right? You might say, hey, I'm going to buy that piece of property, buy some software, make an acquisition, capital allocation. You need to do a valuation. A lot of you do discounted cash flows, right? Perhaps we want to issue an asset-backed security, or Bitcoin-backed security. We need to do a valuation. And the third category is BTC credit, right? And you've heard us talk fairly passionately about the fact that the credit markets today don't value BTC, don't value Bitcoin, and so we need to create a model for that. So think of that as sort of the 3 sort of pillars of the framework that need to be created for the world of corporate finance to work correctly on a go-forward basis, right? So first, let's talk about the BTC standard KPIs, right? BTC yield, BTC gain, BTC dollar gain. And the easiest way to think about this, as I mentioned, is an analogy to diluted earnings per share. What earnings are you providing? What income are you providing to your end shareholder without dilution? And we created some BTC standard metrics, right, that go along with those KPIs. BTC NAV, MNAV. We didn't create MNAV. One of you out there created MNAV, put it on X, and we're like, we like that one. So we started using MNAV, BTC premium, capital spread, and parity. And so what do we do? Let's first talk about why are these KPIs, why are they important? Ultimately, it would be nice if they became GAAP, metrics. It'd be nice if it was something that we could report on our earnings statement as we file our quarterly filings, it might be nice as something that you all be able to do too, right? Because if they're considered GAAP metrics, then we can stick them to our earnings report, right? And then Wall Street Journal can get some AI to write some article 5 minutes later that said MicroStrategy created 15% BTC yield achieved 13.7% BTC yield in the first quarter of 2025, and they're basically at 90% of what they had targeted. That would be a much more accurate representation of the progress of the company. Or even better, even juicier, they created $5.8 billion in BTC dollar gain, right? And that could be a net income number, for as an example, right? That would be much more realistic and much more true about the performance of the company. And what we would encourage is for BTC companies out there, do that. On a quarterly basis, state what your BTC yield is, what your BTC dollar gain is, et cetera, et cetera. And perhaps you might want to actually give guidance, right? We can't use the word guidance today. We use the word target because the word guidance means that we're talking about a GAAP metric. We're talking about a KPI, which is why we say target. And we updated our target at the end of each quarter. I encourage you, as you get more mature as a BTC company, to do something similar. And you could also use this to compare performance of different products. All right, so imagine if you were a company that had multiple product lines. Right, you're a technology company that sold both software and hardware. You could then say which segment of your business is doing well, which isn't. Right? We offer Bitcoin-backed securities, right? MSTR, convertible notes, Strife, and it allows you to have the relative performance at a point-in-time comparison of our different products, if you will. Right? And let's go a step further, and I talked about this yesterday, and you hear us talk about this passionately. What's great about having these KPIs is we can start to provide them and report on them, not just quarterly, but imagine if you were to do it more frequently than that. In our case, we created a site. You might want to do so too, right? And I know there are other folks who have created sites that aggregate some of these KPIs, which I think is awesome. And we update ours every 15 seconds. The difference between updating something every 15 seconds versus every 90 days is 500,000x more transparency to our shareholders. And that's why this is important. Of course, you've never really had an opportunity in the past to make an investment in a project that literally 15 seconds later, you can let everyone know what the return on that investment was, right? You buy a property, you buy a piece of software, and that return on investment that you're getting might take 5 years, it might take 3 years, it might take 1 year to prove. Here you can prove it right away. And that's the power of BTC as a treasury standard. We also decide every week to publish an 8K with our acquisitions, and associated with those acquisitions, we provide the BTC yield and the BTC gain, right? And some folks are like, well, why don't you provide it more often? Because we don't want to. Because it'll give you probably a little bit more insight than we want on sort of what our activities are in terms of ATM issuance, more insight in sort of how we buy our Bitcoin, right? But we think weekly is pretty good, right? We debated, should it be every 2 weeks, should it be every week? And maybe for your company, if you're not purchasing as often, it's when you make acquisitions, right? But that makes sense. Update your KPIs, on whatever frequency makes sense for your company, right? So now let's talk about BTC valuation. And this is where I'm going to go a little bit deeper here and talk about how we value our different offerings and our different instruments. And also I want to talk about how we think about issuing equity and the dilution impacts of that versus issuing bonds and the less dilutive impacts of that, right? So first, valuations in general can help you make a capital allocation decision. It's very simple, right? Like if you sit at home and you decide, hey, I'm going to buy a house, or I'm going to buy a Lamborghini, or I'm going to buy Bitcoin, you do a valuation. And hopefully all you in here decide, I'm going to buy Bitcoin, right? Or even better yet, take your house, get a mortgage, buy Bitcoin. These are all decisions you're making based off of a valuation, and some of you just do it in your head. Some of you create a spreadsheet and you say, well, that house is going to appreciate, that Lamborghini is going to depreciate, and the Bitcoin's going to go like this. It's an obvious, maybe you look it out 10, 15, 20 years. It's the same thing we do. We decide whether to issue equity or a convertible note or a preferred note or whatever else we might do. We run a spreadsheet valuation exercise. Right? And some of it we do in our heads, some we put on a spreadsheet. We want to share with you how to think about that. And to do so, you can't just use BTC yield, BTC gain, BTC dollar gain. You have to use valuation metrics. And as you know, the traditional valuation metrics don't work, which is why we created some new ones. BTC dollar income, BTC value, and BTC torque. So let's think about this a little bit. And I think the numbers are a little bit wonky on this slide, but we can sort of work with this. First thing, what happens if we issue $100 million of equity, right? What happens if strategy issues $100 million of equity? Well, of course, like any valuation model, you first have to take some assumptions, right? And in a traditional valuation, you might make an assumption of, okay, I am going to create a new product. It's going to generate a certain amount of income over time. It's going to generate a certain amount of profits over time. Revenue minus cost profits, right? Same concept that you might want to do with BTC, right? So that's the first thing you want to think about. And we start with BTC dollar gain, right? And so you want to think about what is the appreciation on BTC? What is the BTC ARR, right? In this case, we said, let's take 30%. Now, somebody might say, wow, you guys are crazy, 30% is really, really low. You should be going with 50%. Right? That's just an input assumption, just like if you're creating a model, I'm going to sell a product, and I think I'm going to be able to sell this much or this much or this much. You might create a sensitivity on some of the analysis, or this is the profits, create a sensitivity. Okay, so you plug in whether you think it's 30% or 50% or 10%. Right? So that's one pretty important assumption. Right? The other input is what is the MNAV? Right? What is the premium to net asset value that the company currently has when it issues stock? We just went with 2x in this case. And as you know, if you issue $100 million of equity, if we issue $100 million of equity and an MNAV of 2x, that basically means there's $15 million of equity dilution to our shareholders and $50 million of BTC gain. Right? That's where you hear Mike saying, I sell a dollar for $2. That's what essentially we're saying we're doing for our shareholders. We're taking a dollar, we're producing $2 because we're priced currently of an MNAV of 2. And so you can imagine if the MNAV is higher, you're getting more BTC dollar gain, right? And so in year 0, what do we get? We get $50 million of BTC dollar gain. And then we have the $50 million of base Bitcoin that we're also buying, but that's dilutive, $50 million that's non-dilutive. This is such a simple concept, but when people talk about the dilution effect of what we're doing, it's not the $100 million, it's $50 million. And it's not a leap of faith, it's not a bad assumption, it's not funny math, it's just the truth. Finance guys, you agree with me? All right, so you have to start with that, okay? I'm glad you didn't say no. All right, so then any appreciation on the dilutive effect, that bottom white bar, right, is dilutive to the company, dilutive to the shareholders. Still good, because you're getting 30% appreciation on it, if that's your assumption, and you create $690 million in year 10, based on the 30% increase, right? The next piece is the $50 million BTC gain, which is static over the course of 10 years. And the final part, the yellow bar, is the income we make on top of that. The 30% appreciation is the money we're making as a company, right? It's the profits that we're taking. And so that's the BTC income, and that's the yellow bar. If you add the income and the gain, right, the 639 plus the 50 million, now you have what we call BTC value. Okay, the math is actually relatively simple, but it's good to sort of show how this plays out. Now, what's BTC torque? Right, think of maybe a return on an invested capital, perhaps, right? And that's 6.9x, right? So what are we taking there? We're taking the BTC dollar value, the $689 million that that over 10 years we created that is non-dilutive to our shareholders. And we divide it by the $100 million of investment. 6.9x, right? Which is pretty extraordinary that over 10 years, we can provide 6.9x of torque value to a $100 million investment, right? Generally speaking, if someone says, I'm going to give you $100 million and you can invest it, in 9 years, you can return 6.9x on that. 6.9x return on invested capital. That's pretty darn good. You should be happy with that. So that's it. That's pretty much how this looks, and that's the model. And then we say, okay, somebody help me with the clicker, please. There we go. Then we say, okay, let's take some of our other instruments, right? And what does that look like? Our convertible debt would be the next thing, right? And as you get less and less dilutive, right, a convertible bond at $100 million is inherently less dilutive, right, because we pay a coupon on that. We pay a little bit of interest on it, and so we don't have to convert it to as much equity, and so that's going to be less dilutive, right? Of your $100 million, $36 million of equity dilution, $64 million of BTC gain. Well, that's beautiful. Why wouldn't you do that every day of the week? I'll tell you that later, right? But you get a BTC torque of 8.9x, right? Creating a little bit more value. And so we sat around, and you heard the story. Mike asked the AI, well, how can they get even more BTC torque? Well, you try to do things that are even less dilutive. Strike being the next thing, right? Strike is less dilutive in that the conversion premium is much higher, right? It's further out, and the coupon that we have to pay is there, and that's dilutive because we have to pay for that coupon using our ATM, right? But on $100 million of strike, it's $20 million of gain, right? Or sorry, $20 million of equity dilution and $80 million of gain. And over the course of 10 years, now we're talking about 10.4x. You guys are getting excited now, like 6.9, you're like, that's good. 10.4x BTC torque. And the last thing we did is we issued Strife. And now you're saying, oh my goodness, this BTC gain, dollar gain, is infinite because there is no equity dilution to our shareholders, right? It's a perpetual preferred offering that has zero equity component to it. It's pure debt, right? Over the course of time, we have to pay a coupon on that, and you see that, right, in the white there. But for the most part, it's better, right? It's better from a BTC torque perspective, 12.8, almost twice what you saw by issuing equity at a 2x MNAV. Now, of course, you look at all this and you say to yourself, man, why aren't you guys just doing Strife, Strife, Strife? And are you guys crazy? Why do you even issue any equity whatsoever? I hear that. Some of you on X are saying that. Like, it's like, it makes no sense for folks to issue equity then, right? But of course, it does make sense because to be able to issue debt, right, the folks who value that debt look at our debt to equity, look at our leverage. And so to be able to issue more debt, we have to have more equity available. That's one reason why you can't just look at BTC torque alone by itself, right? Now here's an interesting view, right? It says if you have 1x MNAV, if basically Strategy's valuation, market valuation was $53 million instead of 106 or $53 billion instead of $106 billion, if you had 1x MNAV, then every dollar of equity we issue is dilutive because we're not getting any gain on it. And so you could go a step further and say that at 1x MNAV, it makes even more sense to issue debt, right? In fact, the further to the right we go, Strife, then Strike, then convertible notes, and MicroStrategy, the better it is to issue debt. The lower the MNAV, the better it is to issue debt, right? 2x MNAV, it gets a little bit better. The comparison gets a little bit better. 3x, even better. And so as our MNAV increases, it makes more and more sense to issue equity because the difference in the BTC torque starts to compress, right? And so that's why for us, creating a higher MNAV for all the reasons we talked about last week is important, not just to the equity, but to the debt too, right? I'm gonna skip this multiple stuff. And you see this in a BTC yield curve, right? And what happens in this particular curve is you see that the yield you get on your Bitcoin starts to compress and look more similar at higher levels of MNAV, right? And the next slide does an even better job of showing this, is the BTC spread, that's the percent of capital that we raise that results in BTC gain, starts to compress at higher MNAVs. So you would make an argument that at a 1x MNAV, you really want to issue as much debt as possible. And as it starts to compress, it makes more and more sense to issue more strike, more equity, right? So we're starting to say, okay, number one, right, like on a BTC torque perspective, less dilutive instruments are better. Number two, as MNAV increases, that benefit of less dilutive instruments starts to decrease. And now here's the number three thing, right? Like, what is the BTC hurdle rate? What is the ARR that's required to generate positive income over 10 years? So this starts to tell you the opposite story. Because debt instruments have a coupon, you actually have to pay out every year, where equity we don't. You need a higher ARR on Bitcoin to support those debt instruments, right? So all of a sudden, it's not so obvious that issuing debt is better than equity in a scenario where you think BTC ARR may not go up as much, right? Last piece, two more metrics, BTC break-even price and BTC break-even rate. This is the price at which Bitcoin has to get to for us to generate positive BTC value over 10 years. Think of it another way. I'll say it more simply. This is the price that Bitcoin would have to get to for $100 million of equity issuance to work. And it's pretty extraordinary when you think about it. At 2x MNAV, BTC can be cut essentially in half. It makes sort of sense. Before, that's a bad decision to issue equity. When we get to 5x MNAV, we could withstand BTC going from $95,000 to $19,000 before that's a bad decision. Now you go to the other side, on the debt side, you look at something like Strife. Strife is not dilutive, not at all dependent on Bitcoin price, so it doesn't really matter what BTC price approaches, right? And has to be $95,000. If BTC price, Bitcoin price goes down, all of a sudden, Strife is not such a good instrument, okay? So now I've talked through three things that, if it was a single variable decision, you would all know exactly what we're doing, when we're doing it, and why we're doing it. But there's at least three interesting components here, right? BTC torque, the return on invested capital, favors the less dilutive instruments, right? Debt instruments, right? BTC break-even price and BTC break-even rate favors the more dilutive instruments as MNAV goes up. And the final component to all of this is the more equity we have, the more Bitcoin NAV we have, the better the pricing on our debt, right? Because it lowers our debt, our leverage ratio, our debt to equity ratio, or our debt to Bitcoin ratio. So those are the three sort of things we think about. And now you can't really take that and say, I know exactly what strategy is going to do tomorrow, right? But you can take that and help understand how we think about valuations, right? And I would encourage, right, as some of you are BTC, Bitcoin treasury companies out there, to start to adopt this, just like you adopted the Bitcoin, the BTC KPIs, right? Because I think these valuation frameworks are quite essential in your decision making as you decide what to do next, right? And this doesn't just apply to if you're solely a Bitcoin treasury company and only hold Bitcoin, but if you're a miner and you have to make a decision between whether you buy Bitcoin or you invest in mining equipment, if you're a medical company and you have to make a decision between your next new product or whether you're going to invest in Bitcoin through an ATM or Bitcoin through some debt offering, a convertible note, et cetera. It helps you drive some of these decisions. Okay? You guys still with me? All right. I'm going to skip some of this stuff because it's good, but it's a lot. All right, so let's talk about credit. So we've talked about Bitcoin KPIs, BTC. I keep saying Bitcoin. I mean to say BTC because the Bitcoin Treasury Company. It gets confusing for everybody. It's like strategy versus MicroStrategy. So we talked about BTC KPIs. We talked about BTC valuation. Now let's talk about the credit side of the world. All right, and this is an area that really just needs fixing. All right, you heard our plea last week. We want to access a market that's 2.6 times the equities market, which is the bond market. I met a gentleman in the bathroom earlier today, and he was like, and no, it's not awkward to meet people in the bathroom. I think it's totally fine. He said, hey, nice to meet you. I help manage people's retirement savings. Do you have an instrument for me? And I was like, yes, we have an instrument for you. Right? Like if you have $2 million in retirement savings and you're 70 years old and you want to take $1 million of that and put it in Bitcoin, right? But you never sell your Bitcoin, right? So you have to get earnings and income somehow. My suggestion is you take the other $1 million and put it into some sort of a bond, right? And today, like a bond that provides income, fixed income, right? And so if you have $1 million and you are happy with living off of $100K a year, you can put it into something that earns 10%. Guess what your options are to get a bond that earns 10%? There are very, very, very few, right? Some preferred instruments get you 8, 9%, but they have a duration, right? It can be called in 3, 4, 5 years, right? And they have risks associated with them. Strife is a perpetual preferred bond that gives you access to Bitcoin, if you believe in Bitcoin, and a 10% forever dividend. So you can take that $1 million and earn $100,000 a year and live off of that, and live a okay life, right? That's the market we want to tap, and that's why people are in this market. It looks a lot different than the equity market, and it's huge. By the way, what do people do right now with that? They usually don't buy the preferred bond. They might buy some treasury bill, right? And you know what treasury bills are earning nowadays, and declining. They might buy a corporate bond, right? Or they might, especially if they believe in Bitcoin, buy something like Strike and Strife. And so that's why we're interested in this market. Why the market's broken, right? The reason the market is broken is because, for the most part, bond valuations do not take into account Bitcoin on your balance sheet, right? Like the ability to get a reasonable rate, a reasonable payment from a corporation perspective, like to pay a reasonable coupon, is all based on the valuation and the risk associated with the bond. And so we said, all right, let's start from scratch and say, how would you create a credit analysis using Bitcoin for BTC companies? And the first thing we say is, and this is very normal in sort of a credit analysis world, is what is the likelihood that you will become under-collateralized over a period of time? And we said, for simple starting base, what is the likely you'll be under-collateralized in 1 year? So if you have a $1 million loan, you have $1 million of assets, you're 1-for-1 collateralized. Everyone's happy. It's like anything bad happens, you take your $1 million of assets, you pay off your $1 million loan. That's a good outcome, good scenario. Your risk is reasonable, right? So we said, what is that potential scenario? And we said, okay, let's take our earliest duration, right, notes, and our most senior notes, which are our 2028 converts. And we go and stack them one by one all the way down. 2028 converts, 2029. Our convertibles are more senior than our preferred notes. So you put Strife and Strike below that. And what you start to see as we do this is the first note that's due in 2028. We have $52 billion, $53 billion. Actually, it's higher today. Anyone checking the Bitcoin price today at all? No one? It's higher. So we have more than now $53 billion of Bitcoin on a $1 billion bond. Very simple. The BTC rating is the amount of Bitcoin net asset value we have divided by the $1 billion. Okay? And then we start to stack that in a cumulative order. You see cumulative notional. And we say, as you go down the seniority list, the BTC rating gets lower and lower, all the way to the point of strike, where for a cumulative roughly $10 billion on a $53 billion asset value of Bitcoin, the BTC rating is 5.3x. Okay? So that's sort of step one. Let's think about a way to think about the risk in 1 year of not being able to cover your Bitcoin, right? And that's the BTC rating. And in the BTC risk, we say, what, based on a 50% BTC volatility, and this is just math, and a 0% BTC ARR, what is the actual risk of that happening? What is the actual risk in a 1 year period that we would be under collateralized, right? And the first step is for our 2028s, right? Where what is the risk that the $53 billion becomes $1 billion in a 1 year duration? It's zero. It's not going to happen, right? And you go down and down and down that stack. And now we have a rating, the amount of over-collateralization, and the amount of risk, which is the risk that we will be under-collateralized, right? So those two are fairly easy things to do mathematically. And then we say, what is the credit spread associated with that risk? And the credit spread is important because that's how these instruments get priced by the market. They look at the credit spread. And the credit spread is a more complex piece of math. We do the math between like these two, right? And then we let AI do everything in between. And it calculates what the credit spreads are. And this is why this is important, as you look at this, is the entire dislocation between the calculated credit spread, the price at which we should be pricing these bonds if all else was efficient, and the price we're getting, right? And of course, now you're like, hey, okay, I remember that conversation about the equity ATM. If we issue more equity, the BTC rating gets better as we buy more Bitcoin. The BTC risk goes down, right? The BTC credit goes down, and we pay less on these bonds as we issue more. That's why it's important that we keep building up our equity, right? So folks are like, okay, what about the dilution effect? It's also about what do you get priced, what do you pay for your debt? Those are two very important components. What do we pay for our debt, which is a reason why the equity is important, and are not covered in any of the BTC valuation KPIs. And of course, you look now, if you believe that Bitcoin is going to go up further than 0% per year, 30%, we keep the BTC volatility at 50, then all of a sudden you see the numbers getting even better, right? In this particular case, if you believe that BTC is going to go up 30% a year, which is generally worse than what we've seen historically, right? Then the BTC risk goes down to 1%, right? On our most junior note, which is strike. And the credit on that is 13 basis points compared to a market credit spread of 700 basis points. And so we're paying a 687 basis point premium because corporate finance does not teach people about Bitcoin, and the debt markets don't understand Bitcoin. And so that's why we had a call of action last week that all of you, if you want this market to really work, right, it's not just about the equity, it's about the debt too, and why you all need to go help us teach the markets, the debt markets especially. Remember, $300 trillion debt market, 2.6 times bigger than the equity market, why this matters. And we've tried it. They are a tough nut to crack, the debt markets. These are not folks that want to say, hey, tell me about Bitcoin, right? They don't like talking about, things that have high volatility. They don't like talking about things that have 30, 40, 50% ARR, right? So, sorry, go back here. So that's the 30% ARR scenario. Now, we said, all right, what happens in different ARR scenarios, 0, 10, 20, 30, to the different credit spreads, right? You'll see here, as it makes sense, right? As the ARR assumption gets higher, all of our bonds, all of our notes get less risky, right? Makes sense. And if you take a bigger look at this, you're like, okay, I don't really know, what does a 0% credit spread really mean? Right? What does a 10% credit spread really mean? Or 10 basis point credit spread? What is a 1,000 point credit spread? I'm sure most of you aren't waking up every morning thinking about credit spreads, right? The simplest thing to look at is what's in green here basically means you're investment grade, right? So a BTC risk of less than 1%, right? Less than 1% being under collateralized on your loan means you're investment grade, right? Means that that is something that somebody could go recommend most people invest in, even with your retirement savings, right? And as you get up to this red area, then you get to a place where you're junk grade, 3.8%. I never liked the term junk. I'm sure some really creative, debt person invented it. It's not bad necessarily. It's just your chance of being under collateralized grows. Okay. There's a lot more in here about credit comparisons, but I think you sort of get the point, right? Which is there is a dislocation in the bond market today. It's good that you do your own work, right? Don't let the rating agencies just do the work, right? Understand what a bond is worth. And now we provided a model to do this. Okay. What I'll note here is BTC volatility is going down over time, right? And even though you've heard the term volatility is vitality, in the debt markets, volatility is risk. And as Bitcoin, as an asset class grows from 2 trillion to 3 trillion to 4 trillion, by nature, its volatility will go down over time. As its volatility goes down over time, what you'll find is the investability of the bonds that are backed on Bitcoin will go up over time. And so that's what we show here. Here is a $95,000 Bitcoin price and a 50% volatility. You see that, what is sort of junk grade in that red zone at a 0% ARR is pretty high, right? And as we see over time, as volatility changes, right, which is what you see in these lines here, the likelihood that Bitcoin-based bonds sort of enter into that junk range gets lower and lower. Okay. The last thing I'll talk through, and I'll try to summarize this, is these three things work together, right? Like in sort of all of corporate finance, right? You need to understand your point-in-time KPIs, right? Valuations and decisions to make investments, and valuations and decisions to take on debt, right? True in personal finance, right? How much money did you make this year? What are you going to buy next year? And what are you going to borrow, right? As it is in corporate finance. We're going to, over the course of the next few months, publish a BTC standard model. Like we did last year, we published a Bitcoin model in 2024. We're going to publish a model and open source it and share it on GitHub and other places so that you all, if you're interested in understanding how strategy thinks about our investment decisions, you can start to build your own strategy models. But more importantly, as other companies adopt a BTC standard, they can start to have models and tools too. And we are extremely appreciative and understand the responsibility of being the first and largest Bitcoin treasury company when we see companies adopt some of the BTC KPIs that we've established. Metaplanet, who you heard from yesterday, Cooler, who you heard from yesterday. And so that's the reason we want to publish this model, is so other companies can start to adopt it like they did the BTC KPIs. And probably most important for all of you is we need to educate folks, right? The Principles of Corporate Finance, written in 1988 by Stuart Myers, needs to be updated. And it needs to be merged with the Bitcoin standard. It was written in 2018. We need a book on the BTC standard, right? We're writing the book as we go along. I think it's going to be the book that people will read and teach 20, 30 years from now. And it's exciting to be sitting here talking about the future of finance. So thank you very much.
I'll grab that, thank you. Phong, I love the way that you've made earnings calls a must-watch TV now for strategy. It is time for lunch, so I hope you will join us this afternoon for an exciting lineup of more panels, speakers, CEOs of publicly listed companies that have adopted the Bitcoin Treasury strategy. So please enjoy your time. Thank you so much again to Strategy as well as the sponsors. Thank you.
Please return to your seats. The 2025 Bitcoin for Corporations will resume shortly. please welcome back to the stage your host, Natalie Brunell.
Welcome back. I hope everyone had a wonderful lunch. We're going to get going with an incredible panel to discuss why some of the biggest CEOs are getting into Bitcoin. So we're going to talk about going all in, the CEOs that are sharing their journey of adopting the Bitcoin standard. Please join me in welcoming Simon Gerovich, the CEO of Metaplanet, a Tokyo Stock Exchange-listed firm that has garnered attention as Japan's answer to MicroStrategy due to its pioneering Bitcoin treasury strategy, and it was the best-performing equity of 2024. We'll also have Eric Semler, chairman of Semler Scientific, where he led the company to becoming the second U.S. public company to adopt a Bitcoin treasury strategy. It now has the fourth largest Bitcoin treasury, reflecting his contrarian investment approach and belief in Bitcoin as a superior store of value. And rounding out the panel is Andrew Kang. He is the Executive Vice President and Chief Financial Officer at Strategy, where he oversees the company's financial strategy and Bitcoin treasury operations. With over 2 decades of experience in accounting, treasury, and capital markets, Andrew has held senior roles at financial institutions including GreenSky and Santander Holdings. This panel will be moderated by Shirish Jajodia. He is the corporate treasurer at Strategy, where he oversees the company's Bitcoin treasury operations and investor relations, contributing to its position as the world's largest corporate holder of Bitcoin. And I'd love to know how they're buying so much Bitcoin without really moving the price, although it is doing well today. So let's welcome the panel.
Good afternoon, everyone. I'm so thrilled here to be joined by 3 visionary leaders who are shaping the future of corporate finance, not just by their regular corporate operations, but also using the Bitcoin digital assets integration into their key strategic business, and not just as a side bet, but also like as a core focus on their business. So from Semler Scientific, from Silicon Valley to Metaplanet in Tokyo to Strategy in Tyson's Corner, they have captured the global attention for not just accumulating more Bitcoin using their operations and cash, but also leveraging capital markets to acquire more Bitcoin. So with that, we're going to dive in. What lessons have you guys learned from each other's operations and each other's Bitcoin strategies, and how has that influenced your own strategy? Let's start with Eric.
Okay, that's pretty simple. I would say with Strategy and Michael Saylor, it's about just religiously adhering to his playbook and staying laser focused. And for Metaplanet, we should have launched this in Japan.
Obviously, we're all standing on the shoulder of giants, so we owe a lot of respect to what Strategy has done. And obviously, Strategy has built a playbook for companies around the world to follow, so it's made it very easy for others to do so. So it's been very inspiring. Eric, you and I were on stage together in Nashville about a year ago as the first 2 companies really to adopt a Bitcoin strategy. So that's incredibly exciting and very inspiring, and very happy to be here.
Me too. Thank you, bud.
So to your point, Simon, I feel like this may be like the alumni class of Bitcoin for corporations, because about a year ago, we were all in Nashville, and Strategy had already, begun its journey and was well into that. Metaplanet, you were, getting organized, and I think about, I was telling you earlier, Simon, it was very powerful during your presentation where you showed the progress you've made over the last year, just through 2 photos of your shareholder meeting 1 year ago and this year. And so, for me, I think, from your example, we've learned that there is global outreach and global interest, right? So it's not just a US-based strategy that our company has executed on. there's a lot of ways that other geographies, other countries can really embrace this and be extremely successful. Eric, for Semler Scientific, I recall when we met last year, you were probably still struggling with getting it started, right? I think you were right at the cusp of getting regulatory, or in the process of getting regulatory approval, really launching the initiative. And I look to where Semler is now, and you're the fourth largest corporate treasury. So from my perspective, when I think about Semler Scientific, it's about persistence and conviction and just staying the course. So first off, thank you guys for being here, and I think we can all learn from not just strategy, who's been doing this and helping pioneer, but also for everyone who wants to follow and who may be thinking, maybe it's too late. It's not too late, right?
Great. So everybody's wondering these days, we started off 5 years ago as the only company, or strategy, as the only company with Bitcoin on balance sheet. A year ago, there were maybe like a dozen companies, and this year now there are 70 plus publicly listed companies with Bitcoin on balance sheet, holding over 700,000 Bitcoin, close to $70 billion. So how do you see the emergence of these new companies coming to the space? And do you see them as partners in validation, or do you see them as like competitive pressure?
Good question. I see a proliferation. I think it'll mostly happen with smaller companies. I think it's going to be a more difficult hurdle to get large, very healthy, growing companies to do this. But I think that will happen as well. But there are going to be a plethora of smaller companies who can continue to do this. I think there's kind of this lifeline concept that for many companies, they need to kind of get out of the rut that they're in, if they're zombies and so forth. And Bitcoin provides that kind of that electrification that their stock needs. And so I really welcome that. I'm a huge believer in proliferation. I think it's great for Bitcoin. It's great for us. I'm glad that we were early. It's a great feeling to be kind of a pioneer in an early mega trend, which is that's very emotionally and financially rewarding. And I find it kind of that Simon and I have this cosmic connection, that we were both kind of planning to do this at literally the same time. We never met each other, so it's kind of interesting that played out that way. But I still think I would love to see next year that number really exponentially increase.
Simon?
I think in the traditional world, it's a dog-eat-dog world. Everyone's trying to compete and one-up each other. But the brilliant thing about the world of Bitcoin is we're all in it together. And it doesn't matter if you happen to be the company that buys it after the next person, you have a common vision in mind. And so, we were inspired by strategy and began the execution last year. And now, certainly in Asia, we're being approached all the time by other companies looking to have conversations, looking to understand the playbook, looking to understand what the pitfalls might be, how to explain to their boards, who to surround themselves with to ensure that there's an easier path forward. And so I think this is just the beginning. This is perhaps in the Japanese context, say, the beginning of the tidal wave of more and more corporations around the world adopting Bitcoin. I think it'll be irresponsible for companies not to look at Bitcoin and not to purchase Bitcoin on their balance sheets. And time will tell which ones are the ones that come to the table last.
I would echo all those points. I think the space we live in, Bitcoin, is very much a family. And someone might say that a new entrant is competition. I think we're still at a point where we want more people to adopt this journey and put Bitcoin on their balance sheet. I think that more people doing it gives us validation, gives us momentum. We have more advisors and partners that are helping companies think about these things. And to me, it's like, we're still in the rising tide lifts all boats phase. As I mentioned earlier, it's still early. And it's interesting, the amount of interest that we're getting now versus a year ago or 2 years ago has been amplified significantly. And within the past year, I think, being in the position we have been in, we've got a lot of inquiries from other corporates, other executives, and in my role specifically, other CFOs that are asking more questions. I would say even this week, at this conference, I've gotten several questions of, hey, this CFO would like to talk about this public company is interested. So I think we all collectively agree that more is better. And so I look forward to it. I welcome it. I think there's enough space for everyone. We have 70 plus public companies adopting Bitcoin. To Simon's point, that's still too small. I say that by the end of the year, we'd like to double that.
At least.
At least, not more.
So turning to capital markets, starting with strategy, you pioneered novel ways to accumulate more Bitcoin, starting with convertible debt, different types of convertible debts, equity financings, ATM financings, and structured notes, and now preferred equities. What next from here, and how do you continue to innovate to continue your goal of acquiring more Bitcoin?
I think it's, should I go ahead? You want to go ahead?
Yeah, sure.
Okay. I think it's just a combination of those things you mentioned. I think that you have to use them when they make the most sense, each one of them. We've done a convertible debt offering, which was very accretive for us, created a very good yield. And we also have a very large ATM. We just got authorized for a $500 million ATM. So we will tap those when necessary. There's a potential to go back to the convertible markets for more capital. But I think the ideal one is the preferred market. And for people out there who are considering this strategy, if you start out at a smaller size, it takes time to get there. There's a lot you have to do and to get to the point where you can do a convertible or you can do a preferred. It's not like something you can just call somebody up and they'll put it together for you. So there's an incremental kind of scale building process that enables you to kind of get to the next level of financing. And I'd say that, from a yield perspective, a creative perspective, getting into that preferred financing world would be ideal.
Simon?
I think the brilliant thing that strategy recognized was that there were infinite pools of capital around the world looking for exposure to Bitcoin. And up until strategy came around, the only way to get exposure to Bitcoin really was buying Bitcoin itself. Many investors, professional investors, institutional investors can't buy Bitcoin. And so recognizing that there are different risk-return profiles that different investors are looking for, being able to target exactly what that group of investors is looking for and offering them something they need is I think, the brilliant part of the strategy. So we're just in phase one of our current growth. We're executing the equivalent of an ATM in the Japanese context. There's no ATM that's available, so we've come up with a moving strike warrant program, which ultimately results in the same thing. We end up raising capital through the public markets. We also want to have as many tools as possible in our toolkit, and CBs is a logical next step, although I personally have some qualms about it. One must make sure that the investor that buys your CB is one that is, I think, aligned with the future and not just trying to capitalize on your volatility. The preferred instruments which strategy has launched, I think, are incredibly interesting for us in Japan. Japan is yield starved. Imagine you put $1 million in the bank for a year, you're lucky to make $100 in interest. And so if you offer them a structure where they can earn 3, 4, 5, 6%, they bite your arm off.
I think for strategy, we've communicated a lot on how we think we can continue expanding the funnel. I think our goal is to find new pockets of capital. We've been able to demonstrate that with the preferred equity offerings we've done earlier this year. Michael talked about the iterations and the R&D we do to think about those new types of initiatives. So we will certainly do more of that. I think led by Metaplanet's great example of the success in Japan, I think we will look to see how strategy can be a bigger player in the global sort of markets outside of the US. I think that one big unlock for us in finding new capacity and raising additional capital in the next year is around the financial framework, the corporate finance standard for Bitcoin that Phong talked about earlier, and really advancing that to be able to create the unlock around how investors view our credit, how shareholders understand how we generate value through our Bitcoin acquisitions, through the various vehicles that we have today. I think we will add more to that toolkit as well. But I really think, one of the areas that we addressed with the preferred equity offerings is the enormous universe of fixed income investors that are still largely untapped. So I think through that education, through some more innovation, I think there's a lot more work for us to be done.
Yeah. So Andrew, can you talk a little bit more about, we have different securities now. Strategy has different securities across different spectrum of volatility and risk reward. So how does that play into addressing different types of people, and what are the challenges in kind of expanding the size of those instruments?
So I think I alluded to it in sort of our fixed income universe, right? Like there's just today a pretty distinct disconnect between how investors and rating agencies think about our underlying credit. Once that potential gets clarified, I think there's going to be a tremendous amount of interest. I think hopefully it'll pave the way for others as well. And so, there's just a core, fundamental principle of this new asset class, this new commodity that exists that we are educating on. So that's one way, right? Just inherently educating and expanding the understanding of how people can view our balance sheet relative to our capital structure. And we're significantly undervalued in that perspective today. I think about, another area we've been highly successful is also in the convertible bond market, as Semler has as well. That is a much smaller market, and last year, Strategy was the largest issuer of convertible bonds in that entire ecosystem. I think what we recognize there is a lot of appetite, but there's more investors that could get interested in that type of instrument as well. So it's addressing the existing sort of system, but bringing more Bitcoin focus, people that want Bitcoin exposure into the already existing instruments out there that I think will continue to help us expand. So, education on credit fundamentals and expanding investor bases however we can.
Makes sense. And so from Eric and Simon, your perspective, how do you view fixed income in your strategy, and how do you see that, like how we are working on it? And the great thing is when Strategy launched each of these initiatives, we had to go through a lot of first-time hurdles in terms of working with always like in the traditional finance world, the bankers, the lawyers, and to come up with innovative ways to find ways to be able to launch a new security, new product. So how do you see that applying directly in your context? And do you just adopt it easily, or like any challenges that you come across with respect to your own companies?
I think, you'd be a fool not to kind of try to follow what you guys have done. So I think that you've kind of laid for all of us, we're so fortunate that you've kind of laid that out. And I kind of described Michael yesterday as this guy who's leading a Peloton bicycling team. He's braving the elements, he's setting the pace, and we're in the back just, fueling up behind him and supporting him, but he's really the groundbreaker. And so I think that it's much easier for us once you guys have broken into those markets. It's Doing our convertible, for example, was so much easier because of the work you had done in that area and the success you had, that when we met with convertible investors, it was like very quick and easy type meetings, a lot of interest, substantial over subscription to the offering. So, and I think a lot of that has to do with what you guys have had the success you've done. So I think that our like the holy grail for us is to tap into the fixed income markets. I think those are incredibly accretive and attractive to us. And I think it just takes time. I think you have to, grow and get bigger, grow your Bitcoin holdings, and reach a level of scale where you can, just do what you guys have done. So I think it's there. It's just a question of time and scale.
And Simon, how about you? Operating in Japan, what are the specific considerations if somebody were to enter the Japanese market, or cross-country, like if you were launching something in the US market? How do you get through those hurdles?
I mean, Japan is an incredibly regulated market, but when compared to the US, I think it's probably no worse. Every market has its own unique attributes. So I think anyone in the room who's looking to execute the same strategy just needs to understand what the local regulatory environment is. The one thing that we did in Japan to kick off our capital raising last year was a rights issue, which in the traditional concept is only done by companies that are desperate in need of cash, and a negative thing. But in retrospect for us, we think it was probably the #1 best thing that we could have done. We had roughly 15,000 shareholders fill out 50 pages of documents to subscribe, and they sent in their check, and at the end of that, they all became shareholders, and because they gave us the money themselves to buy Bitcoin as opposed to buying shares in the market, that created a connection, which is rather incredible. We're looking at doing a preferred issuance at some point, but the hurdle there is you have to convene a shareholder meeting first, which has a whole host of headaches and time considerations. You have to update your articles of association to allow for a new class of shares, and once you do that, then you can move forward and do that. So these are all things that we have kind of in our mind going forward. But for us, I think right now it's really executing the equivalent of our ATM. The Japanese regulator now has become incredibly friendly. So the first time we proposed issuing shares to buy Bitcoin, the response from the regulator was, why would you sell shares to buy Bitcoin? It's not your core business. Is this dilution good or bad? And so it's a process of education. Being able to say that there's a huge US public company that has done this and has a track record of executing has been really helpful. So I think, around the world, as people come up with creative structures to raise money to buy Bitcoin, we can all borrow from those experiences.
Yeah, so I think one of the ideas here could be that like strategy initially put out our playbook and open source the playbook for others to follow, and a lot of companies are adopting that. It may be very interesting to have country by country playbooks as well, because you guys are all the first companies of those countries adopting Bitcoin treasury company strategy. While it's all public, but then it's not very obvious to the companies maybe in the country or other countries if they are looking to enter any other country's broader market, to tap the capital. So I think it could be really interesting to develop country by country playbooks. That's a call to everyone in their respective countries, and I think that would be very useful for other companies to look at. So switching gears to more operation, non-treasury side of the business, how do you see the balancing of your non-treasury but non-Bitcoin operations versus your regular like software, tech, healthcare operations? So starting with Andrew, you can provide your views.
We have our non-treasury operations, our software business, and in fact, many of us are here adjacent to this conference to also be here for our software business. It's been around for a long time. It's been an extremely successful business over the years. It actually carries the weight of our employees, that contribute to the entire enterprise. I would say that we've maintained a core focus on that business. We are relentlessly trying to innovate in that as well. Hopefully some of you heard some of the AI innovations we're building into our BI product at this conference. If you're able to, I know we talked a little bit about it at the main keynote. Still full force ahead on that side of the business. I think one important piece in our journey is in the past year, we have really come together as an enterprise. And what I mean by that is, historically, we sort of kept the two businesses and the mindsets somewhat separate. Like, if you're on the software side, focus on that. If you're on the Bitcoin side, focus on that. And there was some crossover that we had to address, but primarily it was, two sort of separate runways. In the past year, I think we realized there was a lot of importance in aligning the mindset and the culture around our business. And so late last year, I like to put it as we decided to orange pill the entire company. So it didn't matter if you focused on Bitcoin, it didn't matter if you focused on the BI business. If you wanted to be at strategy, you needed to be aligned with the core principle of what we do with our balance sheet and the value that we're generating for our shareholders and our employees. So we, set out training courses, right? So every single employee at Strategy has to do Bitcoin training. And we've had, I think, 4 of them so far. And every training gets a little bit more technical. We dive into financial concepts. We started with the core principles of Bitcoin and the why. And so, for me, it's almost like, a transformation that we've undergone in the past year where, it's not just enough to be at Strategy and work on one side. You have to be at Strategy and work for the greater good of the whole. I think one of the big culminations of that was our rebrand from MicroStrategy to Strategy. That is like a biggest signal of we're not an old software business with a treasury business. We are one Strategy under a new brand, and our brand color is orange now. I think it's awesome. I've been walking through the halls and I see all of our software people wearing orange. And to me, that's just a reflection of one team, one alignment, and I think at the end of the day, that helps the greater good of the entire company.
And Simon?
I think the blessing in disguise for us is we had a core business that wasn't doing very well. And so we're not really focusing much energy into hotel development going forward. We still have one hotel remaining, and this is the hotel which we're in the process of converting into the Bitcoin hotel. And we think that's a really good strategic decision for us in our goal to onboard 1 million Japanese people into Bitcoin. As great as Bitcoin is, it's kind of up there in the ether, right? It's something you can't sometimes touch and feel, which is required for some individuals to get comfortable with Bitcoin as something to own. So the Bitcoin hotel will be a place that has a Bitcoin museum. There'll be a Bitcoin art gallery, but really just a space for our shareholders and those who are curious about Bitcoin to come and spend time and learn and meet others. We also have the license for Bitcoin Magazine in Japan, and we think that's a wonderful way to also onboard people through education. But everything we do now is very much focused on Bitcoin. We think of ourselves as the Bitcoin-only company. We will accumulate as much Bitcoin as we can over time, and everything that we do around that core purpose is also Bitcoin.
Yeah, the question of balance is an interesting one because I'd say maybe more than the rest of us here, we're still very committed to healthcare and saving lives and building our medical business. But that business just moves at such a slower pace of development versus Bitcoin that Bitcoin has become, we're a Bitcoin first company because it's where most of our value resides. We were actually a medical version of MicroStrategy and Strategy and Metaplanet between 2016 and 2021. Our stock went up 136-fold. And when we had $1.2 billion valuation, we were, I think, 13,500%, probably the world's best stock in that time frame, based on one medical device that we still have that we're now applying to some new vascular diseases. They just take time to develop. There's obviously the potential that we're addressing even larger TAMs than we were before. So, but it's just going to take time. But as that's happening, Bitcoin just becomes bigger and bigger for us. And maybe, we hope the healthcare business can move the needle if it really takes off like it has in the past. But that balance is really being threatened by Bitcoin.
Makes sense. An observation on the pace of raising capital is that if any other companies, non-Bitcoin standard companies, when they were raising capital, they raised a couple $1 billion. It's not the issue of raising this capital, it's more about the deployment of the capital, which is more challenging for these companies. And what has happened with Bitcoin is if any traditional companies are acquiring any financing and raising some capital, they take 2 years to deploy the capital and multiple years to earn return on those capital. So it's a 5-year cycle. With Bitcoin, that deployment cycle has now gone down from 5 years to like 5 days with respect to strategy. You deploy it in a week and you're ready again to raise more capital. So question for Andrew is then, is there a limitation of the size that you can grow, and how much Bitcoin can you acquire, and how does that play into the relative size of the operation business versus the Bitcoin treasury?
No limitation to how big we can grow.
That's a question that people think about. So,
no, I think our strategy really is, in terms of the two components, I think we have a lot of room to grow both. I think to your point, the Bitcoin strategy is one that is, on hyperspeed, so to speak. And, we've done certain things to bring that speed forward in terms of faster earnings cycles. And what I mean by that is, weekly 8Ks. And that was a bit of a transformation for us at the beginning of the year. I think our transparency allows us to grow faster and adjust to that pace. We have our website up now that many of you have seen that gives 15-second updates on our metrics and our results. And so from the Bitcoin side, I think the pace and scale and the speed is reflected on how we've innovated on transparency and investor relations. I don't think there is a limit to how fast we can do that or how much we can grow. As I mentioned earlier on the software business, it's something that I would say we have every aspiration to grow that as big as we can. It's been a very steady business for the last 30 years. I'd like for that software business to be just as big as the Bitcoin business over a period of time. And Eric, to your point, right, that doesn't happen as fast in that operating function. But we're here innovating, and I'd love for the software business to be 10 times the size it is today. So short answer is no limitations. We're pushing on all fronts.
Yeah. And we talked about the Bitcoin standard KPIs, and strategy devised the KPIs, and then we talked more about it, and Phong gave an elaborate presentation about it. So from other companies' perspective, how do you see the importance of those KPIs in your investor communication, and how that has changed the perception of your investors in your communication? Do they find it more useful? Do you have to educate them a lot? How does it go?
I mean, education is critical. As we get larger, the types of investors that one needs to approach are institutional of larger scale. I think the metrics that they have to value companies are using the traditional tools. And so strategy has come up with wonderful KPIs that we've now adopted as well. And in all the communication that we have with our investors, we talk and educate about how these KPIs work. The brilliant thing about these KPIs and being transparent on your website, we have a similar dashboard now on our website, is that we can share on a real-time basis all the metrics that are important to investors. Having come from the traditional world, you trust, if you invest in a hedge fund, you trust the statement that you receive from the prime broker. Prime broker says, yes, I have $150 million of shares of this and that, but you have to trust that person providing the document to you is being honest. If you have it in a public dashboard, the things that might be buried in a financial statement are now front and center. And so I think it's imperative, it's critical that we continue to build on these KPIs. There's so many new KPIs from your earnings announcement, so I need to spend some time going through them all.
It will take some time.
Yes. We need a bit of time to adopt them one by one. But I think there's no other way than to come up with a new framework for the traditional investment community to understand companies like ours.
Yeah, I agree with all of that. I think that we're doing the live dashboard too, but we also have this kind of real-time feedback on social media from our shareholders. So we kind of get a real good feel for what they think of these KPIs. And I think people are particularly focused on yield. And that, I think, has been embedded as a really critical metric to focus on for all investors, institutional and retail. But I think I think these metrics are incredibly valuable and pertinent, but I think that they just need time to kind of, to marinate so that they can be proven out. I think there's still kind of a little bit of skepticism about how sustainable some of these concepts are, because they're working now. Why are they going to work in the future? And earnings multiples are really based on kind of this constant, consistent compounding concept. And the longer that we can continue to show good metrics, the more I think they become credible and kind of, the Overton window shifts and they become more mainstream.
I would just add that I think the financial framework and the metrics and the KPIs is, we're really early in that. And, we constantly think about how we can communicate better and more transparently. To me, it is a tool for our existing investors and our shareholders to have better transparency. I do think it's an amazing tool that is becoming bigger and more front and center in terms of how other companies can also evaluate their decision of whether or not to adopt a Bitcoin standard or not. Before, it was a bit opaque. It's like, oh, we can buy some Bitcoin, and it's all reflective on Bitcoin price, and maybe there was a bit of a vacuum in terms of how you could forecast valuation and accretion and gain and earnings off of it. I think that the tool is dual-fold. One is it allows your current investors to have a better understanding, but hopefully through conferences like this and discussions like this, it allows corporations, CFOs, treasurers and finance departments to say, okay, if I applied this to not having a Bitcoin standard today, but if I apply these concepts to potentially adopting a Bitcoin standard, it could help push people to do that as well. So I think there's a dual benefit there.
Yeah, and from a legal perspective, and lawyers may say they're all not the KPIs, so there are some KPIs and there are some metrics, so I want to put the disclaimer out. But then, other than that, I think it's interesting to see more and more companies adopting those KPIs and seeing the importance of those KPIs in communicating their story. I think it will be also interesting if these companies start asking their bankers when they bring a new transaction to them, like calculate all these KPIs, and then they can compare all the options. So I think it will be a good exercise for all the bankers and lawyers to get familiar with this, and then we'll see broader education and the application of the importance of these KPIs. And now, so getting to a final question here, what advice would you have for other companies, either in your sectors or cross sectors or your country, other countries? Like, what advice do you have for other companies to learn from your strategies, to follow your footprint, and like, how do you see this evolving and playing out over the next 2 to 4 years? Eric?
I'd say listen to Mike. He's got the goods and he knows better than all of us. So I would listen to him closely. I think that's how I converted my board. I had them listen to a lot of Michael Saylor's preachings about zombies, and that was very convincing and persuasive to them. I spend a lot of my time when I'm not doing this and meeting with public companies. I'm an investor in mostly technology and media companies, and when I'm not here, I'm meeting or on a call with a lot of public companies, and there are so many that I will ask, what are you doing with all that cash on your balance sheet? And it's easier when they're not doing well. Obviously, if you ask Duolingo or, why are you not taking your $800 million of cash and buying Bitcoin? They're like, what are you talking about? Where business is on fire, But if you ask maybe a Zoom Communications, which is not growing much, facing tons of competition and has more than a third of their market cap in cash, and they're making $2 billion of free cash flow a year. I think that those types of companies need to be pressed. I think guys like me who have access to them through my own investing as a portfolio manager should do that. And that's what I do. I actually, on X, I have this thing called the zombie zone, where we call out companies that should adopt.
That's great analysis.
Yeah, we call out companies who we think should adopt the Bitcoin Treasury standard. And because I do this on a daily basis in my regular job, I see so many opportunities.
Simon?
I've got a few points. The first is to have courage and conviction. And so if the company doesn't have a leader that believes in Bitcoin and believes that it can be transformational for one's balance sheet, then it's not going to work. The second is don't listen to your lawyers or your consultants. Ask ChatGPT. I was inspired yesterday by that. It can do a much better job of telling you what you can and can't do. And then I think finally, you want to surround yourself with a board and advisors that believe in the common vision. If they don't, then ask them to step down. Stack your board with people that believe in the vision, that you need to have a push and a pull there, but if you have people that are always standing in the way of you wanting to move things forward, then it's just not going to work. But I'm feeling more optimistic than ever that this is the tipping point. And as we just said, by the end of the year, maybe twice as many public companies or 4 times as many public companies around the world adopting the same.
I think my advice is very consistent, right? We started this conversation around the progress that is made in the past year. I think the examples are clear, right? Like if you adopt a Bitcoin treasury strategy, you can generate a tremendous amount of shareholder value. Bitcoin today continues to become more mainstream. We now have a more friendly regulatory environment. We have a lot of support from the government here in the U.S. I think there's a lot of tailwinds. There's a lot of underlying reasons why Bitcoin today is perceived in a much more favorable light than it was before. So don't be afraid of it. Learn about that core principle first, and then learn from our examples, right? You've seen charts of our performance, our collective performance over the course of the past couple of days. And it's tremendous. And at some point, we talked earlier about more companies adopting this. Then you're going to have more examples of companies that are going to have that type of success. And so, my call to, maybe it's an advice, but maybe it's my call to action would be to, have teams, CFOs, CEOs, boards think about at any size too, right? Not just the zombie companies, not just the small corporates, but the Microsofts of the world. Think about how you can, bring more value to your shareholders, how you can create performance and success through Bitcoin that our examples have provided, and don't ignore them, right? Think about it, go do the homework, apply our Bitcoin corporate finance framework, and really understand it in a way that I think will, be pretty obvious at the end of the day.
Yeah, we saw the Microsoft case study in action yesterday, very elaborately laid out by Michael. And we see more and more bankers also participating in the ecosystem now. And one thing that is common in all the bankers is they always carry a pitch book. And they're always talking about different options and proposing different things to different companies. I think it would be great if they should just start presenting the case studies of all these Bitcoin treasury companies and show this performance. Look at our website, strategy.com, if you want to download the performance charts, and start building the case studies on all these companies, on the performance across any different time periods and what these companies have done, and have that section as a section at the back for all the companies they're presenting to. That will be really fantastic, and I think that will also generate a lot of prospects for those bankers, and we are here to educate those companies. So with that, I would like to thank our panelists and everybody else for joining here. It's clear that going all in on Bitcoin Standard, it's not just about hype, it's about courage, conviction, and vision. And the playbook for Bitcoin Standard companies is still being written, and you all are holding the pen. So thank you very much.
Thank you. Thank you.
Thank you. Always fun to do it again.
Wonderful panel. All right, Strive made a very big announcement on X this morning. I don't know if you guys saw the tweet. It said Strive will combine with asset entities to form the first publicly traded asset management Bitcoin treasury company. So we're about to learn a little bit more about that because they pretty much went radio silent right after that post. So we're going to be introducing Matt Cole, the CEO and CIO of Strive Asset Management, which was co-founded by Vivek Ramaswamy. He leads the firm with a focus on establishing its Bitcoin treasury, both by accumulating Bitcoin and building a long-term investment approach designed to outperform it, using Bitcoin as the hurdle rate for capital deployment across the firm. A longtime Bitcoin advocate, Matt previously managed more than $70 billion in fixed income portfolios at CalPERS, consistently delivering benchmark-beating performance. He helped drive the shareholders' first movement against ESG and DEI mandates, and now the focus, of course, is maximizing Bitcoin exposure. Before we hear from Matt, a short video.
We want to be a part of taking Bitcoin to the masses in a really well thought out way. When we talk about Bitcoin, we view Bitcoin and investing in Bitcoin as an asset class, not just an asset.
If your company's sitting on a stockpile of cash, you're going to hold a lot of it. A lot of them do today in the form of US Treasuries. Very few of them are holding those in the form of Bitcoin today. I believe that is likely to change.
The Strive is all about capitalism, maximizing value for shareholders, period. Bitcoin is the most pro-capitalism, pro-freedom in the history of financial markets. So our view is that corporate America needs to adopt Bitcoin in a major way, and that's why we're here.
As a long-run investor in your company, in the future, if you've deployed capital and you've underperformed Bitcoin, then my view is that you should be fired.
Wow, well, I don't want to be fired. I'll just start with that. But just to take a step back, my background is actually traditional finance, not Bitcoin as the video laid out. I was a $70 billion portfolio manager at CalPERS. They're the largest pension in America. And so I was doing a couple different things there. One, I was one of the larger buyers of structured securities. And so Michael Saylor has given a masterclass over the last few days, from the earnings release to yesterday's presentation, on why these innovative fixed income approaches are so important for a Bitcoin treasury company. Because it's not just about buying Bitcoin, diluting shareholders. You actually need to do it in a way that accretes value, and structured securities is so important for that. So anyways, that was part of my background. The other was I was one of the larger buyers of US Treasuries in the United States. And so for many years, I was sitting there staring at the debt crisis of the United States and buying the debt, because that was my job. Sitting there watching the Fed print money time and time again, and then we would meet with the Fed, and I would say, "You're printing money." And they say, "No, it's not printing money." I'm like, "No, it's printing money," which somehow they still think that it's not that monetary easing has not been printing money. And staring at the problem, and then it became very clear for me in about 2016 that Bitcoin was the answer to every single macro problem I was seeing as a fixed income investor, managing a pension that was underfunded, trying to meet its liabilities for those that served California at CalPERS. So I went all in on Bitcoin, and my last few years at CalPERS, I tried to help them look at it from an asset allocation perspective. When Strive was founded in 2022, they brought a refreshing mission around financial freedom. And the first part of that mission was really about pushing back against constraints in the capital markets. Those constraints were ESG constraints that we were initially focused on. And what we showed the world in just a couple short years is that corporate governance and activism and advocacy can drive major change in corporate America. And so just in a couple years, the ESG movement is pretty much behind us. It's not popular anymore, and we're entering what I believe still to be the golden age in America of innovation. I think AI is going to drive that in a major way. A world of abundance. And in that world of abundance, there is going to be a massive, massive premium on what is scarce. And Bitcoin is the most scarce asset ever known to man, the most perfect form of money. And so our focus now in our advocacy efforts, our number one focus, we're still fighting back against ESG overreach when it's there, but our top focus is Bitcoin corporate adoption across corporate America. And it really is staggering how early that we are in this movement. Less than 1% of companies, public companies, have adopted a Bitcoin treasury. We just had a panel of innovators. We're the newest now Bitcoin treasury company, and we're going to accelerate in every single way that you could possibly imagine. Our board is designed to accelerate. We have a couple different independent board members that we've announced today. Jeff Walton, Ben Workman, kind of the hurdle rate pod crew, and then Ovik Roy. I mean, yeah, I see you right there. And that's key, because one of the first things I've noticed as we've advocated for large corporations to adopt a Bitcoin treasury is the stakeholder management. You can't have a board of directors that's going to slow you down. Innovation and acceleration is key to deploy a Bitcoin treasury strategy and deploy it in a way that's going to be accretive to shareholders, to common equity shareholders, because it's not just about, doing a Mickey Mouse, do a bunch of ATMs, which is great. You use the ATMs when it's accretive to common equity shareholders, but you need an approach that's going to be much, much more sophisticated. And I want to lay out some of the innovations that we're going to bring to the table, because yes, Strive, like probably every other Bitcoin treasury company, is going to lean into the playbook that Michael Saylor has innovated and continues to innovate. I think it's unreal, the innovation, the new securities that he's laid out, the attractiveness of them. I'm a huge fan, just from a fixed income perspective, of the convertible notes and the better risk-adjusted return that they can provide for people that want a little bit of downside protection. But man, this place is so early. And so my background being, coming from CalPERS, institutional fixed income portfolio manager, we're gonna bring some new things to the table. And so I want to lay out a couple different things, because this space is vastly evolving. So the first new thing that we're bringing together is actually part of our initial transaction, where we leveraged learnings from the asset management industry to structure this transaction in a way that allows for a tax-free exchange of Bitcoin for shares of our Bitcoin treasury company. And that is an unlock. And it's an unlock in a few different ways, because we all know Bitcoin goes to the moon very quickly. So what that means is that all these OG Bitcoin holders, they have a lot of gains. And so as Bitcoin treasury companies are evolving, a lot of them want to buy them, but they have to realize a tax gain, pay the IRS, and then obviously have less money to go buy an investment. We're able to do that in a tax-free manner as part of the close of this transaction because of the way it's structured. And I think that's really an innovative way to start a Bitcoin accumulation strategy, and to start one in a way that will be accretive to the common equity shareholders on a couple different dimensions. But I'll just give you one that's really a 1 + 1 = 3 kind of movement between the Bitcoin holders and Strive as a Bitcoin treasury company. And that's that because those gains come over, those Bitcoin holders are likely to be longtime shareholders of the company. You're actually getting a more stable capital base versus having a bunch of hedge funds. So that's the first part of the innovation that we're bringing as part of this transaction. The second is one that I'll keep it more high level, because it's hard to almost believe unless you see it. So I want people to see it, but I want to explain the high level of it. So there's an interesting issue in capital markets where many publicly traded companies are actually trading below the net cash that they hold. So even after you take out the liabilities of these companies, the net cash, the companies are valued at less than the net cash. And so Strive sees an opportunity here, multi-billion opportunity, to actually merge those companies into our Bitcoin treasury company and to basically acquire a dollar for 90 cents on the dollar or less and use that money to buy Bitcoin in a way that is accretive to the common equity shareholders, right? Because to me, there's not much of a better way that you can accrete value to common equity shareholders than to buy a Bitcoin for 90 cents on the dollar or less. And so that's something that we're actively engaged in right now. Our hope is that we can announce something before the close of our transaction or shortly thereafter, but I think it's a very innovative, repeatable strategy that is a multi-billion-dollar type of opportunity that we're bringing to the table. And again, it's leaning into the finance experience for us as a financial services company, things that we see. The third interesting innovation that we're bringing to the space is actually going off of my background as a structured securities portfolio manager, option strategies, derivative strategies. And what it is, and I'm not going to go into the full details because you'll see it when we actually do it, but the high level is there is opportunities to increase leverage beyond what you've even seen to date in Bitcoin treasury companies. Because the clear thing that you have to look out for is what is the downside? How do you break these things? Because you can always break anything, and I'm of the belief that the Bitcoin treasury companies that exist today are almost unbreakable, but I think that we can even level up another place by actually having a hedge strategy that provides explicit downside protection. And by doing that, we can increase leverage. And as everybody in this room knows that is watching Bitcoin treasury companies closely, if you watch the Q1 earnings presentation for Michael Saylor and the layout of Torque and how leveraging intelligent leverage through fixed income strategies can accrue value to the common equity shareholders and actually justify a very high multiple to the NAV of the Bitcoin in ways that just using common equity strategies can't. And so that's something that we're looking to do in another innovative approach. The last thing is less of an innovation, but it's actually part of the structure of our transaction. And so there's many ways to take a Bitcoin treasury company public. And the way we did it was actually reverse merging into a company that's already public. That company's asset entities. And just briefly on them, I mean, man, they're actually going to be very accretive to our actual operating business. These guys are absolute shippers, tell stories really well. And as everybody knows in this room, education around Bitcoin is so important, and they're going to help us take that education to the next level. But their company, as we reverse merge into them, allows us to have immediate access after close to a shelf. And as you know, Strategy uses a shelf, and Bitcoin treasury companies use a shelf for equity offerings and fixed income offerings. So we want to accelerate in manners that obviously accrue value, maximize value for common equity shareholders. If you don't, as you heard, my view is, as a CEO, if you underperform Bitcoin over the long run, you should be fired. I hold that standard to myself as well. That's the standard. It's a hard standard, but why are we at that standard? We're at that standard because there has been a misallocation of funds in corporate America and the world for the last several years. Stock buybacks that shouldn't have happened, dividends that shouldn't have happened, capital expenditures that shouldn't have happened. We've had an era of easy money, and that era of easy money is over. And where are we right now? We're in an era in this conference which I think in a couple of years this conference is going to be at sports stadiums. It's going to continue to grow. And strategy is, in my view, and I don't think this is even controversial, but it's probably controversial to people outside of this room, the most well-capitalized firm in the world. And we're going to build on that. We're going to do it in novel, innovative ways. And our hope is that we can be a leader in the next wave of Bitcoin treasury companies, and that there's just so much room for innovation in this space. And I think what you're going to see is you're going to continue to see the people that are focused, that have a board that's focused, that has a management that's focused, that's dedicated to the success of a Bitcoin treasury company, be the ones that are actually going to be able to take this stuff to the next level. And that's what we're going to do. Strive, I'm happy to say, is a Bitcoin treasury company. We're here to stay, and thank you for your support.
right, next up, we're going to be talking about turning volatility into value with Javier Rodriguez from XBTO. Javier Rodriguez Alarcón is the head of asset management and chief investment officer at XBTO, a quantitative crypto investment firm. He'll share how corporate treasuries can benefit from Bitcoin volatility as an effective tool to accumulate BTC and simultaneously produce income. Drawing from his extensive experience in quantitative investing at Goldman Sachs and Barclays Global Investors, he will elaborate on the uses of derivative strategies in the context of Bitcoin. Please welcome Javier.
There we go. So this is to move this thing. Okay, so just to start with the dress code, I mean, when I actually decided to leave TriFi, I promised to myself that I would never wear a tie. So I know that a lot of people is wearing, ties, I mean, orange ties. So I decided to go for the socks, and I actually having the hat. So anyway, I'm gonna leave it here. But so yeah, I mean, I think very important. I'm gonna probably use a lot of the terminology that you actually have seen in this conference. Great people, great content, and actually, amazing venue. But it's going to be a lot of messages that probably have resonated with you already. But there's one very specifically that I wanted to leave with you, and it's the fact that volatility is an opportunity. Okay, so I know that a lot of people have been talking about volatility to be risk, but it's actually, let's kind of go through how we can do something about it and how we can utilize that. So there we go. So, just to kind of set the scenes. And, we have been talking about all the strategic use cases of, basically BTC for treasurers. But I will actually kind of summarize this into 4 things. The first one is a hedge. I mean, we talk about hedge as an inflation hedge, and a monetary policy is a diversification. We know pretty much that the profile of Bitcoin is actually very different to what you have perceived in equities or fixed income. And very important as well is that it has a very asymmetric distribution of returns. And we have seen that, but it's actually something that we can use to our advantage. And lastly, and very important, is a very mature infrastructure. And I think a lot of you guys have been here in this space for quite a long time. I mean, I've been investing in BTC and Bitcoin since probably 2016, seen all the rights, and the infrastructure has been incredibly different to what we have in terms of microstructure of the market, in terms of how we can do custody and different things. But let's talk about this in a second. So how do we actually think BTC have a strategic edge? And I think a lot of you guys have been hearing from people putting this into the treasury of their companies. And it's mainly because we call it, and I love to call it, digital gold with wings. But it's actually for 3 different reasons. Scarcity, I mean, we heard from the previous speaker, 21 million coins. Liquidity, 7 days a week. I'm a quant investor all my life, and I can't believe of something, finally we have an asset that I can actually put risk or reduce risk on Saturdays, Sundays, when we actually have a news, when we can't do anything about it. This is actually incredible. And very important, actually we trade what? We trade between 50 to 100 billion in a day, if you count the derivatives market. Well, think about it. We talk about a lot of the stocks that we love to trade, that we see in the sticker, like Saylor mentioned, that goes in CNBC and all the time passing by, is Apple, Microsoft. Well, actually, Bitcoin trade the same sort of volume of those stocks, okay? And, if you can compare to any G12 currency, particularly the small ones, I mean, pretty reasonable as well volume. So there is a lot of interesting characteristics of this asset. And lastly, and not the least, what I think is incredibly important, is a borderless. It's probably the more secure network that exists, completely decentralized, and that's actually a feature that all the assets that I mentioned to you before can't offer. No fixed income, no equities, none of those companies. So this is actually an incredible advantage that we can do. But everyone talks about the biggest problem, talk about the issue about volatility. Is it volatile? Yeah, it is volatile. And I think, there was a very interesting quote from Chris from Fidelity, who said that volatility is not risk. Risk is capital destruction. And I agree completely with that. That's exactly what we're actually talking here. But what is volatility, and what terms are we talking about volatility? So you see the graph there. The orange line is the daily, basically changes in terms of daily returns for BTC. Yeah, it's significantly more volatile. But as well, I compare that with the S&P 500, daily changes in their returns. But let's focus on something. Let's talk about the fat tails, or the tails of that distribution. So if you think about it, okay, well, you can see that if I give you a little more of those numbers, BTC, Bitcoin, in a bad day, in the 5% worst days, it actually loses around 5.6%, versus the S&P 500 around 1.7%. Now, if you go to the other side of that distribution and you go to the 95th percentile, so the 5 best days, well, you actually see that BTC perceived delivery is something around 6.2%. So minus 5.7% versus 6.2%. So in a quantitative jargon, that actually means is that the distribution is skewed to the positive side. And I think I don't have to say to anyone here, everyone believes that the prior is that BTC will actually go higher. Well, it's actually showing in the distribution of returns, okay? It's there. Now, but if you compare that with the S&P 500, well, you lose minus 1.7%. But if you actually look at the 5 best performance, it's going to be 1.6%. Well, that's no positive skew. But actually, we love equities. We think equities is a reasonable sort of trade-off in terms of risk and return. Now, BTC is significantly better. Now, so how can we actually take advantage of that? And I remember I saw the presentation from the gentleman from the CEO of Metaplanet, which I think is kind of quite interesting, the analogy that he does, that he has in this slide, that he has a reactor, where you actually have BTC, a reactor, and it has a lot of energy coming out. With that energy, I kind of perceive it to be volatility. Now, the question is, how do you harvest that volatility to your advantage, and which is kind of quite important. Now, the problem is that everyone thinks about one thing. Everyone thinks about holding BTC, a passive asset. Now, oops, do we just kind of go back? Let's see if we can. I think I moved the slide too fast. Is it possible? Yeah, there we go. So basically what actually happens is that everyone focuses about getting the entry points. And the entry points is holding a passive representation. It goes back into, but I will skip that slide. So it's a passive holding, but you actually can't, you tell me who or you actually suddenly hold assets. And it said it's either a house that you don't use, it's either cash, it's either equities, it's either fixed income that you don't do something about it with those assets. All right, so why do maintaining those assets and not thinking about getting those assets to work? If you have a house, you kind of rent that house. If you want to actually have an equity, more likely if you're a treasurer of a company, you will lend that equity, and you potentially can do something about it. So, but the question always is that how do you measure about the custody? And we hear a lot of people talking about custody. How do you assess the risk, which is very important, and how do you actively manage that risk? So, with that in mind, it is a trade that is actually quite important. So we're going to harvest the volatility. However, you think about this graph that I have here, as soon as we can have more people adopting Bitcoin, volatility is going to continue down. And that graph showed you that the realized volatility of Bitcoin is actually going down over time, which is kind of completely orthogonal with the fact that you are adopting, you're increasing adoption. Now, if you look at the purple line, it shows you the ratio between retail investors and institutional clients. And you can see that the last year, that line is not growing, it's getting flat. What that means? There's more institutional comments into this. And volatility will continue to go down, because a lot of what I'm saying to you, we do it for clients, and they are mainly institutional clients that are actually harvesting volatility. Now, the important thing is that, okay, well, volatility is coming down. That's true. But actually, it's still pretty high. So if you see what actually happened recently in terms of the events that we have with the tariff, we go the VIX going out to 50%. Well, that's the standard sort of level that we see with Bitcoin. All right, Bitcoin, usually volatility trades around Depends if they're 60, 65, 70%. And we want to talk about how the surface looks like. But it's still pretty structurally high. Now, why you would actually do sell volatility? What is the benefit of selling volatility? Now, first of all, the structural issue that I mentioned to you is volatility high. So people want to kind of try to harvest that energy that is coming out. But how can you use it to your advantage? I do multiple different strategies that we can cover, and probably if you're interested in another time, for example, carry, for example, arbitrage between futures markets and different exchanges, all this different fancy stuff that is actually very quantitative. But there is something very simple, okay? Which is, if you want to set, I want to accumulate more coins, for example, I can actually sell put options with a particular set of strikes. If I tell you, for example, that you get compensated at the moment in time, we actually go $97,000, let's call it price now, and I said that you can actually sell put options at 85 or 82 for 2 weeks, and people is going to compensate you for that. Would you actually do that? And that will give you the ability to buy at that particular level. So the payoff would be at the end of the 2 weeks or 1 week, if your Bitcoin is trading to that particular level, you will actually receive BTC. Would you be keen to do that as opposed to paying the 97? What is the risk? Well, the risk is actually there is an 105 and never go to that level, but you actually receive premium for that at what we actually to be described to be a high volatility. So what actually a lot of institutional clients use this is as a way to enter and decide where I want to buy those assets and what I'm going to buy that Bitcoin. It's a particular level. So you have a bit of that discretion to do. 2, that premium that you're receiving, you can actually generate yield. You can express it as a yield of that particular investment. So going back to the point that I mentioned before about you want to make sure that those coins are working for you, well, here is a way that instead of actually leave the coins idle, you will say, oh, I'm going to actually generate some yield for that, and I want to express it in that way. That premium is reflected as a way to that. And lastly, a lot of the institutional treasurers and people that are holding BTC, they want to do something that diversifies them from lending the coins. And I know that probably a lot of you have experience of that. You maintain your treasury of BTC, but you need to kind of do something with that in some portion. So what is the initial thought that you have? OK, well, I'm going to take some credit risk. Let me actually lend those coins to someone. Well, we know that it's a market that is actually very one-way. It's either too many people with too many coins or some people with too many dollars, and that's actually very difficult to kind of measure, and there's the credit exposure that you have there. But here, if you actually have the ability to take advantage of that mature infrastructure, those volumes that I talked to you about, open interest in terms of a derivatives market that you have currently in the option market for Bitcoin, you could actually diversify that source by basically doing yield. Now, I'm going to move on quickly. So pretty much, this is something that we do systematically for people. And just kind of illustrate a bit. So someone wants to sell puts to a particular level. They basically sell the puts. The strike get exercised. Let's assume actually falls. OK, you get exercised. You receive a perpetual. You technically get a high exposure. There's a couple of things that you can do. You can actually sell calls to get rid of that excess exposure if you don't want to maintain more BTC, or just simply you keep the exposure, and then you can accumulate more of that. So now the question, and it's very interesting, is that you need to kind of put more capital. You put your capital, which is basically the original Bitcoin that you have in your strategy, and you put that to work. Okay, so very, very, very important. Now, going back to what I said about the distribution, the symmetric distribution of returns of BTC, it is very important to understand that, yes, the coins, BTC, move on price. Okay, today we actually have a 2% change. Well, 2% change, as I show it to you, is not the 5% best returns that you can actually have in BTC, because we said that the average or the mean is around 6.2%. But 2% is actually a tail event in the equity market, as we said for the S&P 500. It's on the 5 best percent, it's actually below, but the 5% best daily returns is actually significantly lower than the 2%. So again, what I'm saying to you here is that, yes, BTC can be more volatile, can be more risky, but in the sense of movement, not in the sense of capital destruction. So how can you take advantage of that is super important. So I want to show you some interesting numbers here. By taking a very small amount of risk here, you basically have the ability to accumulate more coins. So here is actually something that is a live performance that we have done. The returns go from 59 to 70% in the dollar terms, and the volatility actually go from 67% to 69%. So if you are actually holding BTC or Bitcoin, I mean, the volatility is 68% versus 69.5% is actually not going to make a difference in terms of what you see. But you actually can see how you improve all your risk and return profile, which is super key and important. But the bad news is that it's not straightforward. Okay, it's a multi-dimensional problem. When you're actually going to sell volatility, I mentioned to you, you want to know when the volatility is in the right market, what the market environment is actually appropriate, what sort of deltas or basically strikes are you going to actually do that. For example, you're not going to sell volatility when the market is tanking and you are in a period of the downtrend. So there is ways that we assess it, for example, by looking at trend following signals to assess where we are in the market, making sure that we don't sell risk, that you size the risk. It means that basically volatility versus the delta. So there is a lot of different sort of tools that are actually available because we know that that infrastructure is now currently mature and you can take advantage of that. The only thing that you need is make sure that you educate yourself, you understand the risk, or you actually get the help of someone who can actively manage that risk for you. But it is a very interesting way to take advantage of that volatility that is structurally high. And that's the important, going back to the point about the reactor, you get all that energy. Let's make sure that we harvest that energy in a way that you can accumulate more coins and actually generate better returns. So I'm going to stop here, and great to have the opportunity to be with you here. Okay? Thank you.
One BTC equals one BTC hat. I was excited about that. All right, next up, we're going to be listening to Peter Carl, the Managing Director and Head of Crypto Investment Banking at Cantor Fitzgerald, where he leads the firm's digital asset capital market strategy. With extensive experience in investment banking, Peter has been instrumental in structuring and executing significant capital raises for leading Bitcoin companies. Please welcome Peter Carl.
Hello, everybody. Thank you for joining us today, and thank you to the strategy team for the continued partnership. It's pretty incredible how these events have grown. Before I kick off, just a quick anecdote. Cantor Fitzgerald started in the crypto sector in 2021. We grew the team, and in 2022, we had our first crypto conference in Miami in November of 22, and FTX had declared Chapter 11 the day before our conference. So that made for a very fun event. Felt more like a funeral than a conference. And this past year at our event in Miami, it was our most well-attended event. Michael was one of the keynotes, and a little bit different sentiment at that point. It was mostly people watching on Polymarket how the current administration's cabinet was going to shake out. But Peter Carl, Managing Director, I lead our crypto and digital asset coverage on the investment banking side of the house, joined by some of my colleagues here in the crowd. And what I want to talk to you about today is who is Cantor Fitzgerald, demonstrate our commitment to the digital asset sector, and also, and most relevant to the audience, introduce our new Bitcoin lending facility that we think is really going to reshape the market. So who is Cantor? Cantor is an 80-year-old institution formed by some of the world's leading companies. We have Cantor, which is our investment bank, BGC, which is a brokerage and financial technology company, and Newmark, which are partners on the commercial real estate side that have worked with us extensively building out projects, especially within the Bitcoin mining and digital infrastructure sector. So Cantor is focusing on Cantor specifically. We are a full-service investment bank, and we've been a leader in the crypto and digital asset sector for a few years now. We have full-service investment banking across equity capital markets, debt capital markets, M&A, private capital raising. We have one of the largest equity distribution forces across Wall Street, and we are one of the last remaining private partnerships across Wall Street. And that allows us to be very nimble. If you take one thing away from this presentation, it should be that Cantor is foundational, and we will be here for the tenure as this sector continues to grow. We're not opportunistic, and we've seen a lot of people, as you all have, come in and out of the sector. We are committed from our chairman level down, and while we've made incredible progress, and Michael said to us at dinner last night, how could you ever sell Bitcoin now? We have the institutional adoption. It's also still early. We have a lot of growth to go, and we're building our platform around that. So we're about 14,000 employees globally, New York, Chicago, San Francisco, London, and regional offices across the globe. So getting to the important slide here, this is kind of demonstrating our commitment to crypto. So as I mentioned, we built out the team starting in 2021. A lot of companies were going public through SPAC mergers at the time, and in the public world, a lot of the public companies were Bitcoin mining companies. We hired the only dedicated crypto research team across the street. You can find them walking around. I won't say much more. Compliance is always watching. But we have a great crypto team that covers the entire sector and dedicated research to the sector. They're not repurposed fintech analysts. And the same thing goes with our coverage group. So we have about 10 bankers dedicated to the sector, not repurposed fintech bankers, not digital infrastructure bankers, not repurposed coverage bankers. We are focused on the sector across the spectrum. And a lot of what we've done has been in the Bitcoin mining industry in terms of capital raising, because that's where the public companies were. So we raised about $10 billion in convertible bonds last year. It was an incredible whirlwind, and starting really after the BTC Nashville conference, who puts on an incredible event every year. But starting after that conference, you saw miners start to tap the convertible debt market. And this was a natural progression. We lead most of the ATM programs in the market, which has been the lifeblood of this sector. But eventually ATMs get dilutive. And by introducing additional shares into the market, increasing the technicals and the borrow of these companies, we were able to raise over $10 billion in convertible debt. And in total, we raised over $30 billion across 35 transactions. And the strategy numbers, of course, always help with the amount of capital that they've been raising. This year, as I said, we hosted our crypto conference again. And I think all of this in summation, and what was evident at that conference and what's been really helpful is we found unique investor interest in the sector. So as you're working with institutions, there are the marquee names, blue chip mutual funds that everybody can introduce you to. But where we really pride ourselves is with our large sales force, with our research team, with investment banking, finding unique pockets of capital that are interesting. And a great example of that is we launched a $650 million convertible bond for CleanSpark in Q4 of last year. And it was after MicroStrategy had tapped the market, Mara had tapped the market, Core Scientific, all of the miners. And the market fell out, and investors finally said, we've had enough. We leveraged our relationships, we structured the deal appropriately, and we raised them $650 million at a 0% coupon with an effective 100% premium with the use of a capped call. And it changed that company for the foreseeable future, and they remain one of the last pure play miners. But we're excited about where we're going from here. So we see a pipeline of IPOs outside of Bitcoin mining, a little bit of volatility, some news on tariffs apparently, but we expect the IPO market, which will just diversify the public company portfolio, which just makes the digital asset ecosystem more solidified and will allow all of you to be able to access the market with less risk here. So this brings me to really the crux of the conversation, and I'd love to have follow-ups with anybody interested in this. I have a few of my colleagues here. We can get more into the details. I'm going to keep it relatively high level, but there hasn't been an institution with Cantor's track record. Cantor has an 80-year track record. We're an investment grade rated company. We're a primary broker. But there hasn't been that type of counterparty that was willing to lend to the Bitcoin ecosystem. So with our partners, we launched this initial $2 billion program, which we initially announced last summer. And we have had an incredible amount of demand here. This is a non-recourse, non-mark-to-market facility, meaning we're not going to hit you with a margin call if things swing 5 to 10%. This is a volatile market we live in, and we're trying to provide flexibility to you. The rates are SOFR, think high single digits and a very competitive loan to value, making this a product that makes a Bitcoin treasury strategy even more feasible, because if you don't want to sell your Bitcoin and you want to gain yield, you have a trusted counterparty that you can borrow with in scale, with flexibility, and with trust. And that's incredibly important as well. We've announced that we're partnering with Anchorage and Copper as our custody partners. The same teams that are working with BlackRock. And our goal is just to give more comfort to our corporate partners. And also, we view this holistically. So we are not a fund that's looking to make a quick dollar here. We want to build a comprehensive partnership to work with you, again, across your equity capital markets need, across debt advisory, across M&A. And this is just another piece of the puzzle. And we're constantly looking for additional offerings that we can provide from a large global investment bank, because we just haven't seen that yet. Another thing to hit on, and another testament to our depth in the sector, and something that I think everyone's excited about, we launched 21, which is our Bitcoin acquisition vehicle. We announced that candidly when we started. We were a little nervous how Michael and the team were going to react, but could have been more supportive. The white paper is public, and we built that, and imitation is the purest form of flattery. We did that in partnership with Tether, which is publicly available, that they've been an incredible partner to us across a lot of different initiatives. They contributed $1.5 billion of Bitcoin. And we brought SoftBank back into the digital asset ecosystem. They have not played recently. There was a lot of work that was done, but between Tether and SoftBank on that announcement, I think I saw Bitcoin jump $7,000. But we plan to replicate the same strategy, and we're incredibly excited for that transaction. I can't speak too much more on it as it's still to close. And then, today we saw a few more announcements, and a few people came up to me and said, thank you for announcing 21. That helped me get my deal closed. And that's what we want to see. This is an ecosystem that success creates success, and we're very excited for that to play out. So what I'd like to do, and again, I don't want to get into the terms specifically up here. We'll be outside with the full team. We can follow up. But we are lending in scale. So I think for this initial $2 billion, we probably are not looking at $10 million loans, but we can go as big as you need. So 50, 100, multiple $100 million. We have that scale. It's easy. We have the program in place. And the initial $2 billion, which if we hit all the demand that came in, would be spoken for. We have additional tranches of $2 billion that are going to come out. So we're excited to talk with you guys, and it's just, again, I just want to emphasize, it's a piece of the puzzle here. It's a piece of the puzzle to help this ecosystem grow, and while thinking through Bitcoin as treasury and what that looks like, whether you're a miner or an exchange or a staking player, or just a corporation that believes that Bitcoin should be part of your balance sheet, we want to talk to you. We've had interest from all the different categories. And we're excited to get this program off the ground and continue to scale. So with that, I ask that everybody, if anybody's interested, please meet us outside. We'll talk in more detail. We can get you in touch with our Bitcoin lending team, which is based in New York. And if anybody has any other questions or wants to talk capital markets, M&A, we have our full team here today. And that's really why we're a Titanium sponsor of this conference. We want to be viewed as a trusted partner and appreciate everybody's support in this ecosystem, which is just going to continue to grow. So with that, thank you again to the strategy team, and we'll be outside. Thank you all so much.
Thank you so much, much again to Peter. Next up, we are going to have a regulatory roundtable about shaping digital assets. We're going to be hearing from Dax Hansen, Connor Brown, Brittany Ruiz, and Neil Matra. And the moderator is Ming Xiao, who has served as the Executive Vice President and General Counsel at Strategy. I welcome all of them to the stage. Ming, take it away. We got to get the chairs back up here. I hope that everyone is really enjoying the conference. We do, again, really want to thank the sponsors, because these conferences, they're very difficult to put together. There are so many people working behind the scenes, and it couldn't be done without your generous support. I hope that everyone's had the chance to network and meet one another. I mentioned this earlier before, but again, this is a conference which has so much professionalism, so much true signal, but it's not just these massive corporations coming here. There are so many small business owners. I'm one of them. I have a Bitcoin corporate treasury strategy for my media company, and so I hope you get a chance to get to know people, because any business can really make use of Bitcoin and embrace it as a technology. I hope that you will all join us this evening for more of the festivities. We've got a great afternoon. We're going to be capping off this afternoon with a fireside chat featuring Phong Lee and Michael Saylor, of course, and that's going to be hosted by True North, which I know has become very, very popular in the last couple of months. So that'll be great. And I think with that, we are ready for the panel. So again, Ming Xiao is the moderator, and we're going to be hearing from Dax Hansen, Connor Brown, Brittany Ruiz, and Neil Matra, who Ming will be introducing further.
Hello, can you hear me? My name is Ming Xiao. I'm the General Counsel at Strategy. Welcome to the Regulatory Roundtable. I am not as good as Oz the Mentalist, but I think I know what many of you are thinking. Middle of the afternoon, regulatory matters, nap time. But that could not be further from the truth as to what's going on in the digital assets regulatory area. It is the most exciting time that I've ever experienced so far in a positive way. And what a difference a year makes. I still remember at last year's panel, Neil Matra, who's up here again with us today, predicted two things. He predicted first that Coinbase was going to lose its lawsuit with the SEC. And then he also predicted that the various spot Ether ETF applications were all going to be denied. Both of those turned out to be totally wrong. And as I think about it, this is a terrible advertisement for this panel and maybe for Neil, but it really wasn't his fault. Because what really happened was that the regulatory landscape changed so dramatically and unexpectedly, largely due to politics, that change is going to continue. Even Congress looks like it may be poised to adopt major digital asset legislation at some point, maybe later this year. Fortunately, we've got a panel, 4 distinguished experts who are going to help us understand what is happening in the regulatory arena and what it means especially for companies that are interested in pursuing a Bitcoin Treasury Reserve strategy, or if you're a company that is working or servicing in that ecosystem. Before we get started, I do want to introduce our panelists. And first, I'm going to start off with Dax. If there were ever an OG crypto attorney, he would be it. He's a partner at Perkins Coie. He founded the firm's fintech industry group many years ago. He's advised on various industry firsts, including the first Bitcoin exchanges and tokenized assets, as well as the first public company adoption of Bitcoin as a reserve asset. That would be our company. Really appreciate the pioneering partnership over the last 4 to 5 years, Dax.
Thank you.
Then there's Neil Matra, whom I mentioned earlier. He's a partner in the financial services practice at Deckert. He advises on securities issues, especially those relating to blockchain, crypto, and fintech. And he previously served as the crypto and fintech specialist in the Division of Trading and Markets at the SEC. Welcome back, Neil. Then there's Brittany Ruiz. She's a capital markets partner at Latham & Watkins. She advised Strategy's novel preferred stock offering, Strike, STRK. Thank you so much for that collaboration, Brittany. She routinely represents companies across the digital assets space in debt and equity capital market transactions, including advising on the 2021 Coinbase direct listing. Very pioneering. And then finally, Connor Brown, counsel to Senator Lummis, who is chair of the Senate Banking Subcommittee on Digital Assets. He advises the senator on Bitcoin, digital assets, and AI policy. Before joining her team, he practiced law at a well-known corporate law firm in their fintech and blockchain group. So welcome, Connor. With that, we're going to go ahead and get started. And I want to start off with the first topic being the SEC. And Neil, maybe this is a moment of redemption for you. You used to work at the SEC. And you're currently, I guess, a roundtable participant with their crypto task force. Can you describe to us the magnitude of the change that is going on at that agency, and tell us what this crypto task force is, and how is it relevant to Bitcoin?
Thank you, Ming. It's great to be back at MicroStrategy World. And I see what you're doing here, putting me in the middle and asking me about my mistakes. But there is a story here, and it is a very interesting story, I think. When did it all change, and why are we in the promised land? Because I think we are. But it's because the easy answer is obviously to say President Trump won the election. He'd made promises to the crypto industry, and that is true. But that is not where the story begins, I think. The story really begins about a year ago, shortly after this conference, when the Financial Innovation and Technology for the 21st Century Act passes in Congress. Passes in the House. It wasn't introduced in the Senate, but it passes in the House. Not only does it passes with a thumping majority, including 70 Democrats. And that gives you a sense that the political winds are significantly shifting around crypto. And I think the SEC got that message. And that is partly why the Ether exchange-traded products were allowed to get through. But that's kind of all that really happened. All the other changes are after President Trump takes office. And boy, do those happen quickly. And they're happening at 3 levels. They're happening at the executive level with the president, with the SEC as well, and they're also happening in the courts and Congress. We'll get to that very quickly. But the president takes office. Within a couple of days, he signs this executive order, which creates this crypto and AI task force, appoints a crypto czar, and says, this task force, which is across the agencies, is going to look at all the crypto regulations out there, tell us which ones are working, which ones aren't, tell us why the ones that aren't working, and suggest alternatives or suggest modifications. So that's a big deal right there. Around the same time, the SEC, under then acting chair Ueda, who's now back to being Commissioner Ueda, creates a crypto task force under Commissioner Peirce, who's actually known as Crypto Mama by the industry for her crypto-friendly disposition, I guess. And she says, she issues this tremendously powerful statement, which says, we kind of got it wrong. We relied on enforcement to sort of regulate crypto. That's not the way. We should be looking at giving guidance. And she identifies a bunch of different sort of areas which have been roadblocks in crypto, such as custody, for example, such as exchange-traded products, such as the offering process, and says, we're going to invite comment from the industry to address these. And they've been having a bunch of meetings, dozens of meetings. They've been having roundtables. They're issuing statements. They've issued statements around meme coins, around Bitcoin mining, around stable coins, sort of saying these are not securities. And that's been, that sort of indicates the changes that have gone on. 2 more changes before I stop rambling. The first one is the SEC withdraws its cases against Coinbase and against Kraken and against a bunch of other crypto platforms. And Ming, you're going to be saying, well, you got this wrong. Not quite. Because when the SEC withdraws its case against Coinbase, it says, we're not withdrawing this case because we think we were wrong. we're withdrawing this case because we think it would help regulation and help the regulatory structure if we withdrew this case. And just to make that point, they do not withdraw the case against Binance. They instead ask for a 60-day hold on the case. And so the case is sort of paused, and that's because they feel that there are other allegations that are go beyond just securities registration against Binance. And that is important because what the SEC is saying through those cases is you do not get a pass for bad conduct even in this time. We can give you, we can look at you differently if all you're doing is asking questions about how the securities laws apply to you, and maybe you have a difference of opinion with us. That's one situation. But if you're engaging in what we consider bad conduct, fraud, manipulation, something else, we're going to come after you. And the SEC has rebranded its enforcement division, not its enforcement division, but its enforcement crypto force to call it a cybersecurity and emerging technologies force. And it's focusing far more on crypto fraud than on footfalls or registration failures and things like that. So that, in a nutshell, I think is kind of just encapsulates the changes that have occurred. And just to bring this full circle, we started with a legislative change. FIT 21 passing in the House about a year ago. That didn't make it to the Senate. But just about a week ago, the House released, or prominent congressman within the House released a discussion draft of a crypto market structure bill, which is really far-reaching and sort of would create a completely new crypto market structure. It actually it actually builds on a lot of elements of FIT 21, but it goes beyond. It looks into DeFi and other things as well. And I think there's a lot there to sort of encourage the crypto industry. So that, in a nutshell, is why we got to where we are today, and perhaps an indicator of where we can go.
So it sounds like very significant change occurring very quickly at the SEC, and we'll get to Congress eventually in this panel. But I think it's worth talking a little bit more about some of the other specific guidance that has come out from the SEC, because I think it demonstrates a very telling willingness to embrace digital asset right off the blocks. Dax, could you talk about some of the more noteworthy ones?
Sure, absolutely. So maybe the first one just to note is that the Trump administration released an executive order that framed its approach to digital assets, which included, by the way, a focus on dollar-backed, dollar-denominated stablecoins, and trying to promote the dominance of the US dollar. The Division of Corporation Finance at the SEC released a number of different statements, as Neil alluded to, and maybe two that I'll focus on are the statement on stablecoins, where the SEC goes through both the Howey test and the Reeves test to look at stablecoins, and they describe the type of stablecoin that they're focused on, which is really one that is intended to be used not for investment purposes, but to be used in payments for international remittances. But they find that under the case law, that there isn't an offer or sale of securities because there really isn't an expectation of profit for the purchase of these stablecoins. But also give us a discussion of what stablecoins should be to be outside of the investment box, and that includes maintaining a stable value where the issuer is helping it stay pegged to the dollar, for instance, having a one-to-one backing, having a reserve, being over-collateralized, for instance. But that gives us now really a lot of validity for stablecoins, really that have been an on-ramp into Bitcoin, maybe so relevant to this crowd, to provide liquidity, easy access in the exchanges and the markets to get access to other digital assets, including Bitcoin. The second one I would focus on would really just be the statement on proof of work mining, where the division took a similar approach and looked at how we, under the investment contract, to consider whether either self-mining or mining pools were securities based on the efforts and the expectation. And there had been some question about whether pooling with other parties could make that a security. And maybe to no surprise, the division found that there isn't any sort of expectation of profit based on others' efforts here in mining. And so those are not securities, which I think relevant to this crowd just further bolsters the conclusion that Bitcoin is not a security. There had been comments to that effect in Bill Hinman's speech, for instance, but this is one more indicator of that status.
Well, it sounds to me like the SEC is acting quickly to lay groundwork, if you will, for implementing regulations that are consistent with the new administration's vision. But the changes that are occurring very swiftly are not just limited to the SEC. And I want to turn to Brittany. You work a lot with banks and the capital markets. A real big problem in the last administration was that crypto businesses were largely debanked. But there are changes occurring very quickly. I'm wondering if you could talk about recent regulatory changes that are also affecting banks in a positive way when it comes to crypto.
Yeah, as Ming said, the Biden administration choked off, or at the very least, highly discouraged banks from participating in crypto-related activities. And the Trump administration has taken a different tone. I think, as we all know, they want to put traditional crypto activities, or not traditional, but crypto-related activities on the same basis and on the same footing and treated the same way as traditional finance activities. So I think that what you've seen from various regulatory agencies over the last few months is movement towards that goal, which is that crypto banks that participate in crypto-related activities, they will be supervised and regulated as they have always been with respect to any of their traditional finance activities. So in March, the OCC released guidance that said that banks are permitted to engage in crypto-related activities, including custody, stablecoin activities, and so forth. And they rescinded a requirement that you needed to get OCC supervised institutions needed to get approval. The FDIC followed suit. Then the Federal Reserve came out and said, hey, you don't need to give us notice and get permission anymore in order to participate in crypto-related activities. What does this mean for you who potentially are the consumers of these crypto-related activities? Well, it means there's potentially going to be more competition in the marketplace. And I think that you've already seen some of the banks enter the stage, including the bank that was on the stage right before our panel. And that may mean better services, better product, lower cost of services, which of course is better for the end user of those banking services. So far it's a good thing. We'll see if some of the bigger players come in over the next coming months.
Well, clearly there's change that's occurring, very positive change, I think, across a number of different agencies. But there's still a lot of uncertainty, right? So very positive movement, but still a lot of uncertainty. Dax, you're a longtime digital assets lawyer. You advise a lot of different companies. How are you advising them, given the rapid change that's occurring, but still having so much uncertainty about what that end state is going to look like?
Yeah, very interesting. I mean, we have a bit of an unlock. I mean, there was like a sigh of relief recently that some of the areas that have been bottlenecking the industry and have been removed, but then we are facing legislative and maybe some judicial change, which is going to raise the bar in some ways and maybe remove the bar in others. But I would make 3 points really to companies that are considering innovating in the Bitcoin area. One is that even though we've got some additional clarity on the federal securities law side, there's still a lot of other areas of law that are relevant to Bitcoin activities. Interestingly, not so many if you are adopting just a pretty straightforward Bitcoin treasury reserve strategy. I mean, there are very few laws that actually would apply to you if you're going to be maintaining a treasury. But if you're going to be engaging in other activities, I'll call it more Bitcoin development type activities or product launches where you're custodying assets or creating wallets or you're doing lending or you're doing some sort of derivatives, some sort of hedging activity, then you have federal and state money transmission laws, lending laws, commodities laws, sanctions laws, all of which come into play. And now I think also, perhaps we'll talk about this later, but focus on state securities laws as well. So there's established laws that are also being rapidly modified as the industry gets bigger. The second topic really is that as I think about the changes that are happening right now, we're getting clarity about what is and is not a security, and we're creating an unlock on bank regulators' guidance to banks. So banks can custody digital assets, they can loan, they can actually interact with these assets with the current permission of their regulators, which has been withheld for a while. And then lastly, I would just say that for companies that are adopting a treasury strategy, that most of the laws are going to be relevant to their custodians or their brokers. So like you will actually find different prudential regulators that have different standards. You will have more states adopting, for instance, trust laws and models. There may be federal imposition of requirements on custodians. And so this is an opportunity, if you're going to be getting in the space, to consider the differences in regulatory profile and compliance of your vendors, and to develop a program for ongoing monitoring as well as the laws change and those risk profiles change.
A lot still to think through, and I want to zoom out and start getting Connor involved here. He's a lawyer on the Hill, and you consider policy implications probably every day in your job. And with so many agencies removing barriers and the like, but still a lot of hard work left to do, how are you viewing the impact that this could have on the broader digital asset market, and especially as it relates to Bitcoin?
Yeah, it's such a breath of fresh air for the industry writ large to move from an industry that was just sort of, treated as, someone who is just a bunch of criminals or people who are up to no good, and suddenly to have a really strong, legitimate voice, an administration that understands the potential of the technology. I think that the big, interesting thing that's come out of the administration is no one is really sure what being pro-crypto or pro-digital asset meant for the Trump administration until you actually see the policies they're enacting. And I think so far it's been a resoundingly pro-Bitcoin stance that they've taken. And that I think that ultimately a lot of these different agency actions and the executive orders that are coming out are demonstrating that the Trump administration understands Bitcoin at a deep and fundamental level. And I know Senator Lummis especially is very excited about that. She felt like she was a voice in the wilderness for a long time because of her Bitcoin focus. And that's ultimately why I joined the team, was to sort of help her fulfill that mission. And seeing the Trump administration come in and within the first 2 months set up a strategic Bitcoin reserve and start to delineate Bitcoin from digital assets and from crypto and sort of flesh out what really strong forward-thinking policy looks like has been just such a relief. We're really looking forward to what the next 4 years entail.
I want to continue with Congress because there's so much activity going on there that could be very significant going forward. Yeah. We've talked a lot about change in the executive branch agencies, and that's all very positive, significant in and of itself. But I think a lot of people think that if you really need or want lasting change, Congress is going to have to act. And that's really where the work that you and Senator Lummis and her office are doing can make a really big impact. And I want to start with the Strategic Bitcoin Reserve, because I know you and the Senator have been working a lot on that. Can you explain precisely what that is, and what's the plan for getting that through Congress, if that's needed?
Sure. So just the high-level concept is that Senator Lummis fundamentally views Bitcoin as a tool that can be used by the individual, the corporation, as Strategy knows well, at the state level, and at the federal level. That fundamentally Bitcoin is a savings technology that provides incredible benefits for storing and communicating value across time. And the idea with the Strategic Bitcoin Reserve is to say, well, the federal government has plenty of tools at its disposal, and that Bitcoin should be one of the tools in the toolkit. So just like we have other reserve assets, we have reserves of gold, of critical minerals. We even have a strategic cheese reserve. I don't know if you know about that, but it exists. The idea was, well, Bitcoin is a tool that
is increasingly important in a digital age, and that the nation that acts first and decisively will have a massive sort of asymmetric benefit. And part of the reason this appealed to Senator Lummis is she comes from a ranching background, comes from Wyoming, where they value hard assets like land, cattle, gold, and really likes thinking through the deeper monetary history here. And if you look at how the US set itself up in the 1930s, the Gold Reserve Act of 1934 was this critical piece of legislation that set in motion a lasting sort of economic dominance for the US, because the US acquired around 80% of all the gold in the world, actually, through that bill. And that was a critical turning point where the US had this very strong economic foundation for its economy, for its monetary system, and sort of set the stage for the Bretton Woods system and the proliferation of the US dollar. And so in that instance, we thought, okay, well, what is the modern analog there? Like, how do we take that concept and move it forward in the digital age? And Bitcoin neatly fits that. It is the modern form of digital capital that people are clearly adopting in droves at all different levels, and that our version of the Bitcoin Act is trying to acquire a Bitcoin reserve for the United States that would serve as this digital capital to support the US dollar as a reserve currency. So that's the high level. We are very excited about it. When we first put it out there, people definitely looked at us like we were crazy. That was around, about a year ago now, a little bit less. And it's been breathtaking to see how quickly the Overton window has shifted. It very quickly became a talking point on the campaign trail. It very quickly became something that went from, this seems ridiculous, to, well, actually, in an increasingly digitized world, maybe this does have some merit to it. And so the conversation shifted, and I think that further accelerated with the outcome of the elections. And then just this year, a couple months ago, we reintroduced it. But this time, it was a very different introduction. The first time, it was just us. No one else wanted to stick their hand up for this concept. Now we're at a point where we have a bicameral product. We have great offices we're working with in the House. And we have, right now, 5 different co-sponsors for other senators. And we're really looking at moving the ball forward. So we're going to have public hearings on it this year. And we are going to sort of continue taking this topic and explaining the benefits of having Bitcoin added to the United States balance sheet.
So basically, the U.S. government might follow a strategy-like strategy.
Yeah, very similar. It's something that has proven time and time again at every different level. And just like gold has been that rock for the U.S., the past 100 years, digital gold will provide that for the next 100 years, is our view.
Just very quickly, do you think there's enough traction for you to guesstimate a timeline?
Guesstimate timeline, I think the public hearings later this year will really be a critical point where other members can get educated on it. And I think we're looking at sometime later this year where it will be picked up in a much more serious way. The reality is, you can only do so many things at once. And stablecoins and market structure, which we'll talk about, are really at the top of the priority list. They have a very long, timeline behind them. They've been worked on for years. And so those will probably need to get sorted out first, and then we can sort of move on to the Bitcoin side of things. But yeah, we're full speed ahead, and we see it as, with the trifecta that we have right now, it's a great time to get some of those legislative wins and really make our mark.
Well, you mentioned the 2 other very significant legislative initiatives that Congress is working on, right? Stablecoin legislation and the market structure legislation. You can read a lot about it in the news, but we have you here. Can you describe briefly what each is really intended to do? And if it passes, or if each passes, what effect do you think that's going to have on Bitcoin?
On Bitcoin, yeah, absolutely. So the 2 different pieces are stablecoins and market structure regulation. The general idea is that there are all of these new novel digital asset products that are coming to market, and our regulations and our statutory frameworks are simply outdated and unclear in a sense that if you are one of America's great financial services companies, it's not entirely clear how you start operating here in the US. And so we've actually had a lot of companies go offshore, a lot of products offered outside the United States. And so the goal with each of these is to bring regulatory clarity for modern companies. America's capital markets are really the crown jewel of our economy in many ways, and this sort of helps bring those products to the American people. So the two different pieces, first is stablecoins. So a stablecoin is a digital asset that is tied to the value of the dollar, and the stablecoin legislation is basically clarifying what are the rules of the road for a company that wants to issue a stablecoin in the United States. How do they have to account for those stablecoins? What do they have to be reserved by? Who is able to custody them? What are all of the nuts and bolts of how you run a stablecoin business here in the US? That bill has been worked on for a long time. We currently are using the Genius Act in the Senate that passed out of the Banking Committee just a few weeks ago on a strong bipartisan vote. It is still being negotiated as we speak. This week has been very, very active in sort of final negotiations for that. And we are very optimistic that the bipartisan process can continue and we can get a product that both sides are happy with, and we can ultimately get a very positive, strong vote in the Senate floor and send it over to the House. So that's one piece of legislation. The other piece of legislation is market structure legislation. So market structure is the idea that we have securities laws that deal with securities, and we have commodities laws that deal with commodities. But digital assets are so far somewhere in between the two, and especially given the prior agency actions under the Biden administration, it's left a lot of uncertainty in the market. So market structure legislation clarifies, all right, how do you draw the line between a security and a commodity? What fits neatly in the security bucket? What is somewhere in the middle, and you need to have sort of a process of becoming a commodity? And then what is firmly in the commodity world? I think that, and so both of these pieces of legislation will be important to your question for Bitcoin. I think that stable coins will be important in the sense that many of our great banking institutions, our financial services companies are going to maybe start with stable coins, get accustomed to what a digital asset is. What does it mean to store cryptographic keys? What does it mean to really get your feet in this market? But I think that ultimately the proliferation of stablecoins out of the US, around the globe, will really be a catalyst for Bitcoin adoption as well. Because we see it as Bitcoin as global reserve capital supports the dollar as the global reserve currency. And that they're really two sides of the same coin. And as US dollar stablecoins proliferate, people become more comfortable using them, companies become more comfortable issuing them, then the bridge between those people, those companies, and digital assets and Bitcoin, gets built. And that ultimately, the proliferation of these coins, the use of digital wallets, all of those things will be a huge benefit for the digital economy, a huge benefit for people storing and saving in Bitcoin. And I think also market structure will be important for clarifying, it's pretty well understood that Bitcoin is a commodity, but it is not well understood all of the different people that touch Bitcoin, exactly how should they operate, what are the rules of the road there. Right. And for public companies that are increasingly adopting Bitcoin treasury strategies, they want to know, Ming, I'm sure you appreciate this as GC, how difficult it can be knowing exactly who you're allowed to work with and who are the trustworthy custodians or brokers and sort of what are the rules there. And I think that market structure regulation will provide that sort of important clarity for the new corporate set of Bitcoin adopters, that they feel comfortable to operate and that they know exactly what the rules of the road are, so that if there is an attractive strategy for them, they can adopt it quickly.
It sounds like very much needed legislation, but it also sounds very complex. And I want to turn to Neil as a former SEC agency lawyer for just a quick minute on how you're viewing, I don't know, a timeline or complexities around implementing things of this nature.
Well, I guess I'll be the panel pessimist, or as I like to think of it, the realist around this. No, look, I think legislation will get done, but we have some indications of how this has been done in the past. After the financial crisis, we had the Dodd-Frank bill, which was going to regulate, banks and derivatives and some activities around funds, all of that stuff. It was an ambitious piece of legislation. It took 15 years to write the rules under Dodd-Frank. I mean, the SEC literally just finished like a few months ago. And so every time there is really ambitious market structure legislation is the beginning. It's a great beginning, but there's a lot after that. It's the tip of the iceberg. There is going to be years and years of rulemaking by the commissions, and some of it will be contested. It'll get done. It won't be done in a hurry.
Well, we could go on and on talking about this. Is very interesting, and I guess for those who are interested, maybe after the panel, we can continue that discussion. And we've been focusing at the federal level, but whenever I work with Dax on some of our Bitcoin-related initiatives, he's always reminding me that there are also states out there. And I'm just interested, Dax, and I'm sure the audience is interested in sort of this interplay between sort of federal law and what the states do. Could you comment very briefly on that?
Sure, absolutely. I mean, the strength of our legal system in the United States is that we have state and federal laws. And many issues are reserved to the states because the states are closer to their citizens, and they also provide an opportunity for, I'll call it like forum shopping, to attract different types of customers to their states. But I guess I hit three things. One is that we have the dual banking system. And one of the things, at least that I'm focused on right now, is making sure that in the haste to do federal legislation to clarify stable coins and market structure, that we don't leave the states out. I mean, many of the players that are supporting this ecosystem today are state trust companies from various states or state money transmitter entities. And so we need to take their skills into account and leverage their background. The second thing I'd say is that now that we have a bit of a vacuum on the federal securities enforcement side, we're going to see more of a focus on state securities law enforcement. That just because the SEC may not be going after somebody doesn't mean that the plaintiff's bar will not go after somebody based on state securities law, or that the state's attorneys general will not enforce their securities laws. And I want to just read a quote from the Attorney General of Oregon, where he said, they filed a suit against Coinbase recently, and he said, states must fill the enforcement vacuum being left by federal regulators who are abandoning these cases under the Trump administration. So stay tuned on the state side. And then lastly, just Bitcoin specific, we have a number of states that are adopting kiosk laws that are meant to protect elders and prevent abuse at Bitcoin ATMs, kiosks. And so in those situations, we really do need to balance consumer protection and innovation. And this gives an opportunity for states, some states to take a more liberal approach and some take a more conservative approach.
These ideas are not only significant and complex, but this interplay between federal and state is very interesting. I do wonder whether, to what extent preemption will occur on certain topics. But we don't have enough time to go deeper into that, but it is fascinating. I do want to spend sort of our last several minutes pivoting over to Wall Street. This is not a topic that this regulatory panel has addressed in the past, in large part because it just never got to a point where there was enough warming up, we'll call it, on Wall Street for crypto-related companies. But that's happening. It may be happening somewhat slowly still, but it's happening. And we have Brittany here, who works a lot with banks and capital markets. And I'm very interested, and I think the audience would be too, in hearing, Brittany, what you're seeing and hearing among companies, clients out there about doing something similar in the way of a strategy that we have, right? And if they're seeking to access, the capital markets under this changing environment, sort of how would you recommend them thinking about that?
Yeah, and I think this is anybody who's interested in following a strategy for your business, right? This is why you came to this panel. which is how do you access the capital markets and what's the regulatory environment like if you want to access the capital markets? And the short answer is it's never been better, right? The SEC is commenting less. Companies that I worked on the CoinCheck de-SPAC, it took 3 years to get that through the SEC with, getting back comment letters with 60 comments, 45 comments after 5-6 turns, right? That's a very clear signal from the SEC about what their position was on crypto-related companies, right? And now you've just seen it go back to a normal comment process with the SEC, which is great because the question I get asked the most and where I've been spending the most of my time, and in fact, an hour before coming onto this panel, I had 2 companies reach out, is they want to go public because they want to follow the strategy playbook. And how can they go public quickly? And the short answer is there is no quick way to go public. There's lots of options that we talk about, and there's pros and cons to each. There's an IPO, there's a direct listing, there's a reverse merger, there's a de-SPAC, right? But there is no shortcut to going public, and it's going to take some time. And everybody right now is in a race to become public to follow the strategy. And you generally see it kind of 3 flavors of companies, right? You see companies that are more like strategy where they started out with a non-core crypto business, a software business, a manufacturing business, and diversified and followed a strategy playbook. Then you see companies that are natively crypto that just see this as a continuation of their crypto strategy. And then you see companies that are natively crypto that want to kind of deviate on the strategy. So I'm loving the new name and the puns, but that want to deviate and that want to try to do it with other digital assets. Here's why it's hard. It goes back to what Connor said about the market structure legislation, and he talked a lot about crypto assets being commodities versus securities. Why do you care about that? Well, Bitcoin is very kind of more firmly in the not the commodity category. And what does that mean for you? One is you worry about becoming an investment company, or you should, if you're not following a Bitcoin playbook. And if you become an investment company and you aren't registered as an investment company and you aren't doing all the things you're supposed to do as an investment company, then all of your contracts with every counterparty that your company has become null and void. So that's a pretty significant ramification of that. Because Bitcoin is firmly in the commodity category, you don't have that concern. I say firmly, but there's not as good guidance as we like. And the second reason why it matters is because when you go public and when you start to do capital markets offerings, counsel will have to issue an opinion saying that you're not an investment company and to the banks, your underwriters. And the banks take that to the bank. It's incredibly important for them, again, because of the really significant consequences of being an investment company. So even if you're maybe considering an ETH play, which is probably not a security, there's not as good guidance on that on ETH, and so you're probably not going to be able to find a law firm to give you the opinion that you need in order to follow that playbook. Whereas for Bitcoin, there's a lot of law firms out there that will feel comfortable giving you that opinion, which is a prerequisite. You cannot access the capital markets if you don't give that opinion to the banks. So it is a prerequisite to that. A few other things to touch on. One is Michael mentioned in his keynote yesterday the concept of a seasoned issuer. Why does that matter? If you've been public for 12 months, you can essentially do deals without going through SEC review, which was really important when we advised strategy on the Strike offering, right? We did Strike without SEC review because strategy was a seasoned issuer. They're actually a well-known seasoned issuer, which is even a step above. But we won't get into those details right now. And Strike, again, is an iteration of the common stock playbook that they had been following, where Strike provides, upside protection, because if the common stock price increases, then you can convert your preferred into common stock. And if it decreases, you get an 8% annual dividend, which is why I bought Strike. So there's a lot of good reasons to be a seasoned issuer. And if you're looking at acquiring a public company, which, this is a topic that comes up regularly, a lot of these public companies that are cheap, they haven't been keeping current with their Exchange Act filings, which means if you buy them, you've got to wait 12 months until they correct that, and wait 12 months from when they correct correct it in order to access the capital markets. In my mind, whenever companies say, let's talk about a reverse merger, let's talk about a de-SPAC, I'm like, just go with a traditional IPO or a direct listing, because that's more tried and true. And I think we'll actually end up saving you time in the back end. But happy to talk more about that, after this panel.
Can I just comment briefly?
Go ahead.
That Bitcoin moves in dog years. And so I guess just to note, just a market dynamic, that because of that timing element, corporations that have Bitcoin or other crypto reserves are looking at the public company acquisition strategy, right? So there is a timing element there. Lots of hair on that topic, but time is the one thing that this industry has never had enough of.
I see we're going to be running out of time soon, and I want to fit in at least one more question that relates to Wall Street, and that is that in our own experience working with banks, there is a lot of bank hesitation from the compliance and legal side. You made some reference to sort of the Investment Company Act opinion and things like that. What is it going to take for the really big banks, the bulge bracket banks, to embrace crypto? And that's, I guess, a question for Brittany.
Well, I spoke earlier about the changing regulatory environment, but the banks, they're gatekeepers. And they are essentially a proxy for the SEC and other regulatory agencies. When my partner Greg and I worked on the Spotify direct listing, one of the potential paths we were considering that we thought about was doing a deal, potentially without an underwriter. Right? And the SEC said, well, we don't really like that, because the underwriters, they, add value and help ensure that disclosure is accurate and, and informs investors. There's a meeting of the minds between the banks and the company and disclosure. And so because the banks, that's just an example of how the banks have a gatekeeping role. And so because of that, and the banks are also the first to get slapped with fines and penalties if something goes wrong. So the banks are hesitant and a little bit slow moving, especially the bulge bracket, to adopt something new. And I think that's a good thing. Overall, that is a good thing. You don't want, some of your biggest banks in the world taking risk. And I think, as long as there's predictability, and that goes back to legislation, right? Right now, what we have is a kind of ping pong. If there's a Democratic administration in place, you swing far to the left, and if there's a Republican administration, you swing far to the right. And it didn't used to be like such a huge pendulum shift. What you need is predictability. That's what legislation provides. That's what will help the banks get into the crypto business.
Well, thank you for that. I see we're out of time based on the clock down there. I want to thank our panelists. There are literally, we could go on for hours on these and other topics. And so if you do have any questions, find us after the panel. I'm sure all of us would be happy to speak to you. But thank you very much for your time and your attention.
Thank you.
I think in the future, every company is going to have a director of Bitcoin advocacy and strategy. And you need a certain level of energy, you need a certain level of laser focus, and our next speaker has just that. I'm pleased to introduce Ed Julien, the Director of Bitcoin Advocacy at Strategy. He leads initiatives to advance Bitcoin adoption and education within corporate environments, and he's been a Bitcoin enthusiast since 2011, bringing over 25 years of experience in disruptive technologies to his role, focusing on bridging the gap between early adopters and the early majority in the technology adoption lifecycle. His mission is to find ways for Bitcoin to cross the chasm of the technology adoption curve from early adoption to the early majority. We're not there yet. Before joining Strategy, he was Director of Institutional Sales at the Bitcoin Conference, and he's also a contributor to Bitcoin Magazine, where he addresses challenges in Bitcoin's mainstream adoption, including marketing hurdles and ideological divides. Ed is a frequent speaker at conferences and industry events where he shares insights on integrating Bitcoin into corporate strategies, and his work emphasizes the importance of education and strategic communication in promoting Bitcoin's adoption across various sectors. Welcome, Ed Julien.
that was an embarrassingly long intro. That was totally unnecessary, but thank you. Let's all thank Natalie for being our, get back here, for being our host this weekend, or these couple days. Natalie's got her book coming out in August?
November.
No,
Thank
November. Do not buy a copy. Buy 10 copies, okay? And give it to your aunt, your grandmother, your cousin. Does anybody in their neighborhood have those little boxes, you know, take a book, leave a book? Stuff those full of her book. This is gonna outdo Bitcoin Standard. This is gonna be the best Bitcoin book out there. It's for the early majority. November, lots of copies, every Christmas gift, Natalie's book. Thank you very much,
Kind.
Natalie.
Thank you so much. Thank you, guys.
All right, well, I promised everyone who would come to my short talk, Bitcoin, free Bitcoin. I did a proximity zap on Orange Pill app. If you have Orange Pill app, you've been given 210 Satoshis. There's your free Bitcoin. So thank you all for coming to the conference. How did it go for everyone? Pretty good? I urge you to go into the app where we have a commentary rating section on all the sessions. Find the session on the Strategy Bitcoin Hub, 5 stars, 5 stars, wonderful presentation, but please comment on all the sessions. I did get the shoes for $300. My wife, who's watching, said I couldn't get them, so I do need to sell these. Before the end of the day, they're $500. I'll get them signed by Saylor, $2,100. So thank you very much. With that, I need the clicker. All right. So I joined Strategy 5 months ago. Like she said, after working at Mara, I got into Bitcoin pretty early, but then decided, hey, I need to give back to Bitcoin as well. And when I saw this job and got the call from Sharish, I was like, wow, this is like, you know, going to play number 10 at Real Madrid. This is the best job available. So I'm going to talk about the Strategy Bitcoin Hub, which was the vision of the management team, the executive team at Strategy to say, you know, how can we give back? There we go. Nope. Shoot. Which one are we on? Sorry. Can we flip it? There we go. And no. And there. Okay. So I'm talking about the Strategy Bitcoin Hub that we've established in Tysons, Virginia. Like everything we do, we said, well, this is going to be the Hub B. When you come to the Hub, there's the big stickers on the windows. We call it the Bitcoin Hub. It's a little different than the other Bitcoin Hubs you see maybe in Austin or in Nashville. It's in our corporate headquarters. We have a floor open on the building. It's about 140 desks. And so we said, let's give back to the Bitcoin community by offering this office space to Bitcoin developers, Bitcoin companies, Bitcoin entrepreneurs. So very traditional office space. We have our lounge. The beer tap's open at 5 o'clock. We've got this amazing gym, conference space. We have a pretty rigorous interview process that we go through to make sure that, you know, you're actually dedicated to Bitcoin and giving back to Bitcoin, but it's something we're very excited about. Why did we create it? Well, we wanted to position Strategy as a beacon for corporate adoption, create a physical place where Bitcoin builders and advocates and startups and companies can come and not have to worry about that expensive office space, but, you know, also anchor ourselves as a leader in corporate education, networking effects around Bitcoin, maybe not only in the DMV area, but also, you know, worldwide. We've had a couple, I call them kids, sorry, I can't do that. A couple young guys that actually moved from Austin. They packed up their car and they drove, and now they're going to be living in the Tysons area because they want to be part of this hub. The hub is enabling knowledge exchange. We have curated events, lunch and learns. We were able to have Joe Bryan of the Big Red Button. We had Alex Gladstein in. They're always excited to come to Strategy to do a lunch and learn, not only with our employees, but the members of the hub. We're trying to build community with not only the internal teams, external partners, the guests we have in. We're trying to activate the local ecosystem by supporting Bitcoin companies, builders, and enterprises. Showing brand leadership through our Bitcoin first and only identity. And then it's what we call proof of commitment. It's more than just a press release. It's like, hey, this is really a place where you're going to have a commitment to Bitcoin in a corporate setting. So what would success look like for this hub? Education and advocacy. You know, we want to host monthly events. DC BitDevs, which had kind of died off because they couldn't find a place to host it. We host in our lounge every month. We get about 50 people in there that go way over my head every time, and then you get about, it's like drinking from the fire hose with bit devs, and then every time you learn a little more. And we're also, as is mentioned in a couple other presentations, internally onboarding and continual learning for the strategy employees. It serves as a front door for enterprise Bitcoin engagement through our strategic partnerships through different partners, and it attracts collaboration with whether they be custodians or fintechs or policy influencers. It's saying, hey, we want to partner with you, let's do it through this hub environment. So our goal for the year is probably to select and support about 30 high-quality residents by year end. We currently have about 20. Some of them come in every day. Some of them are coming in once a week. We've got everything from a Bitcoin PR firm to some guys that are doing sustainable Bitcoin mining on a chicken farm, to the guys that moved up from Austin that are building a Bitcoin-based stablecoin. So it is the wide gamut of people that are saying, you know, I build something in Bitcoin and, you know, this helps me out. And we want to provide mentorship, networking, and visibility where applicable. We also want global visibility. You know, we want to position the hub as the premier example of corporate Bitcoin stewardship. And of course, the media engagement. We had our kickoff party on April 29th where Saylor came and Phong and Saylor did this amazing motivational talk about why we're doing it, and 100 of our employees were there, and so it just shows our commitment to what we're doing at Strategy. So if you know anybody that is interested in joining our hub, we're going to be launching a second cohort probably end of July. You just go to our website, click up there on network and then hub, and you apply. If you are a billion-dollar company, please do not apply to join our hub for free office space. If you are looking to get your work visa to come live in the US and you want to work at Strategy, that's not what this is. You know, you don't even have to read the fine print, read the big print, right? It's, this is very specific in what it is. So with that, I'm happy to talk to any of you about the hub if you have questions or you know, want to know more before you apply. But the big announcement, I guess, which isn't too much of a secret, is our 2026 conference, Bitcoin for Corporations. This is the 5th one. The first 2 were online, but this will be the 4th. 2026 will be the 4th one in person. And February 23rd to 26th at the Wynn in Las Vegas. QR code, $795. I get 10% of every ticket that's sold in the next 20 minutes. No, I don't. Yes, I do. Feel free to go to our website, use the QR code. It's not hard to find on the website. $795 is a pretty cheap ticket. It'll get you signed up for February. We're excited to see you. We'll be doing this bigger and better, as you probably picked up over the last few days. This is not a subject that's going to stagnate here. I expect to see some much bigger names, much bigger companies. And so this morning, I thought, well, how can we represent what's going to happen in Vegas? And of course, you have to go to LaDozier and say, LaDozier, I need you to imagine. Is LaDozier in the room? Ah, bummer. Okay, so I said, LaDozier, I need you to imagine, you know, what do you picture happening at our conference in 2026? And that's what he came up with. He had the Berkshire Hathaway motivation. He thought the true north, and so I'm not promising this. We can't get an arena, but this is where we're going, guys. This is going to be something that you're going to be able to say, I was in a tiny little room with round tables, and now there's 20,000 people in the room talking about corporate Bitcoin adoption and treasury. So with that, thank you very much. I don't recommend that you leave your seats because you won't get them back in about 15 minutes here. How are we doing on time? Yeah, in exactly 15 minutes. Please be back in the room because we're going to lower the lights and do fireworks and lasers, and no, it's not that big a deal. But we're going to have Phong and Michael and the guys from True North up on stage, and it is going to be fun. So got about 15 minutes. Don't lose your seats, but be back in the room. We want to get these doors closed so they're not clanking all the time. Thank you for coming to the conference. Please go into the app and comment on the sessions. And we look forward to seeing you in Vegas. And let's get fired up for 4:15. Thank you very much.
Please return to your seats. The 2025 Bitcoin for Corporations will resume shortly. Please return to your seats. The 2025 Bitcoin for Corporations will resume shortly.
Crypto.
If you mean crypto like Bitcoin, I've always said it's a fraud.
I do think it's worth looking at this crypto thing a little bit, only because it is a deeply, deeply old-fashioned, simple scam at this point.
Describe it as a Ponzi scheme?
Yes, it's a Ponzi scheme.
It's a Ponzi scheme.
Sell my Bitcoin right into this rally.
I care less what Bitcoin trades for, how it trades, why it trades, who trades it. If you're stupid enough to buy it, you'll pay the price for it one day.
It's like when there was the Beanie Baby craze in the late 90s.
MicroStrategy's entire business model is a ticking time bomb.
If you're willing to take a risk in crypto at this point with MicroStrategy's ticking time bomb ticking underneath you,
more money they can raise and then buy more Bitcoin, like a flywheel effect. That's
There's
insane.
a lot of fraudsters and hucksters and scam artists.
Volatility is like fire, and some people run away from the fire, but Henry Ford put the fire into a carriage via an engine, created an entire industry, and he gave humanity wings.
MicroStrategy adding to its Bitcoin hoard. Nobody right now is rattling the cages of traditional Wall Street more than Michael Saylor.
We beat every single company in the S&P index.
MicroStrategy still buying Bitcoin amid the token's record run.
GameStop is considering investing in Bitcoin.
Bitcoin's been a wild run, and boy, have you been right.
That's the brilliance of the engineering. Can a human being make something that other humans can't corrupt?
please welcome back to the stage your host, Natalie Brunell.
Wow, that just gets you fired up, right? And we still have so much work to do when it comes to mainstream media. That's the world I come from. I am so excited to introduce this fireside chat with the MSTR True North community and two visionary leaders. But first, I do want to share a little bit of a personal anecdote that's very relevant to this, because strategy has empowered so many people and families to truly achieve financial freedom, to retire early, and to grow their families. And I actually have two friends from high school that attended this conference this year. I will not share their names. I'm going to protect their privacy. But they said that some of my earliest interviews with Michael Saylor helped them gain conviction in strategy to make that their primary family investment. And that has allowed them to have the financial security and the flexibility to expand their family. So not long ago, they had their third, fourth, and fifth children. So we're gonna have a strategy baby boom. And I know, hey, population growth, right? Yeah. So this company is truly changing lives. It's empowering companies, it's empowering families, and what an honor to be at this event that's honoring all of that. So without further ado, I would like to introduce Jeff Walton, Tim Kotzman, and Ben Workman, who are the driving forces behind MSTR True North, a leading platform dedicated to analyzing Bitcoin treasury strategies and corporate finance innovation. And of course, they really need no introduction, but the visionary, the superb, the superior, the brilliant Executive Chairman Michael Saylor and CEO Phong Lee. Please welcome them to the stage.
We are back. Woo! We are on stage here with some of our favorite people, and we are excited to share an hour and ask a few questions and really dive into things a little bit more. So this is the first time we're actually on stage with Michael and Phong, and man, look at all the people in here. Wow, holy cow. All right, this is exciting. So maybe we'll just kick it off. A quick question over to Phong and Michael. So over the last couple of days, you've talked about this digital transformation of investor relations. And prior to what we're seeing today with this community, the investor relations page was the most boring page on a company's website, right? Nobody ever went to the investor relations page. Nobody went and scoured all the documents, but now people are. And people are because we're talking about it. We're talking about this evolution of in equity and how a company can be formed. So I'd love if you can expand on this concept of the digital transformation of investor relations and really kind of dive into that a little bit further.
I can start. The funny thing, and I think Eric Semler talked about it yesterday, about being a zombie company and a company that nobody's interested in. I had mentioned yesterday we had 40 investors on our earnings calls, 10 of which were employees and board members. The other thing is we had no investor relations person. I was the CFO and I was investor relations. And I remember talking to investors and like, you should really hire an investor relations person. And I was like, to talk to 30 people, it didn't make a lot of sense. And Shirish Jodia we hired in 2022 to be our first head of investor relations. And I still remember we had two people who were our final candidates. And one person was a really nice, super guy from Texas who'd done investor relations for like 15 years. And he had zero knowledge about Bitcoin. And then we had Shirish, who hadn't done investor relations for very long. I think it was like 2 years or so for a local energy company. And he's like, I love Bitcoin. I sought you guys out. I looked you up. I like, this is my job. And of course, Shirish got the job. And then we realized after that, Mike went from like 50,000 X followers to 1 million to 2 million to 3 million, got a huge voice. And we realized that was really the next digital transformation of investor relations in 2023 or so, was to use our X handle Because when you have a story that's extremely misunderstood by traditional finance, you need an amplifier outside of traditional finance. We need an amplifier beyond just sort of the way you would normally do things. And so the X handle was the next big sort of really digital transformation of investor relations. And then the biggest gift beyond that is everyone started producing content that we didn't even know we needed, right? Like charts were being created, videos were being created, 10 p.m. sessions of people talking about strategy for 2 hours on end are getting created. And how else do you amplify an organization of 0 IR people to 1 IR people to 1,000 to 1 million? This is the way to do it, and it's just fantastic. And you realize that all of that is because we tapped into the zeitgeist of Bitcoin. And Bitcoin is what caused the digital transformation capital, but of investor relations. There's no better way to do investor relations than this way. And it makes so much more sense than sitting and talking to, in a converted hotel room at a non-deal roadshow with 4 Harvard MBAs, sorry, CJ, that asked you questions at the age of 27 about your business and want to steer you to go do something like they understand software. That's not investor relations. This is investor relations.
I think we benefited, we were catapulted into a digital transformation by COVID and by the crypto community. And I gotta say, we were taken there kicking and screaming. And maybe that's the only way you get there, but as Phong said, the 20th century way to do things is you go meet people face to face. I remember I've spent 1 month flying around the world, and like an entire month of my life, $1 million of travel fees in order to stand in front of 100 people in a room 20 times. And basically deliver a 1-hour message to 2,000 people cost $1 million. And that was, quote unquote, best practice in the year 2018. So something profound happened. And when the lockdowns came, you don't get to travel. You don't get to meet face to face. And then you have to do remote. And then you have to embrace something like Zoom. And we used to have, Phong's being generous. I remember, okay, I'm going to tell him myself here. I went through a phase when I just decided I was kind of a little bit irked with the investor community, so I canceled conference calls and earnings reports for 10 years in a row. There's a period about, like 40 quarters where we didn't do an earnings call. And then there was when we came out of that phase, we had a lot of goodwill with our investors, obviously not. And then the best practice was sit in a conference room with one of those like speaker phones, and we'd all look at each other and we'd punch the speaker phone and we'd dial in, and there were like 19 people. I remember 19 to 20 people being on the call and one of them being an investor. And the other 19 working for the company. That was my recollection. There might have been a couple. So we had that dark period, and then COVID came along and the lockdowns hit, and we went from speaker phones to 3 different video conferencing things, and then we landed on Zoom, and then we started to have Zoom meetings, and then we tried to have an employee meeting. We realized we had to have the employees join online with a webinar, and so we discovered webinars. Then we thought, well, if we're going to have 1,000, then we started trying to figure out how to sell things to customers, and we had to do that. And so we were forced to adopt technology for customer activity after 2020. And once you get there, it's a hop, skip, and a jump to, well, if we're going to do Zoom webinars for customers, then why don't we do a Zoom webinar as an earnings call and put the video on it? And we evolved from there eventually. And I would say we were catalyzed by COVID. We had to do that stuff. And then, of course, we needed Bitcoin. We found Bitcoin because of the war on currency that came with the war on COVID. And then after that, we were all of a sudden in the arms of the Bitcoin community, and I'm going to say crypto too, although people don't always love when I use the word crypto, but you know, we're rehabilitating crypto. It's going to be a better word going forward. And the learning from that is this. Everybody in the crypto community was launching these tokens, and they were doing investor education on tokens, and they had to do them via YouTube and via Twitter. And so when I got involved with Bitcoin, I saw all these YouTube podcasts, and you would see all the Bitcoin podcasts, but you see every kind of podcast, and then you started seeing all these crypto influencers, and they're reporting on, you know, their favorite crypto token, just like it's CNBC in real time. And, you know, some of them have 500,000 followers or more. So I started looking at what they were doing, and then we realized that you have to go do podcasts. And, you know, we started doing some of these podcasts, and we started posting. And I remember when I started posting, I was very clumsy. Everybody, when they first discover X, well, when they first discovered Twitter, used to be before it was X, everybody's very clumsy, and you do silly, stupid things. And I watch all the newbies come into space, and they don't tweet well, and I cringe, and I'm like, don't do it that way. And I remember Samson Mao, if anybody knows Samson Mao, great Bitcoin maximalist, you know, he took me under his wing when I started tweeting, and he goes, you know, Mike, you posted this, there's no social preview. And I'm like, well, Samson, what's a social preview? I'm like, well, like, there's no image showing up on your URL. And I'm like, an image on the URL? He says it's an ugly string of letters. So I got on the phone to my marketing people, like, what's a social preview? Put a social preview on the URL. And so when we got into it, we just started getting educated by the community. This is how you share. This is how you post. Like I even sit with executives today, and I'll say, okay, first you're going to go on CNBC. Then you're not going to not tell anybody. You're going to go on CNBC. You're not going to wait 2 days and post an ugly URL that links to a partial extract of you on CNBC. You're going to go on CNBC. You're going to get your talking points right. You're going to extract the video. You're going to put it in an MP4 file. You're going to upload the MP4 file. You're going to write this, right? You're going to post that, right? That's going to be seen by 10 or 20 times as many people as saw you on CNBC. And if they agree with what you said, they're going to grab the handle and they're going to message it to their boss or investor or board of director or whatever best friend and say, you got to check this out. And that kind of was like a 4-year journey to realize that you have to articulate the message. You have to put it on the channel. I remember we got on YouTube, and I would do this interview on YouTube, or someone would interview me on YouTube. And first, I didn't know what I was doing. And then I got lucky, and then I got things like the Lex Friedman podcast. And Lex interviewed me for 4 hours, and then he posted it. And it runs like 10,000 times a day. Like the residuals are 10,000 people a day spend 4 hours with me listening to what I have to say many years ago. So you watch that. And then you watch people, they'll post things, and I've seen them, they'll interview me on Bitcoin, and they'll post, world coming to shattering end COVID problem, yo-yo dying. I'll call them, you know, that's going to run better if you put my full name in the title and something Bitcoin, because Bitcoin really works well with the algorithm, and my name will work well with the algorithm. And so I think I went from, I was never on YouTube, I was never on television, I didn't think to post, to stumbling around and making all the rookie mistakes, to starting to learn a bit, and then realizing that the real power is articulate your message, make it easy to consume, put it in different formats. Some people want 30 seconds, some people want 5 minutes, some people want 20 minutes, some people want an hour. And whatever it is, give them the handle, because what will happen is 9 months from now, they'll want to send it to 97 people. And if they can do that in a couple of seconds, your message will spread virally. And don't make it hard, make it easy. Like when you write a paragraph, think people will read the first sentence. When you write a sentence, think people might read the first 3 words. When you write 3 words, obsess over the punctuation of the 3 words, right? That's how I think now, right? And I didn't think at all like that before 2020.
When you think about your equity, and you guys really did something special when you embraced volatility in the market, but when you have a lot of investors, that's often scary for them. It used to always be equated with risk. And one of the big themes that we've seen from the retail community as we've been talking to everybody in the hallways here is that the constant education and the messaging that you guys do empowers the retail community to amplify it further and build conviction. So we've been playing around with the concept of retail being a partner in what we're calling conviction as a service, where you guys enable us with enough information that we can distill, and then we can find ways to communicate that out further to other investors who might be starting from different points in their journey and investing and understanding a type of equity like a Bitcoin treasury company like Strategy. What have you guys seen along the ride as your equity is taking these volatile swings? And I'm sure you guys are seeing all the noise on social media, but what I hope you also see is the people that are the calming voices out there trying to help the retail community understand why they're in this in the first place and what it is that makes this so special. How do you guys see that emerging as kind of a strategic advantage for what you guys have built with your retail community?
You know, it's not lost on us that we hold a 2 hours earning call, and 2 hours later, you know, Jeff gets on X and does an hour and 20-minute dissection of our earnings call and does a pretty darn good job. Because what actually happens in between that is we go and talk to all of our coverage analysts and we do callbacks, right? And we, you know, have a collaborative relationship where we share with them our message, distill it, and they go write reports. And a lot of those folks are here. We appreciate the coverage analysts, of which we used to have one, right? Literally one who had a sell rating on us when we started this journey. And now we have, I don't know, like 15, 12, 13, 14, 15 who all have a buy rating on us. And they do pretty good work, and they publish out these reports. And I would guess maybe 100 or 1,000 people read these reports the next morning. You go, don't talk to us, right? Do a dissection that is pretty darn awesome that evening. You know, you could probably, I don't know if you have a wife and kids, you could be doing something else, but you're so passionate about Bitcoin and about strategy. We don't pay you, we don't ask you, you don't ask us. And, you know, it's awesome work. And you get 10, 15, 20,000 people that watch it that night. And it's awesome. I mean, and so, yeah, like there is the structural relationship, and there is the unintended relationship. And the unintended relationship is 20 times better, 100 times better, 1,000 times better. And I do think it's a calming voice out there amongst FUD, but the FUD has decreased. And so, like, this is the way it should work, right? And more people who do this work, and you do it because you're passionate about the company, right? I think it's awesome. I think it's really cool.
I think I'm inspired, you know, by, I mean, the early juggernaut in my career was Microsoft, and the late juggernaut in my career is Bitcoin. And if you're looking for a commonality, it was Microsoft made room for their partners, and Microsoft was successful because just about every techie company on the world, on Earth, could build something, build a product, build a service, and work with Microsoft. So they made space for the partnership, and they respected their partners. And I think with Bitcoin, right, the success is it's decentralized, and everybody can choose to engage with Bitcoin in whatever depth, technically or economically or intellectually they wish to. And I think that's informed us. So as we built our company, we wanted to make space for our partners and create a community, and it's very, very clear that we can't do everything. Like the best marketing isn't done by employees of our company. The best education is done by our customers on the product, by our investors on security. And you just see, endless examples of that. I used to tell our investors on the road shows, I said, our objective is to stay in our lane. We're not going to compete with you. We're not going to do it if you can do it. We're going to do the things you can't do. So our job is to create the security, buy the Bitcoin, hold the Bitcoin, and do that in a credible fashion. You could almost say the most valuable thing in the market is credible, durable, high-performance volatility. And a lot of people have figured out how to create non-durable volatility or non-credible volatility, credible maybe non-transparent volatility, or low-performance volatility. But creating high-performance, transparent, credible volatility is what makes us a success. And when you understand that, you realize that there's a lot of investors who are very long 30-day call options. And so they have a particular view. Their world ends in 30 days, and they want up. They're constituents of ours. There's another set of investors that are very short 30-day. They looking down, and their universe ends in 30 days. There are the out-of-the-money long call option people. There are the long-dated equity people. There are convertible arbitrageurs, and on any given day, they're either buying our stock hard or they're selling our stock hard, but we're in business with them. There are big people that hate Bitcoin, and whenever something bad happens, they want to put a short on it. They short us. And let me tell you, if you gave me a choice, would I rather have them short my stock or short somebody else's stock when they're mad at Bitcoin? The answer is I'd rather have them short my stock. I never want them to lose faith in the fact that I am double long, and I want them to think that they got a 2-for-1 short. So you got all these people out there in the community, and there's someone that needs to be told why it's a good idea to short our stock when you're hating on Bitcoin. And there's someone else that needs to understand how to sell volatility, and somebody else wants to buy the volatility. And you have the long equity investors, and then you have preferred, and you have convertible bond investors, and then you've got the options traders, and you can never forget, for everybody, you read a lot on X about people trading options. For them to trade the options, someone at Susquehanna or someone has to create that market. So there's a market maker creating that. And it turns out that, there are incredibly powerful forces in the market. They're all doing their job, and they're very good at it. Right? Like, you want to know how good they are at it? Just take a stock ticker out, take a Bloomberg or take a TradingView or anything, and then put on your screen Bitcoin, IBIT, MSTR, and track it minute by minute, second by second, and watch the correlation and ask yourself the question, who's making all those things hop? Like in synchronicity, amplified in a certain way. And I think that the point really is, you think you know the investor, you don't know you think you understand how the market works. You don't, right? The point at which you understand when you realize you don't understand. Like the market's much bigger than any of us. And so the takeaway from that is humility, right? you have to allow for lots of participants. It's a highly decentralized market. There's so many conversations going on every day in every direction, in all polarities, right, in all languages everywhere in the world. Yeah, you know, the company could never hope to be able to meet every need. And, you know, our bias, Phong and I, our bias is naturally going to be long the equity, you know, with a secondary objective of making sure all of the credit instruments are fairly valued, right? That's how we think. Fair to the credit counterparties, but our job is to make MSTR go to the moon. That's how we think. But, and here's the conundrum, for us to be successful, we actually need people in our ecosystem that don't believe any of that stuff and have the exact opposite point of view. They're the ones making the market on the other side of the trade. And what I learned early on in my career is the fate worse than death in the capital markets. It's not for them to hate you. It's for them to be disinterested in you.
So Bitcoin started as a peer-to-peer network. It is a peer-to-peer network, but it's also now becoming an ecosystem. It's an ecosystem full of Bitcoin treasury companies, lots of vendors and service providers, ETFs, other products. And the retail audience is definitely picking up on this and tracking it and amplifying it. How helpful is that, and where could it go over the next 3 to 5 years?
I think great ideas spread via word of mouth. And every retail investor, no matter how much or how little money they have, is no more than one step or maybe 2 steps removed from someone running a public company or someone running a multi-billion-dollar portfolio, or, you know, or someone running a state, or someone running the cabinet, or a country, or a cabinet department. You know, I walk into a hotel and, like, you know, a 20-something guy will walk up to me and say, "You have to talk to my father," and his father turns out to be a mega billionaire, right? And he's the retail investor, and his dad's not invested. But I have to tell you that all these retail investors, they're all indirectly or directly driving our culture, and of course, all it takes is maybe 2 iterations before you've gone from insignificant to being 20% of the market. And then once you're 20%, it's unstoppable. The entire world flips. So I think it's incredibly important, not to mention the fact that it's refreshing talking to retail investors because there's a certain honesty and candor and enthusiasm. So I guess asking, and they bring out your best performance. Take any rock star and ask them, would you rather play to a music festival full of 20-somethings, you know, a third of which are jobless? Or would you rather play in a nice, elegant tent of a billionaire at his charity ball for 300 of his rich, elite friends? And the answer is, they would do that one for free. And this one, you have to pay them quadruple. And they come in and they get off the stage, right? And so I think we do it for the people, the masses, right? You're not going to change the life of the institutional investor. You're like 2% of their portfolio allocation going to 200, up 20 basis points, and they've been trained to be very, very measured in their communication. But when someone walks up to you and says, "Hey, you changed my life. I retired. I bought a house. I got married. I had a kid." You know, you meet someone, they say, "Yeah, I was able to move to the Caribbean and I lived there permanently because of you," right? That's much more motivational, I think. So if you're saying, like, why do you do it, right? Well, you do it in theory to make the world a better place, but, or, you know, you like to make people money, but you really like to make retail investors money because it's their money. Whereas when you're making the institutional investor money, it's going through 3 layers before it eventually ripples to a nameless, faceless, institutional, whatever organization. It doesn't have the same emotional appeal.
I mean, I'm surprised more public companies haven't embraced social media generally, and X specifically. Right? It started with athletes and musicians, said, well, I want to get out to my fans, and rather than go through a publicist, I'm going to go direct to them. And technology provided a way for do that. Politicians, rather than going through a PR person, said, I'm going to reach out in a public town square, like they used to do, and go talk to their constituents. And what better way to do that than via social media? It's the same concept with investor relations and corporations who are really funded by the trust primarily of retail and institutions. Why wouldn't we get out to our retail shareholders via the same avenue and skip and bypass the middleman? And the answer, the reason why more aren't doing it is because of friction, concerns, risk, legal, because it makes total sense, right? And it's not even just in a Bitcoin community. I think if you want to access your shareholders, this is the way to do it. And Mike's right, it just feels so much better. Like, trust me, like none of our institutional, like, you know, holders, and they're awesome, are coming up to you at an event with their wife or husband and saying, you changed my life. No one's saying, I was able to have more kids because I invested. Like, nobody on the institutional side, and that's just, yeah, it makes you feel good. It's inspiring. Why wouldn't you do that? And I'm sure that happens to athletes and marketers and influencers and politicians. It's such a great forum to get outreach to folks, and Bitcoin amplifies that. But you know, you ask this question, like, I love what True North is doing, the digital transformation of investor relations. Like, yeah, our advice number 1 is buy Bitcoin and put it on your balance sheet to any corporation. But if you're not going to do that, at least use social media to get out to your investors. Like, why wouldn't you want to do that? And as a retail investor, why wouldn't you want to see the raw representation of the executive team that you're investing in versus the extremely filtered, curated, prepared remarks at, you know, Mike's got some guts here, right? Like, when I joined in 2015, I still remember, right, like I was CFO and IR guy, so I wrote the earnings script and I would read the script that said basically nothing. And Mike would just go ad-lib the thing, which people don't really do. And then I remember once we were like, hey, Mike, I'm gonna give you some bullet points. And he was like, okay, yeah, I'll take your bullet points. He went completely off script. And then after that, I was like, well, I'm gonna just write you something. And he didn't read any of it, right? But that's sort of how this should work. Like, you don't really want to hear the scripted, prepared remarks that were recorded 1 week in advance to the earnings call. That's not a investor relationship, right? You want to hear the raw remarks, the raw emotion, and that's what the retail investors want to hear from someone they're going to put their life savings into. I think it makes complete sense.
So, you guys have created these new novel products that the market has never seen before, right? Strike and Strife, and people are beginning to see the value of these products. And you know, we've been trying to track what's going on there and how these can potentially change the world of finance. And so I've kind of got a 2-part question. What can we as True North do, and what can everybody else in this room as an audience that's kind of experiencing this do to help? You know, where can this potentially go? What do you see this looking like in, you know, 3 to 5 years? How does it change the world of finance so we can, you know, get there?
Yeah, well, I would say a lot of the energy in the Bitcoin community has always been about how do we fix the money and how do we explain to people why Bitcoin fixes the money. And I think that's been going on for 15 years, and there's an incredible amount of really good content there. What people, I think, misunderstand about our mission at Strategy is we're not here to fix the money because Bitcoin did fix the money. We're not even so much trying to convince you that Bitcoin works. I think we've crossed that inflection point. I think when the President of the United States, created the Strategic Bitcoin Reserve, and when David Sachs says Bitcoin is digital gold, I think it became clear that the establishment has accepted the idea that Bitcoin works. We're here to fix the capital markets. And so here's the mission. The mission is $100 trillion worth of equity based on future expectations of currency derivatives, of broken companies operating broken currencies, or weak companies operating on weak currencies. And our suggestion is you can create new equity based on a sound money, and strong companies can actually grow those equities and compete against the Mag 7. That's hard to understand, right? So there's an entire world of equity analysis. How do you value a company based upon digital capital and based on sound money as opposed to based upon traditional 20th century business techniques? And then in the credit markets, we want to fix the credit markets, and that's $300 trillion of credit instruments, bonds, preferred stocks, convertible bonds, sovereign debt. They're all based upon future expectations of cash flow of weak to failing currencies that are issued, securities issued by weak companies. Companies without assets, with weak business. Which companies do you think are there, right? There are weak companies issuing credit securities valued on future expectations of cash flows that are coming to you in a currency which is collapsing in value. They're not good securities. They don't yield much. The credit's not great. They're not liquid. They're sold in an antiquated fashion. Most preferred stocks, most corporate bonds are sold over the counter, one and done, short duration. They don't have tickers. You probably can't name a ticker, name a ticker for a corporate bond issued by a major bank in the United States. Now, major banks in the United States have issued hundreds of billions of dollars of fixed income instruments. You ever wonder why is it that a major bank has never issued a fixed income security that you can trade, right? They're sold through a sales force. How many things, they're sold through a sales force that's 50 years old. I mean, the idea is 50 years old. They're people. They have CUSIP numbers, right? There are numbers like something 199742. And then there's another issue, something 19743, and you can't get the quote unless you pay $25,000 a year to get the Bloomberg, and then you can get the quote, and then there's no market maker, and the spreads are 3%. And that's because why would you ever trade them? What? So that's the state of the credit market. And so we're not here to fix Bitcoin, we're here to fix the capital markets. Now, fixing the capital markets means going to people that buy preferred stocks that are illiquid, that they're holding, waiting to die, right? They're waiting for them to whatever expire, and going to those people, they don't even know they own the stuff, and they're getting 100 basis point spread above SOFR on garbage, and explaining to them how they could actually get paid 700 basis points above SOFR with a better credit instrument, right? And how is it that our converts can do 60% and the average convert index is 4 or 6, right? Go find, but the unlock is finding people that don't even know, that don't know converts exist. And then of course, the market, it's structured, you have the SEC 33 Act, the SEC 40 Act. You have so many rules, and when you decipher the rules basically just cripple the market. They cripple the market, they cripple the distribution channel. And traditional conservative or conventional actions cripple the securities. And so, what can you do? I think it's a educational campaign to the investors of the world to show them, there are more than 100 equities, or maybe you can consider more than the Magnificent Seven. Here's some new equities that can outperform the Magnificent Seven. Let me show you what they are. That's a renaissance in equity capital markets. And then there's a crusade. Well, here's some credit instruments that will give you yield for your retirement account, and they actually aren't risky. Not nearly as, you don't even know how to get them. You don't know they exist, but someone invented an electric flying car with a nuclear reactor in it. You don't have to refuel once in a lifetime. You can buy that. It's cheaper than the normal car. But someone told you that it's dangerous to have a car with a reactor in it, right? So I think that the rate at which the capital markets evolve, it's really a function of how rapidly ideas disseminate. And I think that's a function of just how adept and nimble and facile the educators are in the market. And I think there's an opportunity for everyone to get involved. And of course, the more people that get involved, and the more effective the education, the faster we transform the market. The question is, how fast can you grow? It's really a question of how fast can the capital markets absorb a new idea. And if there was one 60-minute podcast you could distribute that just solved it, then you would just let it run, but there isn't. There's a lot of work to be done in educating and helping people embrace new ideas.
As everybody knows, strategy issues equity at the market when it's proper to do so and accretive. Is a shelf necessary for success? I mean, we see Bitcoin companies, Bitcoin treasury companies coming to market in a fashion where they can't have a shelf for 12 months. Is a shelf necessary for success?
I think you can, if you gave me a public company that was a cash cow that couldn't issue equity, but it generated cash, it would have extraordinary success just sweeping its cash flows. Here's my list. I take a company, I take the cash on the balance sheet, I convert it to Bitcoin, that's a success. I take the cash flows, I convert them to Bitcoin, that's a success. I take the dividend, I convert it to Bitcoin, that would be a success. I take the buyback program, I turn it into a Bitcoin buyback program, that would be a success. I don't take the company private, but I do an LBO where I lever up the company, so I basically pledge the cash flows, raise private or public debt, buy Bitcoin, that's a success. I take a company that's got a slow growth business that's struggling, and they sell off that business or do an M&A transaction and take the proceeds and buy Bitcoin. You've swapped a zero growth business that you sell at 1 times revenue for a 60% a year growth business that you buy at 1 times revenue. Would you do that trade? Right? Yeah. You could sell this business, pay 30, 40% tax, and buy Bitcoin. You would still be better off by a factor of 100 over the course of a decade. So you can take a business that doesn't have access to equity, and you can do all sorts of capital markets transactions. If you're a private company, many of those things are also available to you. And of course, you can also work your way down the credit instrument ladder, where you could sell forward contracts of your products. You could sell a subscription to your product, roll that into Bitcoin. You could sell convertible preferred. You could sell straight fixed preferred. You could sell junk bonds. You sell convertible bonds. You could do bank financing. The world is full of people that found endless ways to do it. Warren Buffett, one of his secrets is he bought insurance companies, right? And insurance companies had investment portfolios, and then he was able to invest those portfolios in securities. Well, the trick is the operating company can't hold the security, but this insurance company, has like one layer, and they get like a waiver, and they get to invest in securities. So he found a very elegant way to grab a float, but the trick is not getting the float. The trick is being able to invest the float, right? And so what if you get control of one of those insurance companies and you reinvest the float in Bitcoin, right? And of course, there's a million compliance and regulatory issues you got to work through. But I can imagine 100 different strategies that you could pursue to sweep cash into Bitcoin, and a lot of product changes to the way you run a product business or definition of a product that would enhance the product. You could, for example, build an insurance policy where, you invest the premiums in Bitcoin and use it to increase the payout on the back end and grab market share, or you could cut the premiums in half because you're invested in Bitcoin and grab market share that way. And so what you can do is a function of what kind of company you are and what jurisdiction you're in and what kind of entity you're managing. But, again, Buffett showed you that where there's a will, there's a way. And, you have some people that kind of they want to do the simplest thing. They're like, well, I can only do this and this, and so that's what I'll do even though I'm going to fail. And there are some people that don't want to fail, and so they'll think a little bit more creatively. And, lest we forget, the greatest investor of the 20th century, his success story starts with buying Berkshire Hathaway, which is a failed textile mill. So it starts with a failure. And he just simply decided, even though it's a total abysmal failure, he's going to turn that into a shell company to become a great investor, and he did that. And I think that every single operating company in the public market is in the same situation now. Every private company is in a situation. It comes down to will. Do you have the will? And do you have the courage?
So I've got a really important question here. You guys did something very unique as a company, particularly at this conference, which is you took a bunch of people that streamed from their basements at midnight on a Wednesday, and somebody convinced you guys it was a good idea to let us have a room and host our own conference here. So first, whose idea was that? And then the second one, because you guys have become such fan favorites in the retail community, you might be the only person on earth with a personal digital artist around him. How weird is this for you?
I think it's definitely Fong's idea you're here, so you should.
We love you, Phong.
But it was my idea to retweet you. But we work like that, which very often the way it works out is I see something which I think is amazing, beautiful, extraordinary, compelling, novel, and I amp it, and he sees it, and he operationalizes it in the business. So all of the execution is him, and occasionally I nudge him, and then occasionally he has a good idea too.
Look at the idea of Bitcoin. A lot of these ideas, they sort of. There's a lot of gut instinct to an idea. Like when we decided we were going to do Bitcoin for corporations 4 years ago, I was like, hey, Mike, should we do this? And it's like, yeah, of course. It's not like there was this long debate of is it a good idea. When somebody came and said, should we let True North host an event within an event within an event, it might seem crazy, but it was obviously a good idea, right? Those are the easy ones. Right, like when Mike told me we should do Strike. Well, when Mike told me we should do Bitcoin, that took a little bit of work. Strike took less work. Strife took even less work. By the way, back to your question about how you can help more than you already have. I don't think people understand strife. And I don't mean how it benefits us, right? Which I think we've explained fairly well, and you've explained fairly well. I don't think the retail community understands the benefit of a 10% coupon bond that lives into eternity that you could buy in the NASDAQ, right? I have some neighbors down the street who are in their 60s or 70s. I haven't asked them, but they bought a house for $500,000 as an investment, and they, they cleaned it up, they redid the yard. We're pretty happy about that, and they rented out at something like $3,000 a month. And so get $36,000 a month on a $500,000 investment. I'm sure they took out a mortgage. Let's say it's about 3% or so. And almost every year, the tenants turn over. And when the tenants turn over, that house sits vacant for about 2 months. And when the plumbing doesn't work, the guy shows up and cleans, goes in there and fixes the toilet. Right? And anyone who's ever fixed a toilet before, it's not fun, but that's what he does, gives them something to do. And that is the traditional way for people, who have some wealth to make money off of their wealth. The other way is to get 2.5% on a T-bill, or the other way is to buy some mix of something that you don't quite understand. Like, go tell people, you basically, instead of doing all that work, the hobby of buying a house, because that's the traditional way to make money off of your money, go online, put STRF in, put 500, whatever amount makes sense, and collect your 10% forever. And I don't think people realize how novel an idea that is versus all the alternatives out there. Like that buying a house is hard. Renting it out is even harder. Maintaining it is even harder. There are many better ways out there now. And if you can help explain that to folks, right, that's a great option, in addition to the equity. And other companies should be providing something similar.
Yeah, on that subject, normally if you want, if you look at that instrument, you're paying like 600 basis points more than SOFR. Normally you want super high yield, you either have to take massive credit risk, you're looking at distressed debt where you're in anxiety, or you have to take a lot of credit risk on a short duration instrument that will be called or repaid in a year. With Strife, you're getting something that you could hold for 20, 30, 40, 50 years. You could gift to your granddaughter, right? You can hold it for 100 years. And if SOFR comes in, if interest rates come in, when you have a very long duration instrument, a 10 duration instrument trades up 20% when the interest rates drop 2%, right? And if it becomes more creditworthy, it could trade up 20, 30, 40, 50% when it drops, right? So there's capital upside on one hand, but the other thing is when you buy these other short duration things, when interest rates drop, the companies just refinance them, they pay them off, and you lose it. So it's very hard to find high fixed income yield in a creditworthy package that's transparent. And we don't need to I don't think we need another Bitcoin educator group, because people have been working on educating for Bitcoin for 15 years. And I don't think we need, maybe we can always do with some equity education, but the fact is $5 billion a day gets traded in MSTR. So it's pretty clear that it has massive awareness. The things we've done, I think, that you could feel it in Fong's voice, and me too, I think we're most proud of, are creating Strife and creating Strike, because we use the energy in Bitcoin and the volatility in Bitcoin in order to create one instrument, Strife, which is just a much higher grade fixed income for people that want it. Just a better, maybe arguably it's the best high yield product in the world. I don't know, I don't really think that there is another instrument that's a perpetual 10% plus floating listed preferred stock that's 5x over collateralized. I just don't think you'll find anything like that in the world. I've never heard of it. So we think we've created something which is akin to, you know, the nuclear-powered hover car, right? And that's cool. And the world doesn't know it yet, but I think everybody's going to like the idea of something which has double the performance that lasts for 30 years on one can of fuel, right? And I think with Strike, you know, what we wanted to do was create something that gave people Bitcoin upside with downside protection, principal protection, and a guaranteed coupon. So a lot of people are scared to, I mean, they don't want the roller coaster of 100 vol, but they're scared to death of 50 vol. And if you say, you know, if you go to the average person on the street, you know, you go to them and you say, well, do you want to invest your, you know, retirement account in Bitcoin or IBIT? It comes from a good company, BlackRock. They're like, well, I just hear it's too volatile, right? And the talking heads on CNBC think it's too volatile. And they're like, well, and I need money to live on. Well, what if you get an 8% dividend and you get principal protection and you get a conversion rate, which works out to be like 35, 40% of MSTR, which can work out to be 80%. It could be 80 to 100% of Bitcoin. What if you have the potential to get 80 to 100% of Bitcoin and you get the guarantee and you get the downside and it's over collateralized and it's liquid? Well, that's kind of like Bitcoin with guardrails. You know, actually, Bitcoin with guardrails with a living stipend, right? I'm going to give you the Bitcoin vehicle. I'm going to give you a stipend, right? I'm going to put rails around it, and I'm over collateralize it 5-to-1 or something. The creation of those instruments are to onboard a massive class of normal investors that would just like to live happily ever after, right? And I applaud anybody that's going to live happily ever after because they took the plunge on MSTR, but that took a lot of conviction. And the way that we grow this market is we provide the best credit instrument for the most skeptical fixed income investor in the world, and they come in. And then we find this great Bitcoin middle instrument for the normal investor that simply can't handle the G-shock of the fighter jet, you know, when it pulls up, because we pull the stick hard sometimes, you know. And in fact, of course, if you listen to us on our earnings call, right, the torque, or to your credit, fully torqued Bitcoin. The investment proposition of MSTR is we're going to make it double, triple, fully torqued Bitcoin, right? If it's a 2x Bitcoin, I'm sitting around trying to make it a 4x Bitcoin. And if someone walks in and said, I have ways to get it, you know, from here to here to here, and when I think about it, I get kind of excited. You know, I'll say to Phong, if we do this and this and this, we could get to 3x Bitcoin volatility, maybe 4x, right? So and there's a group of people for which volatility is a beautiful word, and they get, you know, the Jeff Parks of the world, and they get very excited. And there's another group of investors that for volatility is a dirty word, and most of them are sitting on CNBC and they're conditioning the mainstream audience every day. And so I think the real key for us, and of course the great irony is the way that we're going to create, you know, the way we're going to be able to pull 4 Gs on the MSTR jet is we create Strife and Strike, you know, and their brothers and sisters, and then we grow that business, and that is an educational campaign, because we have to introduce a new idea, a new security. No one's ever seen it before. 50 years in the capital market. Nobody wanted to hold preferred stocks because they were all garbage. So now you've got one that isn't garbage, the not garbage one. Yeah. Now we have the not garbage one, right?
I think Strife is a better name than not garbage.
Yeah, that's why we went with that. He keeps me honest. Sometimes I get too excited. Yeah.
So you've got an entire room here full of a lot of retail investors that are very excited about everything you're building, everything you're bringing to the markets, all the ways you guys have invested your time in educating them and really teaching new courses in what finance looks like even in people's personal lives with all the new products that can get integrated. What's the one thing you would want to say to the retail community that you would really like to stick with them?
All good things flow from Bitcoin.
I don't think I can say it any better.
Yeah, we're on a new frontier of digital capital. You guys are blazing the path. We're hanging on. It feels like we're hanging on the outside of a rocket sometimes, right? I mean, holy moly, fully torqued is right. Yeah. So I guess I've got one more question, and you know part of my presentation a couple days ago was about the evolution of like the equity market, right? And it's primarily been a function of how fast data and communication can transmit between people, and we're now seeing this increase exponentially, right? We've seen some mania with the GME, and information is moving incredibly rapidly. And we're also seeing the advancement of intelligence, right? And a lot of this conference has been about the advancement of AI and intelligence. How do you see that changing in the next year or 2 years with communication flow increasing incredibly rapidly? Does that, what exactly does that look like?
The William Gibson quote is very apropos at this point. He's quite a brilliant writer, and he said, "The future is already with us, it's just not evenly distributed." The future's already here, it's just not evenly distributed. What you have is heterogeneous future shock. Ideas and technologies and protocols are rippling through the global economy everywhere, in every different way, but they're manifesting themselves differently on different organizations, different entities, different individuals. And there's a natural rate at which ideas can propagate, but they propagate through various fluids at different speeds, and they have a viral effect. I mean, think of it as any kind of virus. It infects some people and they shrug it off, and others become super spreaders of it. When I was as an engineer, the metaphor that is very powerful in my mind is a shock wave. And a shock wave forms when you have an airfoil moving faster than the rate at which the air can get out of the way. So the speed with which air molecules communicate to each other has a common term. We call it the speed of sound. But it's really the rate of communication of molecules of the air. When you're slower than the speed of sound, you have subsonic flow. It's very easy. It's pretty efficient. When you actually breach that speed, it's like you look that way and I slug you in the back of the head with a baseball bat. And if you're looking at me and I swing the bat, you duck. So if you're looking at me and I'm communicating fast enough, it's just a trivial joke. But if you're looking away from me, I take your head off. And so that's why you don't travel supersonic. Right? That's why in 50 years we can't figure out how to create a supersonic passenger jet, because it's so much more obscenely expensive and turbulent to breach the speed of sound. I think you got to think about the idea of ideological shock waves, like this week a Bitcoin strategic reserve bill vetoed by a governor in Arizona. That's an example where it's going too fast and the governor sees no merit in the idea, shuts it down, and then a Bitcoin Strategic Reserve Bill signed by a governor of New Hampshire, right? So what you're going to see is all these ideas, you're going to look at them and you're going to say, well, this is a great idea. It's pretty obvious every family, right, should adopt this. And it's going to be like, no, no, hell no, no, of course. Of course, I'm going to quit my job and tell the next 100,000 people this, right? That's how the idea will spread, and you'll say, well, why doesn't everybody react rationally? Well, you have a heterogeneous market. Everybody has a different attention span. They have a different set of prejudices and biases and a local set of information and political preferences. And the way you know you're succeeding, right? When the central banker of whatever country says, we've decided not to adopt Bitcoin as a strategic reserve asset, that means you're succeeding, right? When, in your video, when bankers that run large banks say, I hate it, that means you're succeeding. And the reason you're succeeding is because it's a new idea, it's a shockwave, it's propagating, everybody's getting asked the question, they don't want to answer the question, they don't want to address the issue any more than the air doesn't want you to go faster than the speed of sound. And what happens when you break the speed of sound? You get a sonic boom, right? It's very loud. And so the screeching is indicative of the ideological velocity and the rate at which it's spreading. I think you're just going to hear lots of screeching. Lots and lots of screeching about all these things, and it would be a mistake to interpret the screeching as negative feedback. When you hear the sonic boom, that means you succeeded as an aeronautical engineer, right? That's a success. And when you get the sonic boom in the capital markets, that also means you're succeeding. That means that everybody in the world is forced to embrace, right, and react to a new idea, and there hadn't been one for 100 years.
Speaking of airplanes, 3, 4, 5 years ago, you often said Bitcoin adoption is going about as fast as it can go without breaking something. Do you still feel that way, or is there a chance that Bitcoin treasury companies can pull that future forward, nation-state adoption can pull that future forward?
Well, I still think it's going as fast as it can go, but I think that Bitcoin treasury companies are every Bitcoin treasury company is a motor on the network, right? Torquing the network, right? And so as they get bigger, they're going to get exponentially more powerful. Metaplanet is getting exponentially more powerful. Semler is getting exponentially more powerful. We are getting more powerful. Right, so I think that they're part of the dynamic that's going to drive the market. But my thought is it should be growing 30 to 60% a year for the next decade, and my long-term forecast is 30%, 29% ARR over about 21 years. So I haven't changed my view on that, and I think that everyone that gets involved, you are a driver, right? Everybody in this room is a driver. Every company that adopts Bitcoin is a driver. Every time a politician advocates for it, they're driving it forward. But you know what? Every single time a politician blocks something or reacts negatively they're driving it forward. Right? You can't pay for the marketing we just got in Arizona. Right? That's going to catalyze millions and millions of people to say, well, what is this thing? Was that the right decision? Right? Should we reevaluate this? So I think that everything is good for Bitcoin.
So Strategy is the company whose phone is always going to be ringing as new companies start to enter into this market. What sense are you getting that this is really accelerating at a much faster pace than people are thinking?
I think a year ago, there was us, and then Semler and Metaplanet, which are companies with an operating strategy that adopted a Bitcoin strategy. Really, that was just a year ago, right? Came out and said that they were going to adopt a Bitcoin treasury company strategy. And now we're up to 70 companies. So if you extrapolate that out, that means that next year, right, we could be at 700 companies, right? And I think, look, success breeds interest. And we're at a time when there is just a lot of uncertainty in the economic environment, which causes companies to ask themselves, how do we create value for our shareholders? And if they go out and they just say, let's look at the top 15 companies in the world last year, you know, number one is Metaplanet. Semler follows somewhere in there, and I think we were number 14, right? Like, you would think that that would cause people to be interested. I think the other piece is, you know, a lot of folks talk about the Overton window and what's happening with the US government and the embracement of a strategic Bitcoin reserve, digital asset framework, stablecoin bills. We have an administration who's very supportive of Bitcoin. It makes everybody wake up and say, hey, what is this Bitcoin thing? Right? So I think we're early, but I think the acceleration is real. And I think, you know, from last year to this year, right? We held this conference last year in Las Vegas. I think there were about 50 to 100 attendees. This year we're at 300 attendees. And I think in this room, there's probably 400 interested folks, right? Next year, maybe we'll have 1,000. Right, so I think the acceleration is absolutely real. It's exciting.
Absolutely. Yeah, it's hard to beat Bitcoin, so join it. Or talk about the company that's, you know, buying as much Bitcoin as humanly possible, and hey, perhaps we become a Bitcoin treasury company, and maybe we go public and we start being one of those machines in the wheel. Yeah. So, you know, I think we're at time. Should we wrap this up? Should we do final thoughts, pass it around, just like a True North call? Yeah, maybe we'll start with you, Ben. Some final thoughts.
Yeah, I mean, my final thoughts are just being at this event this entire week has just made me so hopeful for so many people, because the number of people out in the halls here talking about the impact that just a single equity and the entire ecosystem built around it has had on them, it shows that the information we share and the way that we share it makes a real difference for people in their lives. And it's one of those things that makes me very hopeful that more people are going to get on board with this mission, and they're going to push forward with telling all the people that they love about what it is they're discovering. This is life-changing stuff for a lot of people, and it's just been so amazing to meet so many of you. And all of our lives have been impacted by Mike and Phong, and this has just been a really amazing experience. So I'm really happy to be a part of this journey.
Maybe you, Tim?
Yeah, all of this reminds me of what you posted when we did our programming. We had, I think, at least a dozen, maybe 15 or 20 different countries in the room, and to have those conversations in the hallway with people coming up to you and saying, hey, I flew 16 or 20 or 30 hours to come see you, to come see Jeff. That really leaves an impact. So we really appreciate the support, and we're literally, right, the community power that we talked about on Monday, that's everybody in this room.
Yeah. Maybe over to you, Phong.
I want to thank you guys for what you've done, for not just strategy, but for Bitcoin. And I've expressed this sentiment before, but I feel it more now than usual, than ever. What's great about Bitcoin is because it represents freedom for a lot of people, it attracts some pretty cool, good people, right? Like, you know, you can't say that about every technological revolution, every capital revolution, every digital revolution. I've met some amazing people here. I've met some amazing people over the last 4 or 5 years, and that's the sentiment that I don't think most people get, right? And being in the room here, you get it. Being around people, and you know, but like, it's just, you guys are great dudes, right? The folks out here are good, cool people who care about their country, about the world, about the economy, and about freedom. And that's just, it's just an awesome feeling to be around people who are just good, honest people.
All right, Michael, I'll leave you for last. I'll go, and we'll let you close it out. So some of my final thoughts, I met a ton of incredible people being here. Some of my final thoughts are really trust your gut, right? I think a lot of people are probably feeling a gut feeling in their room, being around so much energy. This is the innovation, this is the most innovative company in the planet right now, and I think it's very apparent being at this event for the last 3 days. So trust your gut and upgrade the world, right? If you see an opportunity, take it. I mean, I left my very comfortable traditional financial job and to take a bit of a risk and explore this. And I mean, here I am. I never would have guessed that I would be on stage with you guys. I mean, this is incredible. So thank you. And upgrade the world. So appreciate the time, everybody. So over to you, Michael. Final thoughts.
Well, I want to thank you guys for setting this up. For those who are listening to this on the live stream or future recording, I just want to say I'm sorry you can't be with us here because the energy at this conference is electric. I've been to a lot of conferences in my life. I can say that I've never seen the electricity, the hope, the optimism, the enthusiasm that I see here at this conference, in this room, in this community, at this time. And so it reminds us why we all come back together again, and the value of coming together. And then I'll just end with the thought, I said all good things, they all spring from Bitcoin. Bitcoin is hope, and the beauty of Bitcoin is that we're able to create better equities, better securities, better products, better services, better communities, better governments, better protocols, better plans, better strategies, better philosophies, better politics, better everything, right? It just injects a better spirituality and a sense of optimism into the world. And I think anybody that doesn't understand what I mean when I say that, I would encourage you to block out 100 hours of your life and go down the rabbit hole and try to figure out how this can be beneficial to you, your family, your company, your community, your institution, your country. I got to say, I'm just incredibly energized by the community, by each one of you. It's an extraordinary privilege to be on this journey with you. Thank you for your support.
Make everything better, and a cocktail might make the night better. So please head over to the cocktail reception presented by USI. Thank you so much for joining us for Bitcoin for Corporations 2025. I'm pretty sure Michael Saylor made a great pitch for 2026, so encourage your friends, your family to get tickets for next year because there's something very special about being here in person. Thank you so much to all of you watching, streaming, and have a great evening. Thank you to our sponsors, and thank you, Strategy.